the chief executive officer of the company at year end.
To the Omaha of the Oracle of Omaha this morning, Warren Buffett, who announced his retirement at the young age of 94.
If you have to have a career, let it be like that.
Yeah, if you have to have a career, let it be like that. And finally, he decided to retire, and that standing ovation there. I think the thing to learn about, from Warren Buffett is his investment philosophy.
Yeah, I mean, the patience that he's teaching investors is spectacular, because that's what he's talking about still at the age of retirement at 90, that you should be a long-term investor.
Yeah. And, the modesty that he has, the humility that he's had over the years, there are those metrics, and you can throw so many out, right? The cash that they're currently holding, how many companies would they be able to buy with that money?
Yeah, sitting on cash and giving his successor, Greg Abel, here's the money, now take it forward. So a lot on Warren Buffett, if you want to know about it, his journey, etc., on NDTVProfit.com. But a very good morning to all of you. You're watching India Market Open, and it's looking like it's going to be a good start of the week. After about the last 3 trading sessions being range-bound, bulls seem to be firmly in charge. If you look at the implied this morning, you're looking at a gap up. And why not? Because global factors have been all in the positive. Everything you could ask for from an Indian perspective. US markets, for example, surged in Friday trade. US markets have now officially recovered all losses since April 2nd, when the entire trade war sparked and the Trump tariffs came into place. So just let's take a look at how US markets closed. S&P 500 was up 1.5% nearly. The Dow up 500 points, and likewise for the Nasdaq. So this is 20 sessions nearly of up moves that we have seen on key indices. So what are the reasons for the US markets being positive? Recession fears are easing. They've not gone away, but they're easing, because the payroll data that came in over the weekend was positive. In April, payroll has grown by 177,000. Expectations were of 133,000. Yes, it's a big drop from what we saw last month, but definitely better than expectations. Unemployment rate has also come in at 4.2%, which was what was being expected. Treasury yields jumped on those positive cues. The 10-year was at 4.3. And oil prices is really the big story this morning. Oil prices have plunged as OPEC Plus has agreed to increase production. Brent is below the $60 mark. So once again, good from an India perspective. Asian markets have shut on account of various holidays, but the India implied is looking good. So all in all, the setup as far as India is concerned this morning is good. But Matt Orton joining in, his chief market strategist, Raymond James Investment. Matt, very good morning to you from where we are, and always great to have you on the show. I'm just trying to understand if the optimism we're seeing is something that could last, because it's one set of data. The backdrop of tariffs still remain. This morning, news coming in that Trump wants to apply tariffs on movies made outside the United States.
Good morning. It's always great to join. And I've always been more of a glass half full person throughout all of this uncertainty that we have. And I think a lot of the reversal that we've seen over the past couple of weeks, I mean, we've just had 9 consecutive up days on the S&P 500. First time that has happened since November of 2004. So there's a lot of, I think, reversal hope that we're going to start to strike trade deals, that the worst left tail scenarios are off the table. There's going to be some key events this week that we have to pay attention to. Number one, the S&P 500 is approaching some key technical resistance levels. So can it hold its own? Can it break through some of those levels? We're going to see. And I think the most important detail is going to be the Fed meeting. And so on Wednesday, we'll hear from Powell. And I think that Powell is going to strike more of a hawkish tone. I think interest rate pricing, the expectation for cuts is a little bit ahead of itself, given that the data continues to hold up fairly well. We're seeing decent earnings, much better than feared across the S&P 500 companies as well. So I think amid that backdrop, the Fed's going to be very reticent to try and broadcast more cuts that are coming up. So I think we're going to have some adjustments, but I do think that dips are viable, and I would wait for dips to start to put more capital to work in this market.
Matt, that's an interesting perspective that you're putting forth as well. Good morning. This is Hiral on this side. When you talk about Powell being more hawkish from here on, what would that actually mean for the money market, taking into consideration the way the dollar index and the bond yields are moving? Because that, again, becomes absolutely imperative for emerging markets as well.
Hey, good morning, Hiral. And that's a really good point. Part of the reason that emerging markets have worked so well this year is because the dollar has been so weak, and understandably so, given the position that tariffs and that uncertainty has created and capital flows happening around the world. I think that dollar weakness, we're seeing a lot of dollar weakness again overnight tonight. And I think the market could be in for a little bit of a rude awakening, some reversal potential, given more hawkish comments from Powell. But I don't think the downward trend is over. So again, I think the strength that we've had, particularly in markets like India, supported by really pretty good earnings across a number of key companies, I think you want to keep that more optimistic bias to your positioning in the market, but wait to put some more money to work, because there's going to be ups and downs. There always are in this market. And I think investors really should be looking to use downside opportunistically rather than chasing upside, just because there are a lot of potential near-term speed bumps that could give you a better entry point in the current market.
Hi, Matt. Alex here. Speaking of downside, and I realize you and I are similar. I think a lot of people choose to look at the glass half full. But I was reading a comment over the weekend, and it says there appear to be similarities to the Roadrunner cartoon, in which Wile E. Coyote keeps on running long after the ground has disappeared beneath his feet, ahead of the inevitable moment of realization when gravity kicks in. So the writer is talking about the possibility of a cliff edge kind of a situation, and we did see those payroll numbers come through. What if there's a dramatic shift in the data as early as this month, or perhaps next month? What happens then?
Yeah, hey Alex, good to see you. And I think it's a question I asked myself when I've spent a lot of time over the past month talking to clients multiple times every single day. And a lot of them have been a little bit more glass half full, which has been surprising to me. I think everybody learned what happens when you take money out of the market like you did in 2020 after COVID, only to have a recovery. We know there's going to be damage as a result of tariff policy. We know that economic growth is going to slow. Obviously, Q1 GDP results are an anomaly just because of front running of tariffs, but growth is going to weaken. I think the key, though, is when you look at all of the data that we have, payrolls data especially, because jobs are so important to sustaining the consumer in the US, what we are seeing is that the jobs market remains strong, and that the base from which we're going to have some weakening is very elevated. So I think that provides some insulation. Plus, you have the White House continuing to make pivots with respect to policy and really listening to the cues from the market with respect to where to pull back and where to remain firm. I think that's encouraging. I think that takes those worst left tail scenarios, that proverbial cliff that you just mentioned, off of the table. And the big question now is just how much does the hard data actually pull back? I think based on what we're seeing, based on all the CEOs and management teams I've been talking to through this earnings season, I'm not getting the sense that they think this economy is completely derailed. Some of the growth is just delayed. It's being pushed back, but there's still the hope that when we get policy right, plus deregulation, which the administration is starting to focus on, plus making permanent some of the tax cuts, all of that provides some offset. So to me, when I look at the market, the key is being selective. I don't think you want to own the full market. You want to own high quality companies that are leaned into secular, long-term, durable growth themes like artificial intelligence and the more AI tangential plays. Those are the places where we're seeing continued strength, trading at really big discounts, and still today trading at big discounts.
You know, the other big factor, Matt, which I think we should talk about a bit and try and understand what the impact will be, is what's happening with crude. The almost overnight plunge after OPEC Plus has made it clear that there's going to be more supply coming in. Benign crude prices seen in the context of an emerging market like India is another positive buffer?
Yeah, I think that's right, Tamana. I think weaker crude prices are certainly a positive for emerging markets, and India in particular, especially when you overlay a weaker dollar, and the fact that I think India, along with Japan, South Korea, are probably going to be the first trade deals that get announced over the coming week or 2 weeks or so. So I think that all bodes very, very well. I don't think that the weaker oil prices, at least right now, based on what's happening from OPEC, I don't think they're a harbinger that there's worries that economic growth is going to fall off a cliff from a global perspective. I think it's very much related to supply-demand dynamics. The market's very reactionary right now, so I wouldn't read too much into it, except for the fact that I think we can count on oil prices to be a little bit more weak. Don't want to own energy companies right now in the US, but I do think it spells very, very good opportunities in emerging markets. And India is one that I have been telling clients is a ballast with respect to a lot of the uncertainty that we have from tariffs, given its insulation from US trade, and also the valuation compression you had from the 15% pullback, a couple months ago. So I think there's still a lot of opportunities. And again, we're seeing that reflected in earnings strength, especially from banks, financials. That's really, really encouraging to me going forward.
Yeah, and that's what we want to ask you about as well. I guess that you've adjusted your top picks based on what you've seen in the earnings fine print. So what stands out to you at this point, Matt?
Yeah, so Alex, ICICI Bank is one that we've talked about in the past. That is by far my largest overweight in India right now. This is a name I continue to accumulate on any weakness. Earnings once again were best in class. You continue to see margin expansion. You continue to see a solid wealth management business. It's just an incredibly well-run company. HDFC Bank, though, looks really, really good. This is one we talked about when I added it later last year on some weakness. And I continue to like what earnings have spelled. You had margin improvement, which is good, loan book growth. Those are all really, really encouraging signs and healthy execution from the management team. So I like those a lot. And then when I look at other names that I've been adding to positioning, Bharti Airtel has been another second largest carrier. It's got a lot of exposure not only to India, but to Africa. Again, it's a standout operational story where there's a big margin improvement and lower CapEx because we're kind of through the 5G CapEx cycle. So those are all really, really interesting. A name I have my eye on right now to potentially start to reaccumulate is Mahindra & Mahindra. Again, they report earnings today, so I'll be curious what we're going to hear from the management team. But what I like about what I have seen so far is that they're gaining market share in farm equipment. They're in a great cycle with respect to SUVs, potential accretive mergers taking place, and again, best-in-class management team that's executing. And I think it looks very, very attractive based on the pullback we've had over the past month or so.
Yeah, Matt, good names to talk about. Thanks so much for joining us this morning, and perhaps we'll check back to you after the Eminem numbers to see whether you continue to be optimistic.
Sounds good.
All right. Let's talk about what's happening in trade today. Of course, Eminem numbers later today. We'll speak about that when it does come through. But let's talk about what happened last week. Of course, on Friday, you had foreign institutions continue to buy. They have been buyers in the recent past, but you also had domestic institutions that bought on that session. Of course, we ended pretty range bound. Large caps gained along with global peers last week, and I'm talking about the week as a whole. The Nifty 50 capped the week with 307 points higher, about 1.3% or thereabouts. And the broader markets actually underperformed with a muted showing. The Nifty mid-cap 150 index gained about 0.2% for the whole week, and the small-cap index actually lost ground to the extent of 1.1%. The India VIX, which is a measure of volatility, as you know, climbed through the week and ended Friday at a high point of over 18. And in fact, it has closed the week 6.1% higher. Most of the Nifty 50's gains took place on Monday, that is the 28th of April, and the Nifty 50 actually ended flat on the remaining 3 trading days of the week. The key sectoral moves last week, though, because there are a few pockets of very considerable strength, and one of them, for pretty obvious reasons, and you will know about this, is the defense pack. It gained about 6% or thereabouts, and you had oil and gas led by the oil marketing companies that were also in focus. They will likely be in focus today as well. But maybe some of those gains will be pricing in the benign crude prices that you're witnessing right now, and also the earnings that came through. Significant beats on EBITDA were announced by the oil marketing companies. That entire pack was up about 4.4%. Realty up about 2.6% or so, and auto up about 1.3%. IT was up just about 1% or so, and the underperformer was metal. Not many in the way of significant underperformance, but metal was down about 0.6%. Lastly, just bear in mind that the Nifty 50, though it showed some signs of consolidation in the last couple of trading sessions, is continuing to trade above its 50, 100 and 200-day moving averages, and the current RSI, which I'm guessing Hiral will also speak about, is above 70, which continues to indicate overbought zones, Hiral.
Absolutely, Alex. I mean, we're talking about consolidation, but what's happening is that 600-point range is where Nifty is stuck, right? And it's failing to break beyond this range. So there are signs of hesitation that Nifty is displaying as well. And this is coming in at elevated levels. And repeatedly, you're seeing Nifty, which is getting knocked back from that resistance zone. And intraday, it's giving you those fake breakouts. And that is what is indicating that, yes, there is some bit of momentum which is fading, and this is a period of consolidation that is coming through. Apart from that, the market is seeing some sideways movement which is laced with caution, and there is stiff resistance near higher band, and that is what is stalling this kind of bullish momentum which we are seeing during intraday trade. Overall, it's a choppy range. Those overhead resistance levels is what Nifty is failing to conquer, and you're seeing consistent, persistent supply pressure, and there is an undercurrent that's passing, which is telling you that at least the retail mood is still not with the markets. Now, despite that kind of sporadic buying that you're seeing in terms of intraday trades, that intraday move is becoming very deceptive. So that's what you have to be cautious about. There is this ongoing tug of war that's happening between the bulls and the bears that is suggesting that the market has entered a time-wise consolidation phase. Now, key levels, as long as Nifty stays above the 24,000 to 23,900 zone, there is that positivity factor that continues. And a decisive move above 24,500 is what could lead to a crucial rally from here on. But if there is a breach below that 24,200 mark, it could invite swift selling pressure as well. And there is an immediate resistance which is placed at 24,590, and 2450 is that immediate support zone. Talking about Bank Nifty as well, the reaction will be watched in today's session because you have SBI as well as Kotak Mahindra Bank that have reported numbers. So their reaction and their contribution will become crucial. Bank Nifty also, if you think, is stuck in a limbo because it's been a very narrow 2,000-point range that Bank Nifty has been trading at. Again, there is time-based consolidation that you're seeing there. 56,000 is the stiff resistance in terms of Bank Nifty, and if you talk about the support, that lies at around 54,450 as well. Overall, the strategy that investors are currently using is buy on dips, but to be noted, this is what the fund managers and market veterans are pointing to, and technical analysts are pointing to. The retail participants are not still trying to get into this kind of a strategy of buy on dips. They are on that wait and watch mode because there is the fear with regards to India-Pak tensions. Now, the FOMC and its policy outcome in the upcoming week is what we are watching out for. Today, Eminem will be reporting numbers from the large cap space. So watch out for this counter, and you have the other companies on your screens that will be reporting numbers from the broader markets as well. So these are the ones that we should be watching out for. But clearly, there is that slight bit of positivity, but your bears are coming in at the resistance level and taking you down.
And I think geopolitics is part of it. I agree with you completely here. If I was to look at factors to watch, earnings and the remainder of earnings this week would be important. Eminem, you'd see maybe a Titan, some of those large companies which have to report so far. Geopolitical factors, there's been a relative lull, but is there going to be an escalation this week is something that the street will watch very closely. Even in terms of FII flows, and they've been positive so far, but they've also been diminishing. So that's something that you need to watch out for. That is that support continuing, and of course the FOMC meet May 7th will be keen. This note from Goldman Sachs I want to go through very quickly before we get to the F&O setup. where Goldman Sachs is saying, based on the 53 MSCI India companies that have reported earnings, they're tracking ahead of consensus with an average of 2 to 4%. There's a surprise on EPS, that's earning per share. About half of the reported stocks have beaten estimates, the highest in 14 quarters. So, that's why you're seeing the positive note in the markets, because this quarter was expected to be quite a dud. It's turning out to be not as bad, simply put. Autos, industrial, cement have posted the most beats, says Goldman Sachs, aided by better than expected margins. Despite a better than expected quarter so far, sentiment for earnings remains subdued, with 1% EPS cut QTD for MSCI India, especially in domestic cyclicals, reflecting a soft outlook. So that's one factor that we should see. There's an interesting note this morning from Rhythm Desai as well, which we'll come back to. But first, let's go across to Puneet on the setup on the derivative side.
Well, thanks for that. So, as you guys rightly said, there is a time correction seen across the index, and we are seeing that in stocks as well, because we've seen a lot of out of money calls as well as puts taken. So, at least on the implied open on the Nifty, we are seeing a 100-point gap up opening. 24,508 is the level that the GIFT Nifty is indicating. Now, we've actually were not able to sustain the high of 24,589 in the previous session. So, something to watch out for, at least on that aspect, if we can close above this level. 24,300 has been a level that we've been able to maintain. The Nifty Bank as well will be in focus on the back of numbers from SBI as well as Kotak Bank. In this week, we're also seeing the FOMC number meeting as well as that will come out as well on Thursday for us. When we see the impact of that Thursday morning, another one will be there. On 56,300 is the level on the Nifty Bank that we are watching out for. In terms of the open interest, both distribution for both the losers as well as gainers. First, let's look at the calls. So at 24,500, we've seen an increased level. We've also seen an increased level of calls at a 25,000 level as well. That's another one. And some interest seen again on 24,800, indicating that traders are looking at to the reduced premium in the out of money calls and puts. In terms of both puts, 24,000 remains a firm level for investors and traders, essentially taking a call on the index. Finally, in terms of stocks as well, on the gainer side, we are seeing some long build up on something like a PNB Housing as well as Eternal. Eternal again in focus up on the back of earnings, and Federal Bank as well as Hindustan Zinc and Indian Bank has seen some short build up. Finally, in terms of losers as well, we are seeing short coverings for stocks like Deepak Nitrite as well as AU Small Finance, as well as something seen on Laurus Labs as well. Some long unwindings on TCS, and that is might be just a call on the IT index as a whole. But overall, we are seeing a gap of at least a 100-point open. It's effective to see where we close, at least close to the 24,589 levels of the previous highs. Essentially of the last week. So that will be something to watch out for. But again, a very earnings heavy week, and that will determine the levels of the index as well.
And I think the first few stocks on my list will also determine the mood today. Thank you for that, Puneet. I'm going to start with State Bank of India. On balance, inline numbers. So on balance, a thumbs up from our end, although other income has boosted those numbers to some extent. So here's the picture with State Bank of India, and we'll have a more detailed conversation on it in just a bit. But net interest income was in line with expectations. Profitability mildly better than expected. Other income has ensured profitability. So that's the only sort of minutiae that you need to look at, that it is the other income that has boosted those numbers. Healthy growth was posted in Q4. Lack of reversals and normalization of loan losses has hurt credit costs to some extent. Look at the core numbers. Net interest income up 3% YOY and QOQ. Operating profit is also up about 9% year on year and 33% Q on Q. Provisions have gone up a fair bit at 6,442 versus 911 crores. PAT is at 18,643 crores versus 20,698 crores. So that's down about 10% year on year, but up quarter on quarter. Gross NPA ratio has come down by about 25 basis points quarter on quarter. Net NPA ratio is at 0.47% versus 0.53%. So that's down about 6 basis points quarter on quarter. Advances are up 14% year-on-year and 4% Q-on-Q. Deposits, meanwhile, not a bad number at all, up 9% year-on-year and 3% quarter-on-quarter. The NIM figure, net interest margin figure, is flat at 3%, mildly down. But I think what the management is saying about the NIM figure is important, where they're saying they expect that standard to continue because of the decline in treasury yield, though that helps aid treasury profit, but they expect NIMs to be under pressure, and the full year NIM for FY26, that's the net interest margin, is expected to be at 3%. Quite a few notes this morning on SBI. I'll just pick one. Investec has maintained a buy, hiked target price to 920 from 870. They say that the net interest income is in line. High treasury gains have aided this 1.1% ROA delivery. Softer loan growth is led by chunky prepayments. Asset quality remains rock solid. Moderation in ROA is led by lower NIMs and non-core other income. But all in all, they're quite all right with State Bank of India. Thumbs up for Kotak Mahindra Bank as well. Although growth is slightly below expectations, margin have improved quarter on quarter. There's positive commentary. Credit cost pressure is led by microfinance, and return on assets seems to have sustained. In line net interest income as well, and margins better than expected. Significant net interest margin cushion is available, and microfinance delinquencies continue to remain. Slower growth in corporate and unsecured. That's the overview on it. Let's look at the core numbers. Net interest income for the quarter was up 1%, but 5% year on year. Operating profit at 5,472 crores was completely flat year on year, up 6% for the quarter. The operational expenses have also gone up 8% on the quarter and 13% for the year. Provisions have also gone up at 909 crores. They're up 14%. PAT, though, the profit after tax is down 14% year on year, but up 8% quarter on quarter. The NIM figure is what's good for Kotak Mahindra Bank at 4.97%, up 4 basis points. Management also expects that bank will grow their advances 1.5 to 2 times of nominal GDP. Their unsecured book will be up to 15% of their entire book. They expect tech changes to aid their housing finance book as well. So all in all, you're seeing a decent set of numbers from Kotak Mahindra Bank. They also think that margins have improved due to savings account rate cuts, and higher CA balances are aiding it. Investec has maintained a buy on it, and they've hiked the target price to 2535 from 2300, basis the strong asset quality despite the softer top line. So those two are decent. So is Indian Bank actually. That's a solid set of numbers. Net interest income is up 6.2% at 6,389 crores. Profit is up 31.6% of year on year. That's at 2,956 crores. Net NPA has come down. Gross NPA has also come down. So good set of numbers from Indian Bank. The only pain point for them is what's happened over the last few days with JSW and Bhushan Steel. So their recoveries get stuck because the Supreme Court has come and struck down the entire deal under the IBC. So they will have to return about 1,200 crores if that doesn't go through. It's in review right now. So that was a big story on Friday, and that might have an impact on Indian Bank. But the numbers by itself was good.
One thing is, in terms of Bhushan Steel, is I think 40% of their exposure, what they had, is what they've already got in terms of recoveries, and this was back then when it was admitted with NCLT. The remainder is something which they've already written off the books. So this move, the moment it goes through, in a way I think the bank is taking it very positively, because that will help them recover money the moment it goes to another person. So there are full possibilities that could go to the Tatas or the Liberties, as they were the next bidders after JS.
I think they're worried they'll have to return the money.
40%.
No, they're saying they will not have to return the money, apparently. They're saying they will be able to, because it's already taken on the books, and it's through the NCLT, that money might not go through. So that is what is the stance of the bank. What happens over here,
we'll have to wait
and watch, but 40% is what they're sitting on right now already.
It's a pretty straightforward thing from the perspective of an outside view. Of course, that the bank is an interested party. But if you were talking about a deal that went through insolvency, an asset was bought, money was paid, and the banks recovered a certain amount of money, they wrote off the rest. But if the deal has been scuppered,
They'll have to give it back.
they'll have to give it back.
And I think they have said that. You know, we'll go back and get that clarity. They have
Yeah.
said that they'll have to give it back up to the basis of 12.
So whether another deal is done.
But the numbers are solid.
Yeah.
So the thumbs up marker is on the basis of the numbers.
And whether another deal comes through later, of course, that would be a positive. But anyway, let's talk about a couple of stocks that I've lined up for you. The first one is an interesting one. It's an order win from Aether Engineering. And I'm giving this a thumbs up purely because of the size of the order. It's signed a long-term agreement, supply agreement with GE Steam Power GmbH. And this is for the supply of rotating stationary airfoils. Now, if you're unfamiliar with what an airfoil is, you will, if you've seen the wings of an airplane, those parts of the airplane that move up and allow the plane to get lifted, that is also something that goes on turbines. So this is used in several power plants, in nuclear plants as well. That order, by the way, is worth about 452.5 crore rupees. The order completion is seen over the next 6 years. Now here's the interesting part, because the order value is the equivalent of the current 1-year sales. And if you are seeing it get booked over the next 6 years, you're talking about a run rate of about 70 crore rupees per year over the course of that 6 years. So certainly a positive for this company. The next one on my list is an earnings update, and this is from RR Kabel, a solid set of numbers coming through, a 26% increase in revenue, 2,217 crore rupees ahead of expectations. The EBITDA is up as much as 68%. The margins have improved quite substantially by 218 basis points, also ahead of expectations at 8.7% or thereabouts, and the PAT as a result of which is up to 129 crore rupees, up as much as 64% year on year. Now, there's also an update in terms of capacity expansion, and you will be aware, of course, of the context in which RR Kabel is operating. There is significant pressure and competition coming through. This company doubling down and saying that it is going to invest in additional capacity. 36,000 metric tons of capacity expansion of wires and cables has been approved. The expansion is set to take place at the Waghodia plant, and the capex for that plant is set at 1,050 crore rupees. A further expansion of the Silvassa plant has also been approved by about 6,000 metric tons, and that expansion is going to cost 400 crore rupees. So the company doubling down and increasing capacity at a time of a rise in competition in the space. By the way, their numbers have been aided by their core wires and cables operations. Now next is Aether Industries, and this is a thumbs up. It's an interesting play, and this is in the API and agrochemical space, primarily APIs. The revenues come in at 240 crore rupees, and it's a significant improvement, of course. The EBITDA is coming at 79.5 crore rupees, and the margins have improved very substantially to about 33%. The PAT as a result of which is coming at 50.2 crore rupees compared with a loss in the comparable quarter of 1.4 crore rupees. The PAT number is up about 16% sequentially. So even on a sequential basis, it looks good. But here's the thing. The numbers are actually in line with expectations. Of course, it's a solid quarter, but it is because the last quarter, or the quarter a year ago, was a low base. There was a significant amount of growth that was logged in the contract exclusive manufacturing part of this business, which accounts for about 40% of revenue in the fourth quarter. But bear in mind that there was an impact of a fire accident last year that led to reduction in revenues and also exceptional expenses, which is what led it to being a low base last year. And the production halt, of course, took place in December 2023 and Jan 2024, which led to lower inventories and reduced margins last year. So bear that in mind as well. Having said that, it's a solid set of numbers.
A solid set of numbers from Aether. But moving on, the two names which I have, on my list, Alex, are from the FMCG space. It's interesting to see Avenue because it's a thumbs down. Overall, you have the operational performance and the profitability, which has actually missed street estimates. Now, margins are seeing further contraction, but this is mainly on the back of competition. Overall, the revenue number has gone up around 17%. In terms of the key metrics, If you talk about the average billing size, that is seeing somewhat of a downtick as well this time around. The management has alluded to higher growth trajectory in the home delivery business, and the losses in the online business are expected to continue, and this is about DMart Ready. If you talk about store additions, 22% higher is what you're seeing in terms of store additions, but the size in terms of square feet per store has gone down this time around. Gross margin pressure on the back of high competitive intensity is expected to continue, and they're seeing better growth in tier 2 towns. So that is going to be interesting, because that is telling you that there is still that slowdown in terms of urban India. Rural is where the recovery is happening. Brokerages, you have a City which has maintained a sell. They've cut the target price to a 3,250 from a 3,350. And you have a Jeffries which has maintained a hold. They have also cut the target price to a 4,100 from a 4,225. Moving on, the next one on my radar is a Marico. Now, that's a thumbs up, because the numbers have been largely in line with what the street was estimating. It's a volume-led growth at around 8%. It's foods and digital first brand which is leading to the growth, and the copra inflation has kept the margins under pressure at 16.8% versus a 19.4%. The other income has been substantially higher at 47 crores, and that is what has aided profitability. But apart from that as well, the number looks to be pretty okay. In terms of the outlook, they're expecting double-digit growth in FY26. The food and premium personal care will account for 25% of the business by FY27. And they're expecting the digital-first portfolio to scale by approximately 2.5 times. An average revenue rate by FY27 for Beardo is set to reach double-digit margins. You have Jeffries, which has maintained a buy, and they've hiked the target price to 800 from a 780. Macquarie has maintained a outperform, and they've hiked the target price to a 790 from a 780. Goldman Sachs has maintained a buy, and they've hiked the target price again to a 780 from a 750. And very lastly, Atul Limited, and the earnings came in on during market hours on Friday, but the thumbs up is on the back of the analyst meet takeaways that happened. Firstly, in terms of the revenue guidance, 8,000 to 9,000 odd crores is what they're looking to scale up to. 770 crores in sales is what they're projecting from the liquid epoxy resin plant over the next 2 years. And they're seeing almost 1,100 crore worth of unrealized sales from other operational segments. Utilizations is interesting because right now it's below 70%, and they have plans to scale it up to above 90%. So that is what is going to be interesting. Between FY23 to 25, they've made an investment of nearly around 1,640 odd crores. However, the realizations in terms of revenues in the same period have remained very modest. So now from here on, inorganic growth is what they are looking at as a strategic pillar. They have a cash reserve of around 691 odd crores, and they're expecting a potential JV in the US on the water industry front, plus a few inorganic purchases that could be made as well. So this is going to be a thumbs up from my side as well. So a lot of stocks, ladies and gentlemen, that we are focusing on in terms of today's session. But before that, let's quickly slip on to a short break. On the other side, we'll get you top trading strategies. For today, we have Kush Bora in the studio as well.
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two
credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system.
Welcome back. It's all about banking this morning, and Ashutosh Mishra is going to help us break it down. Ashutosh, we're doing this quickly. We're short on time, but let's start with how you've looked at SBI. A bit of a debate here in our newsroom because numbers are in line, but aided by other income. Have you looked at it?
Yeah, good morning. So yes, number is mixed. There are some good indicators also, and there are some lag also in the part of it. But no, when we standing here and try to look out what SBI can do in the next year, given the liquidity things which is released by the RBI, the way things is panning out, it will be a good year from the next year perspective. This year, there are some one-offs which has impacted them. Even in the increase in other income also looks a bit higher because there was a mark-to-market loss in their forex portfolio in third quarter, and compared to that fourth quarter, forex income was very high. So these are some of the one-off which has shown into this results. But if you look at closely and given where SBI is at this point of time, the type of guidance which they are giving in, probably FY26 is going to be a very good year for them.
Okay, Ashutosh, just quickly, Kotak, Indian Bank, City Union, quite a few banking BFSI have reported over the weekend. If I were to ask you to go through them quickly, how would you rate them, good, bad or ugly? Let's start with Kotak.
So Kotak, yes, MFI portfolio was giving pain to them. And what the management is guiding from here is that the next year will be good on the business growth front. And they were lacking on a deposit growth, and especially managing cost of deposit front. With MFI portfolio is already being addressed, and now with easing liquidity and clearly RBI also removing all the restrictions which they have put on them. Now they are well placed in my view, and that's why we have also maintained our buy rating on the Kotak banks from that perspective. Indian Bank result was very good, and especially public sector banks, both Indian Bank and SBI, we have to look also from a treasury part of it. The way rate scenario is panning out, they will have a good treasury income. Either it will be booked through PNL or into the balance sheet directly. But surely, next few months is going to be very good for these banks from the treasury point of view.
Ashutosh, hi, morning. So then, based on the numbers that you've seen so far and the fact that we've seen a run-up of the frontline banks, quite a considerable amount, double-digit, over the course of the last 1 month, do you think that that captures the potential for improvement in the next couple of quarters, as you've mentioned? Or do you think that there is still potential upside? In that context, what are you suggesting to buy?
So I agree with you that the stock has run up quite as sharply, almost all major large banks at this point of time. And first quarter result may not be very good for many of these banks, especially on NII front, because there will be transmission of 50 basis point of rate cut through EBLR will get fully reflected in the first quarter results. Yes, so from that perspective, we may see that stock may not run very sharply from here onward for the time being. But again, these will be transitory in nature. because liquidity floodgate opened by the RBI is clearly going to help them over next 6-month period to come out of this whole transition period where 50% of almost their loan is linked to the EBLR, and rate cut is getting transmitted very fastly on that front, whereas cost of deposit will catch up gradually, especially I think in the next 4 to 5 months it will take. So yes, run up. Currently, we are finding that NBFC will be better placed rather than the bank at this point of time, given the banks are already run up very sharply.
So Ashutosh, clearly then what would your top picks be in pecking order if you have to look at large cap and the mid cap space?
So if I look at the bank, then I will still prefer ICICI Bank, followed by Axis and Kotak on the private side. SBI will be on the public sector bank, and Bank of Baroda is also looking very attractive at this point of time. And the NBFC front, purely Shriram Finance, Poonawalla, these looks very good to me.
Right. Thank you, Ashutosh, so much for joining us on the show and sharing the views. So those are interesting picks. SBI from the PSU banking space continues to be his top pick. ICICI Bank from the private banking space is what Ashutosh is looking at. But now let's also welcome in Kush Bora, founder at kushbora.com, and Parag Thakkar. We have Kush, who is in the studio. Welcome to the show, gentlemen. Kush, before we start off with Nifty as well, my first question to you today is going to be with regards to Bank Nifty, taking into consideration SBI and Kotak will be, contributing to the move. What are charts indicating with regards to Bank Nifty? Because that will give us a direction for what the two banks could be looking like.
Absolutely. First up, good morning, guys. And I want to ask Tamanna, how was it sharing stage with Amir, or nearly sharing stage with Amir?
Yeah, after him.
Right after
him, yeah, at Waves, yeah. I mean, so Waves was a super experience, and Amir just took charge of the entire panel, told everyone, be quiet, let's start.
Oh, wow.
He's nice. But, I had an interesting session on the future of live events. In India, with Book My Show and Wizcraft and the YouTube head of artists, and the potential that they're seeing is phenomenal. So lots to celebrate.
I think we should do a few live events as well, and we should ask our viewers in various parts of the country to write in and tell us where they want us to come next. Maybe if you're writing in from...
There's Guns N' Roses and then there's Alex. That's how it is.
We can do an Ask Profit special. Push can come over.
I've been gunning for those live events for some time now, you know that, right? So, but you should ask the Book My Show guy, what are they doing about the IPL tickets? We aren't getting the good ones, for sure. No, but here to your question, and spot on, and I think that's going to be the theme of the day. Let's start with Bank Nifty today, as you mentioned. We're witnessing a classic flag and pull pattern here, which could well turn out to be a bullish one this time around. We've had a good run over the last month and a half. I think the correction or rather consolidation that we saw in the last week was absolutely par for course. And if you recall, we've had these discussion on the closing shows as well, where I was pretty circumspect about how HDFC, ICICI and SBIs of the world would move after the kind of run they've had. We've already seen some correction, and by that I mean only a few percentage points, but some correction, some healthy consolidation in SBI and HDFC. I'm actually looking forward to a healthy consolidation for ICICI as well. If the 1450 level is taken out, then this up move could continue even now. But if not, then there could be some consolidation. On the whole, very positive on the likes of, the private banking space, especially the big ones, which then in turn suggests that the Bank Nifty is ready to, knock at the doors of 56,000, which it has tried twice but not been able to take out successfully, and then move higher to about 56,600, 57,200 kind of levels. So still very positive. I think this is a launch pad for the next up move for Bank Nifty.
Okay. Speaking of banks, Parag bhai, thanks so much for taking the time as always. You've seen the numbers now, and if I remember correctly, you were liking Axis. Correct me if I'm wrong. And would you double down on that? Would you change your view based on the numbers that have come through?
As Ashutosh was pointing out, see the banking, and as Kush has also said, that banking had a very nice run, right? And they have outperformed the overall Nifty. Because of the RBI actions, mainly. RBI has put so much of liquidity into the system that banks were able to cut their saving rates and deposit rates in order to manage their margins better way. Otherwise, there could have been a decline in margins. As Ashutosh was pointing out, I was listening to that conversation. that there have been 2 repo rate cuts, right? So in April, May, June, that will get reflected. And of course, it is transitory because at some point, the saving rate and deposit rate cut will also match the lending rate cut. And so margins will get normalized. But for next 1 or 2 quarters, you might see decline in margins. So my view today on banking stands as, Axis, SBI, all these are banks which we hold in our portfolio, Federal, of course. So I would say that valuation wise, see, this is the most important point, that although you might see 1 or 2 quarters of slightly lesser margins, but asset quality remains good, which is a very structural thing. So I would be positive on banks, yeah, and mainly valuation. See, SBI at 1 time price to book or PE of 7-8x, Axis Bank at 10p, as I said in our last call. So I would say that valuations are Federal Bank at 1.1, 1.2 times, PE of 10, 11. So valuation wise, it gives me a lot of comfort, especially when I am confident about asset quality in some of the banks, where they have not taken a very large exposure to risky segments. So if you are a calibrated and a disciplined lender, and the stock valuations are attractive and RBI is going to support you by putting liquidity into the system, you cannot be very negative on the sector.
Okay, yeah, I mean, it would make sense to be very negative on the sector, but is there a further upside? We'll come back to all your stock picks, but quick conversation, first an exclusive on NDTV Profit with AKSI Kumar. He's director Apollo Microsystems, joins in to talk about the company's new acquisition plan. They're acquiring 100% of IDL explosives for about 107 crore rupees. Mr. Kumar, very good morning to you and thank you for your time here with us on NDTV Profit. Let's start by talking about the rationale of this acquisition.
Good morning. Primarily, as you know, we are a weapon systems company, and we are slowly growing to a Tier 1 OEM, both design come manufacturing Tier 1 OEM for various weapon requirements. So this will be both backward integration as well as a vertical integration for our company. There are very select few players who have this capability of both designing, complete, weapon at the same time, manufacturing it. So we would fall into this very small club of, very few members in India. It's a capacity augmentation for the country, overall as such.
And tell us about how are you funding this acquisition? What are the kind of capabilities it adds that otherwise you didn't have? Any detail that you can add there?
So we have been traditionally a technology company developing weapon system electronics for the last 4 decades. And we have a spectrum of, variety of, technologies that we have developed onboard weapon applications and also for many other platforms. But explosives and propellants is one such area that we do not have expertise. This is something, which we wanted to actually, get into by acquisition rather than building the capability individually by ourselves. So this is a 64-year-old company having the first explosive company in India, having a capability in explosive side. This is a space where we would be further investing, in developing warheads and rocket motors and propellants and for our current and future requirements.
Okay. Hi, Mr. Kumar. Thanks so much for taking the time. We're speaking, of course, and I don't expect you to give us numbers, but I'm just trying to understand your current order book and the way that you manufacture and sell products. How is it currently placed geographically? Do you primarily sell in India?
Presently, our market is dominant in India. We have 0 exports, and we have a few opportunities that are upcoming for export opportunities for some of the mature products where we have given our offerings to different customers. So this new acquisition would help us, bringing the total solution under one roof where we have the capability of complete weapon as well as the explosive and propellant together.
And the acquisition is set to be completed in the next 2 to 3 months. You said that it will already be backward integrated. In terms of the implications for the numbers, at what point would it be EPS accretive as well?
So presently, this company as of FY24, it has done around 624 crores top line. So with our current, top line of FY25 and, upcoming, the guidance that we have given for FY26, we see that, our revenues are cumulative going to be more than double the revenues actually as in a consolidated balance sheet. So in terms of the profitability also, remarkably, I think, the PAT lines would be similar. As we take this company into, fully into our control, it would be a positive EBITDA company. And there are certain restructuring that we would be doing in terms of entering a long-term purchase agreements. Ammonium nitrate predominantly is a fluctuating market. So we would be doing some long-term purchase agreement with some suppliers, domestic and overseas, in order to balance the overall, improve the profitability margin of the company.
Right. Mr. Kumar, a quick question in terms of your capacity expansion. One of the units comes into stream in the first quarter of FY26 itself. Your construction of the third unit in Hyderabad will be completed by the second quarter of FY26. Are these, number one, on track? And after this, what is that capacity expansion plan expected to look like? Is this going to be a stop right now, taking into consideration the acquisition that you've already made, or are you seeing ongoing capex?
So this acquisition is totally different to our ongoing capex actually. The ongoing capex which we have done for our Unit 3 and the Unit 3, upcoming Unit 3, this is something for the existing business that we have. We are augmenting our facilities as an end-to-end manufacturing, which includes other critical test facilities like EMMC and all, which would enable us to, manufacture both the subsystem as well as a complete Tier 1, short-range rockets and some of our, qualified products like the underwater mines and other products as such. This particular acquisition is totally different. There is a separate factory and plant, that this is a totally out and out different. So apart from this, there will be new other capex also that will be planned. We have 1 year back, we said that, we would be expanding ourselves in composite side for our current requirements. So in a small way, we have started, some machinery are already ordered. Manufacturing is already started, but there, we will be acquiring some land and, expanding it, the base of it in a much more wider way. So capex is something, we would be further investing, but predominantly, ours is not a capital intensive, business. We are a more working capital intensive business, but this acquisition is the first stage, where we are doing a backward integration. There's nothing to do with our capex plans as such.
And it's your tech focused. Just one last question very quickly, and just only what you can share or some direction that you can give us, because we're talking right now in the middle of a lot of tension in the neighborhood, trying to understand the implications of this for a company like yours. Would this increase demand for you? Anything that you can add here?
Yeah, of course, it will increase the demand for us. The upcoming, RFPs like the V-Shore rockets in the next generation, which Indian Army has floated RFP. We are also participating in that. We have certain more products, that are developed, which we are offering to the different services, both for the Air Force as well as for Army and Navy. So I would not say this short-term, very immediate war, how it would impact this thing. But yes, we are part of the supply chain for various OEMs. Definitely there will be a business upcoming, and you see a lot of conflicts happening across, in different parts of the world. So overall defense business as such is growing, and OEMs would have a much brighter advantage. That's how we are trying to get into a different league of business altogether, continuing ourselves to be a technology company.
That's on the business side, of course, but it's good to know that we have strong tech backing for whatever challenges India has going forward. Thank you so much, A.K. Sai Kumar there of Apollo Microsystems. Very short break. We'll be back with the pre-open rates and your top strategies for the day. Stay tuned.
Apollo ties. Now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To him.
Welcome back. You're watching India Market Open, and as things stand, you're looking at a 100-point open. Let's pull that number up, more than 100-point. Actually, we built up a little bit of steam. Let's see if that carries us through to those higher numbers on the benchmark Nifty 50. Kush Bora in studio with us. Kush, we spoke about a little bit about your index strategy and the way that you're looking at the bank Nifty in particular. But let's talk about your picks. What have you selected today?
Could I give a quick view on the Nifty
yes,
first?
That was that was pending, right?
Yeah. Great. So last week, all of last week practically, we've spoken about the cautiously optimistic view, and I was going to say I told you so, but since Tamanna wasn't around to counter me, it's no fun. So yeah, I'll skip that. Or maybe I slip that in, like subtly.
Yeah, very
No, but the Friday move was the textbook definition of cautiously optimistic, right? We did move towards that 24,600 mark only to give up those gains and then come back. I think if the geopolitics, issues now coming close to home, if they went around, I think we'd be in the clear and heading towards, sustainably towards 24,600, 24,800. I still maintain that view that this is a rally which will take us to 24,800, 25,000 levels, but it will be with pit stops. I think at the beginning of the show, if I recall, Tamanna was mentioning that a lot of global factors are falling in place. I think she mentioned crude. Dollar index is something that we've not spoken enough about. Close to those 100 levels. But what's interesting is that if you look at the setup, maybe from a geopolitics perspective, but also from a technical standpoint, both dollar index and crude are actually showing a slightly downward trajectory. So that muted outlook on both of these will actually aid the Indian markets. FII buying's already on the cards. It's happening for a while now. So that's also a healthy sign. So I remain bullish. 24,800, 25,000 is my target on the Nifty for this rally, but with pit stops along the way. As far as the picks go, today I have got both of them on the long side. The first one is MCX. We've seen very healthy moves on this one. Good consolidation over the last, about 15 days, a month or so on the back of very good volumes. So now, this rally could go up until about 6480, 6680 with a stop loss around the 6080 mark. And the other stock is Bharti Hexacom. We've seen very sharp up moves on this one, but with with intermittent rounds of profit booking. So that's also a very healthy take. Bharti Hexaware with a target of 1750, 1800 with a stop loss around the 1650 mark is another buy call.
Meanwhile, the first sort of ticks on markets, and of course these will settle, is giving you some direction of what we're seeing, looking pretty decent. I just want to pull up Adani Ports for you. The business updates have been good. I want to pull up a Tata Motors for you. JLR has resumed exports to the United States. That news came over the weekend. We reported it on NDTV Profit. .com, and that stock also looking interesting this morning. Let's look at State Bank of India and Kotak Mahindra Bank just very quickly. What the first ticks in the pre-open are telling us. And SBI looking negative at this point, and Kotak Mahindra Bank even more so. Some misses there on the top line, but overall There was a positive view from brokerages coming in. Indian Bank, solid set of numbers. So you're seeing that pan out as well. RR Kabul is the other one I want to pull out, as well as Aether, both interesting set of numbers on the positive end. RR Kabul about 2.5% up right now, and these rates will change. Aether also seeing a bit of a turnaround there, and those are some of those factors to watch out for. Parag, very good morning to you. We've spoken briefly about banks, but I want to talk about Tata Motors for a second and Mahindra & Mahindra, both in focus. M&M before its numbers, and Tata Motors, of course, because of the JLR news. Any views there?
Yeah, you asked question to me?
Yes, Parag bhai.
Okay. So basically, yeah, Mahindra & Mahindra will report very decent numbers for sure, because tractor sales have been picking up, plus they have done very good SUV launches. So I expect a very good EBITDA growth in Mahindra & Mahindra. Tata Motors, of course, is a very globally dependent business. So this news that they can start supply to US from their UK plant is a positive one, and stock has corrected significantly. So it might see a positive reaction. One thing, Taman, I would like to point out, which we have not discussed, there has been a consistent price hike in cement. In South, it has happened in April, significant price hikes. And in East also, for example, Nuvoco Vistas reported number that day. And we saw superb, I would say excellent numbers. The EBITDA per ton was 968 rupees, and absolute EBITDA number was above 550 crores for a company which has a market cap of 12,000 crores. And they have reduced that from 6,400 crores to 3,700 crores. And the news flows which are coming in from South and East are absolutely positive. Just to put a disclaimer, we own this India Cement and Nuvoco Vistas, and of course Remco Cement in our portfolios. And one can take the advice of financial consultants. But I would say that this is a remarkable, because the cement industry in December was having a prices which were 10-year low. And practically even the most cost-efficient cement companies like Shree Cement or Ultratech or Ambuja were making a very low EBITDA number, which was not actually helping them to make about 10%, 12% ROEs. So now the entire industry has woken up to the fact, and the petcoke prices are falling and cement prices are going up. So I would say that one sector which I'll be very constructive in near term is cement, especially South and East companies. And if you see, for example, India Cement result also, India Cement, they reduced debt by 1,000 crores. They broke even at the EBITDA level. And now April, May, June is looking significantly better. So I would say that, and both India Cement and Nuvoco Vistas, both are trading at replacement cost around $75 per ton. And you have a very significant short-term tailwind of price hikes.
Okay, so those are the picks that Parag Bhai has in that space. But let's get you the big brokerage call of the day. And Jefferies has upgraded Newgen Software from an underperform to a hold. But they have cut their target price from 1,240 quite substantially to 965 rupees. What is the reason for that cut? And how does that gel with the improvement in the rating? Harsh, I need to tell you about that. Harsh?
Well, it's interesting, Alex, because the stock has fallen 40+% from its recent highs, and therefore definitely warrants a relook, and that's exactly what Jefferies has done. Results were a miss with regard to where estimates were concerned. Growth in annuity is slower than expected. I'll first talk about the business. Annuity growth slower than anticipated, and that is also likely to have a knock-on effect on AMC, which is their recurring revenue. That also is likely to get pushed back because certain projects are being pushed back. So instead of a 6 to 9 month execution, now clients looking at 12 to 18 month execution for Newgen. So longer execution cycles is what is impacting revenue and expected to do so as well. In terms of regions, EMEA not doing so well. APAC is where the growth is coming from and offsetting some of those EMEA losses which the company is making. Now in terms of PAT, also was a miss. All of it, EBITDA as well as PAT miss on the back of top line miss. So that is actually what is flowing through. FY 26-27, Jefferies has cut their EPS, their revenue estimates by 4 to 7% due to all of these factors. They expect a 20% EPS CAGR though over the FY 26 to 28 period. stock they believe has priced in incrementally weak growth, which is already being seen. There's limited downside, but growth slowdown limits upside as well. So at this point, and even Stephen, where Newgen is concerned.
Newgen, in focus, I think auto sales numbers are out from Fada. So that's going to be in focus to some extent as well. So is JSW Steel on the whole Bhushan Power deal falling through. Let me come to you, Parag Bhai, actually on JSW Steel. Huge knock already that we saw coming in on Friday. Do you expect more pain now that we have more details of what the Supreme Court has said? And yes, the company will go in for a review at the Supreme Court, but it's a difficult ask that the Supreme Court will review its own order. It really does.
Yeah. So, of course, JSW Steel will file petition. They have expanded capacity to 4.5 million tons now. So, they have invested behind this asset also. And of course, some part of the negative impact was reflected on Friday when it was down 6%. But I expect a little bit of muted stock price performance for at least 2 to 3 days. And then at some price, it will, at around 920, 930, I think the full impact will be reflected. And then, of course, it becomes a decent buying opportunity because otherwise everything's, for example, safeguard duty and everything is falling in place for the company. So I would say that it's a shocker for the company also because they have invested behind this asset. But, as you rightly said, that Supreme Court decision is a decision. So you have to take it.
What would be your call on the stock, Parag Bhai? Would you say that the pain is now baked into the price or more to come?
So I think close to 900 rupees, I think it's a decent buy.
Okay.
And just to put a disclaimer, we have a very small weight and we would look to increase if it falls to closer to 900.
Okay, so you would look to increase. Kush, just on the charts very quickly.
No, I'd wait this one out. Maybe, as Parag Bhai said, closer to 900, or those levels. But I'd want the dust to settle and see some recovery, rather than just see the base formation in place. Some recovery will help its cause. So closer to those 890, 900 levels. But at the moment, I would avoid this one.
Okay. Swiggy in focus as well. So that's an interesting development. They've brought in their 10-minute delivery format named Bolt, while on the other hand, Zomato has shut its 15-minute delivery. Mahima joins in with all the details. Mahima, one more update from Swiggy is I think they've shut Genie as well. So a lot of changes there taking place in the quick commerce, in the quick delivery space.
Right, absolutely. So, this is interesting because Swiggy just came out with an exchange filing on Friday saying that they're betting big on Bolt, and this is after Zomato did shut down its 15-minute delivery platform. Now, in terms of what they're saying is that Bolt has now expanded to over 500 plus cities and also partnered with 45,000 plus restaurants. Now, Bolt powers 1 out of every 10 food deliveries that are taking place for Swiggy, and this they've executed in less than 6 months. Bolt has surged across metros as well as tier 2 and tier 3 towns as well, and also showing a 4 to 6% higher monthly retention every month. In terms of what the management is saying about this, they're saying that Bolt is a breakthrough in terms of operational intelligence, and the delivery radius, they've limited it to 2 kilometers, and they've partnered with QSRs like KFC, McDonald's, Subway, Fasos, Burger King already. In terms of Rohit Kapoor, he commented saying that Bolt isn't just a winning on convenience, it's also delivering business impact. On the other hand, Zomato did shut its 15-minute delivery, Zomato Quick, which was launched just 4 months ago. Dipender Goyal in his shareholders letter did mention that they do not see path to profitability without compromising on customer experience, which is why they are shutting their 15-minute delivery. Currently, restaurants' density and kitchen infrastructure is not set up for a 10-minute delivery format, is what Dipender Goyal mentioned in the shareholder letter. He also said that Zomato did not see any incremental demand while it ran quick commerce, and they did not see any kind of enough ROI keeping it in place. So this is the entire scenario as to how this delivery war of 10 minutes is taking place right now.
Yeah, and no doubt, and both of those stocks in focus. Kush, quick view on both of them. The pair, Swiggy, do you have enough data on it to take a call?
Well, with whatever limited data is available, Swiggy is still an avoid. You've not seen any kind of recovery, and resistance is at every rise. So Swiggy is an avoid and eternal, as we've spoken, a couple of times now. 240 is the level to watch for. Once that level is taken out on a closing basis is when I think a new uptrend will start. Otherwise, that 200, 240 range continues.
Okay, then let me broaden the scope a little bit beyond these two stocks and ask you this. In the event that we do see a gap up, which looks likely at this stage, what would you do? What is the strategy that you would employ?
So, Alex, just before that, I think sticking to the same space as, Swiggy and Zomato, there's a lot of traction, and I mentioned this last week as well in the QSR names, and RBA and Devyani are two stocks that, we've already recommended. So, those seem to be doing well. Barbecue Nation is also starting to show some positive signs. So, I would actually be a little more constructive on the QSR space. Now, as far as the gap up opening goes, for about 70 odd points, I think this is a healthy one. If we had that 120, point opening, we'd be closer to 24,500, and the maximum call base right now is close to that level. So I wouldn't be betting on the Nifty taking that out immediately, but with about 100 points, 90, 80 odd points to go to that level, I think you could see some more upside. So if you have long positions, continue to hold on the Nifty. If you want to create, because the risk reward ratio is not too big right now, you might want to still create the long positions, but keep a smaller ticket size.
Right, so smaller ticket size is what you should be watching out for. Another aspect that we should be looking at is in terms of what's happening on the acquisitions. Two stocks, Azad Engineering, that's one that has seen an acquisition as well. 2.5% up move coming in on that one. In fact, Kush, what are charts indicating with regards to Azad Engineering?
So, so far there is consolidation. That's been the case for the last about 5 odd sessions. 200 moving average support kicking in, and on the upside 1600 level is acting as a bit of a resistance. So until that is taken out, I remain positive, but the momentum could be missing. So if you want to accumulate, perhaps in this range you can, but expect momentum beyond the 1600 mark.
Order win, and I mentioned about an acquisition. So Azad Engineering is one. Parag bhai, very quickly in terms of paint companies, taking into consideration the way crude prices are moving and valuations, your top picks?
So we don't own any paint stock in the sector because we feel that wherever there's a new entrant who is powerful, who is ready to spend a lot of money, we stay away from that space. And see, one thing which I wanted to highlight is, even if you buy a quality company, there is a risk that you might.
I'm sorry, markets have opened, so we're going to have to just come back to you on that thought, Parag bhai, as we see the first ticks this Monday morning, and it's not looking half bad, about 70 points odd up on the Nifty, a little under what the implied was showing us, but green on the screen nevertheless. Remember, we've seen a range bound few sessions, a little hesitancy there, but that seems to be easing. Nifty IT doing better than the Bank Nifty this morning, maybe following the cues that we've seen on the Nasdaq overnight. The broader markets actually looking even better than the key indices this morning. The Nifty gaining as we speak right now, but about 0.5% up there, and the mid cap also 0.5% up. Let's pull up the heat map very quickly before we get Hiral in to talk about what's happening in the broader markets. Adani ports there because of very good updates, looking strong this morning, about 2% up. Tata Motors 1.5% up, and even further expect some strength there through the day. The relief that coming in from JLR, again starting exports to the United States is important. Eminem in focus ahead of its numbers. Good set of numbers are expected. Asian Paints, the kind of plummeting that we've seen in crude, Brent below $60 a barrel, very good for an Asian Paints, and you're seeing some excitement there. Overall, the breadth looks good. Enough green on the screen to give you some, relief there. ONGC showing pain again, an offset or an offshoot of those low crude prices, which is hurting ONGC this morning. Kotak Mahindra Bank is interesting, and we should do a more detailed look at Kotak Mahindra Bank ahead on the show on what really is the pain point that we're hearing. Yeah, there was a clear miss on the top line with Kotak Mahindra Bank, but nevertheless, the rest of the parameters looked okay. Street not taking that clear miss on the top line very, very well this morning. But all in all, not a bad start to Monday at all, I would say, Hiral, with more green on the screen, and even in the broader markets where all the action is.
Absolutely, a lot of stock-specific action. Tamanna, one thing what we need to note is India VIX as well. If you see in terms of India VIX, a 2.5% up move is what you're looking at. So that is interesting because volatility is high. So that is giving you an indication as to what could be expected in terms of that consolidated move. But very quickly, if you see in terms of Nifty mid-cap and the small-cap index, let's just pull up that one on the screens. There you go. You have the mid-cap index, which is seeing gains of nearly 0.5%. And if you see the small cap index 250, which is pretty much flat. So you are seeing that little bit of outperformance that is coming in, and that's mainly because of that stock specific action that you're seeing. But let's quickly look at individual stocks as well. On the back of earnings, you have few of the FMCG names that are in focus as well. If we can just pull up those ones. Marico, volume-led double-digit revenue growth is what you've seen on that one, 4.5% up move coming in there. Avenue Supermart as well as seeing a downtick again. Missed estimates, the margins have been under pressure. City Union Bank is another one that has been in focus. The PAT has been absolutely in line. The ROAs have been stable. That is one which is seeing gains of around 4.5%. CDSL, 4.5% downtick on the back of the weakness. And Indian Bank, a strong set of numbers that Tamanna was alluding to as well. That stock is seeing gains of nearly 1%. Moving on, you have RR Cable on the back, Kabel on the back of earnings. The operational efficiency is what has led to the beat, 12.5% on that one. So that's going to be an interesting one to watch out for. And Aether, which is seeing gains of 1%, and that's mainly on the back of the turnaround that they've seen in terms of the profitability. Apart from that, if you talk about any of the other names which are in focus, you have Tatva as well as Atul. Tatva again on the back of earnings is seeing pressure. Atul on the back of the commentary is what the street is watching out for, but the pressure stock is down around 0.8%, and that probably is because the recovery to that 8,000 to 9,000 crore kind of a revenue number is going to be gradual, and that's what the screen is looking at. JSW is another one, again steel down 0.5%, so no major impact coming in on that stock today with the kind of cuts that we saw in terms of Friday's session, but there is an overhang on that one. Apollo Micro, on the back of the acquisition boost, the stock is seeing gains of nearly 3.5%. And if you talk about order wins, Ercon and Azad Engineering, two stocks which are seeing a strong hold in today's day of trade. So again, a lot of stock specific action. Markets are telling you that there is some bit of consolidation, taking into consideration the way the VIX has been moving. You're seeing Nifty 50 and the Sensex up around 0.4%. Bank Nifty is absolutely flat. So the contribution in terms of what SBI and Kotak are doing is important. HDFC Bank becomes important as well. And from here on, the day gradually probably could see some bit of profit booking at higher levels in case we land up moving higher. Tamanna and Alex.
Yeah. So here are a couple of capital market plays are catching my eye as well. CDSL down about 4% or so, and the numbers didn't look particularly good for this company. Profit decline for a second quarter in a row, and the stock is taken on the chin, 4% lower. Nuvama is another one that is losing ground, about 4% lower at this juncture. Of course, I do want to point out that RR Cable now climbing to as much as 13%, and Kush has a view on it. We'll come to him in just a bit. But before we do, I'm curious about what Parag Bhai has to say about CDSL. Did you see the numbers, Parag Bhai? And is this only a factor of the kind of uncertainty in the markets that you saw in the fourth quarter? And does that ease out once the market has an uptrend, once the volume stabilize, and all of that could come through as early as the first quarter?
Just to put a disclaimer, we don't have CDSL in our portfolio. And if you remember some time ago when I had an interview with NDTV Profit with Neeraj, I was very, very cautious about capital market plays. Because, we are at about 25,000 and euphoric mid-cap and SME and all those things were going on. So it was better to stay away from capital market plays at that time. Of course, now, as you rightly said, the sentiment has hit, the retail sentiment is hit due to the geopolitical tensions and all. And of course, last quarter was very bad. February, we saw a big fall in mid-caps and small caps. So that has hurt the sentiment. So we might consider it at a lower level. It's a great business. Of course, it's a very high ROIC business, net cash company. So we will look at it and evaluate it at some point. And just to carry on from what Tamanna was asking on oil price decline and so paint stocks doing well. So we have Pidilite in our portfolio, which is a beneficiary of oil price cut. And we feel that it is a better placed company because it does not have that kind of competition. It has a strong brand, I would say magnificent brand value. And so it will also benefit from the oil price decline, which we are seeing.
Okay,
So,
yeah.
and just to add one another thing before we close, I think within banking space, what we are seeing right now is that private sector bank side, everybody is trying to protect margins, right? For example, we saw City Union Bank result. They have protected the margins to a great extent at 3.6, and they are guiding that they'll range between 3.5 to 3.7%. Because 25% of their gold loan book is gold loan. And gold loan, of course, has a very good tailwind, of course, in terms of growth because of the higher gold price. Regulatory framework is also falling in a favor of banks like City Union and Federal, who are more compliant in terms of loan to value and all across the cycle. And most importantly, these banks have, for example, City Union Bank said on the call that gold loan business, they have shifted to fixed rate loan. So that part of the business will not affected by the rate cut, and that is not floating anymore. It is fixed. So I would say that valuation, if you see, our City Union Bank is just 1.1x with 1.5% ROA on FY27 basis. So I would say that in banks or in cement, there is a good value emerging in mid cap and small cap spaces where the businesses are done in a very well compliant and very, I would say, calibrated manner.
Yes. Point well made, Parag Bhai. And we've spoken about 3 different sectors, but I do want to talk about, at this juncture, the stock of the day, 12% plus RR Kabil on the back of numbers and also on the expansion plans that they've announced. But Kush, you looked at the numbers and perhaps that may not be sustainable. Is that what the charts are indicating?
Indeed, Alex. So, I think a bit of the expectation of the numbers was perhaps baked into the price already, because we saw a good up move over the last week or so in this. And Friday, the stock was up on back of very strong volumes, and by that I mean nearly 5 to 7 times of the average last 20-day volumes. So a lot of it was already baked. Now you're already seeing the stock come off the highs of the day. What it created at open. Also the resistance around the 1190, 1200 mark also acting up. So if you did have any positions from the lower end, it will not be a bad idea to book as much as maybe 75%, carry a little just for that momentum to kick in, if it does at all continue from here on. But I think it's a good idea to book some profits. Just a quick word on something that Hiril's emphasized enough, which is the India VIX. Yeah. Just be a little mindful of that. With the markets going up, India VIX still rising. I'm very comfortable with the VIX around the 15 to 18 zone. 18 to 20 is that caution zone. Beyond that, it could get a little overheated. Closing above 18.5, perhaps closer to 20, will perhaps set in some jitters. So I'm just being a little cautious, and I just want to put it out there that the VIX rising is not a very healthy sign. Beyond 80, it could get a little
Having
iffy.
said that, it did cool off just a tad bit from the high point today itself, right?
It's still above the 18.5 mark. Sure. The last few closings have been below that. So just being cautious on the VIX front.
Okay.
Just want to, before we go into the break, point out, pull up the Nifty Bank. Taking a tumble over there, so a bit of pain coming in on the Bank Nifty in the last few minutes as well. We're taking a very short break. We'll come back with more details on what your strategy should be ahead. Gautam Shah also joins us, founder of Goldilocks Premium. But meanwhile, Kush and Parag Thakkar, thank you so much for joining us on this leg of the conversation. We come back with a lot more analysis after this break.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Apollo ties. Now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system.
Welcome back. Watching India market open. Good start, but the challenge is going to be on whether we can hold on to the kind of gains that we've seen up top. Nifty being powered pretty much by Tata Motors, Adani Ports moving the Nifty. In fact, let's see the contributors to the Nifty before we get to our next conversation and one that we're looking forward to. Yeah, it's HDFC Bank, RIL, Infosys, the heavyweights coming in. You have IT Pack also doing fairly okay this morning. But we're speaking now with Gautam Shah, founder Goldilocks Premium Research. Gautam, always a pleasure to have you in conversation with us here on NDTV Profit, and great to speak to you once again. Let's start with how you are looking at the recovery that we've seen on the Nifty and the Bank Nifty over the last few sessions. Are you now getting a sense that the worst is behind us, or there's more pain to come?
Good morning, Tamanna. Well, it's not just the last few sessions. I mean, if you look at the last few weeks, the Nifty is up 2,700 points from the recent low. I don't think many people in the market at the starting of April would have expected this market to rally the way it has. But I think our stance has been very clear all along that this 6-month-long bear market that we saw was a digestion of the 2-year bull market, that the market witnessed, I think, which was phenomenal in every sense. I do believe that we are out of the woods. I think these are the pointers that we put out in our recent reports. And I think the momentum has looked good. The breadth has been excellent. The participation is amazing. And you have the Bank Nifty leading this entire market up. And as we speak, you actually have more and more sectors bottoming out and starting to join the party. So it could be real estate, it could be auto, it could be PSU, and even capital goods. But let's be mindful of the fact that we've rallied a lot and there are issues at the borders, which obviously people are talking about. It's not in your control, but I've always believed that the markets are the best judge of geopolitical situations. We've seen that with the Middle East last year. As of now, the price action looks quite relaxed. I know India VIX is above 18, which is a bit of a concern, but the price action itself is not too negative. And I would say that till the Nifty is above 23,800, which is now the most important support for the rest of May, I would say this is a buy on dip plan for market. So I would be constructive if the view is 3, 6, 12 months. If the view is next couple of weeks, I think this market needs a little bit of consolidation. But if you're thinking more medium term, I think near term we are heading for 24,800, and over the medium term we are heading for 25,600. So all dips are a buy. Just be in the right pockets, be in quality stocks, and stick to the large caps.
Right. So buy on dips, Gautam, is the strategy. In fact, you've been talking about being positive with regards to where financials go. 55,000 is what you indicated last time we spoke as well. Taking into consideration the kind of moves that you're seeing in the HDFC Bank versus a Kotak Mahindra today, how would you play both these stocks? Because HDFC is the one which is giving us support of around 30 points to Nifty. Kotak is the one which is taking away almost 35 points from Nifty 50 right now. What should the strategy be?
I've always believed that stocks and sectors that don't do so badly in the difficult times end up, being the best performers in the better times. And that's exactly what has happened with financial services. In fact, we've been bullish for almost 3 or 4 months. And when the index kept correcting and we hit that level of 21,800 on the Nifty. In that period, if you see SBI, ICICI Bank and SDFC Bank, they were rock steady. Thereafter, we spotted a breakout at 53,000 levels, and we very quickly come to levels of 55,000, and there are still no signs of topping out. There are no concerns of valuations, and these are companies which don't have anything to do with foreign soil. So given all of this, and given RBI's stance, which I think is so important with what the rupee has done, with what dollar index has been doing, and this aggressive stance of RBI, I think is acting as a tailwind, for this entire financial services space. So given all of this, if I have to think medium term, I think there is another 10% upside for the bank Nifty towards a level of 60,000. Near term, there could be some consolidation. If it were to lose 2-3%, I think it's very normal. But I do believe the top stocks, the top 3 names will do much bigger things going forward.
Gautam, that's the view on banks. I just want to know the view on autos as well. Eminem, Tata Motors in focus this morning, some Fada data coming in. The overall annual numbers are weak, but in two-wheelers and four-wheelers, which between the two do you prefer? And any specific view on a Tata Motors and Eminem after the moves we've already seen?
Tamanna, you and I know really well that the market follows the principle of discounting. And in today's day and age, it discounts things really fast. I mean, what's likely to happen over 6 months, the market discounts it today. I think that's the kind of market that we live in. So the auto index witnessed a very large 25% correction in a matter of 6 months. It would have typically happened over 1 year. But given the slowdown in the economy, you must have seen how FMCG and auto behaved. So the market just discounted the weakness over a period of 6 months. Now this comeback looks durable. I think it's rebounded from some very long-term supports. Tata Motors was a multi-bagger. It's corrected about 40% from the highs and now seems to be stabilizing. So I think both for FMCG, auto and IT, I think the worst is over. All these 3 sectors will gradually come back, and it's sort of an advanced indication that the economy can also get back on track. So far, the earnings season has gone off relatively okay, no major shocks, and I think the price action suggests that you're going to see more upside. So while I continue to like autos, I still feel that my favorites are still financial services, PSU and metals. I think I would bet bigger on these 3 sectors than the other names.
What about on the consumption side? You talked about FMCG and autos as well as banks, set for a better run. Let me broaden FMCG to the whole consumption basket. Anything over there that you see coming back, just moving on this theme of economy recovery?
See, consumption is already very expensive. Even now it's expensive. And I think a lot of the positives of the next few years was in the price and is still in the price. That's probably the reason I'm not betting very big on consumption. And there are still questions on the recovery of the economy. So let's not say that, okay, all is well and, things have turned around. Very early days, we need to go through the entire earnings season to actually take that call. But I do believe that in this leg of the bull market, which possibly takes the Nifty back to lifetime highs, which I think is likely sometime in the next 6 to 8 months, there will be new leaders. And I think those leaders will be in the form of metals, PSU, and financial services. So I think the old favorites of the market, which was consumption and auto and IT and capital goods, they have taken a bit of a backseat, which is not a bad place to be in.
What would be your one topic in each of these 3, which you mentioned?
In this market, I'm sticking to top quality. I mean, with what's happening globally, everything around the Trump trade, the kind of volatility that we are seeing, the geopolitical issues, I want to stick to top quality. I want to stick to the big boys in each of the sectors. I don't want to give out any specific names, that the top 3 or 4 names in financial services, the top 5 or 6 names in the PSU space, the power PSU, the defense PSUs, the infrastructure PSUs, and the entire metals basket. I think once the metals index gets past 8,700, I'm actually looking at a 15% move on the entire metals index in the next 6 to 8 months. Now that's big by all standards, because I don't see more than 8-10% upside on the Nifty and the bank Nifty.
Okay, so metals is the big call. And PSUs also is the big call, because that's a change after a while in terms of what the street has been looking at. Gautam Shah, always a pleasure. Thank you so much for speaking with us. He's founder Goldilocks Premium Research. We need to take a very, very short break, but we're coming right back. Action-packed morning here on India Market Open. Don't go anywhere. Up ahead, we're talking about Godrej Properties.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity.
Welcome back. You're watching India Market Open. Now, real estate company Godrej Properties, that's a stock to focus on, and this is on the back of the way earnings have panned out. The stock is down almost 0.8%. My colleague Anushi is standing by to give us more. Anushi, if you could take us through the key highlights in terms of the quarter and what is anticipated going ahead in terms of the outlook.
Okay, well, thanks for that, Hiral. Now, we did see Godrej Property reporting its numbers in market hours on Friday. Quickly walking through some of the numbers that we've seen. If you look at the bookings, they were up around 7%. They beat the FY25 guidance of 27,000 crore. They did report a robust growth in terms of the collections are. That's why we've also seen an improvement in terms of the operating cash flows for the fourth quarter. Now, if you look at the business development, they have maintained the same guidance as last year, that is at the 20,000 crore mark that we are looking at, in spite of seeing about a 26,000 plus crore of a growth of a number in FY25. So that is one number that we should be watching out for. Delivery guidance was something that the street had focused on. This was after the company had revised its FY26 delivery guidance lower at 10 million square feet as compared to 18.4 million square feet in FY25. However, if you talk about the launch guidance, they had exceeded that by 22%, and collection guidance was exceeded by 14%. So overall, it's a strong FY26 outlook that we are going to be seeing. And FY25, we have seen a beat across all the key metrics that are there. Quickly walking through the Q4 FY25 numbers as well, revenue was up around 49%, while margins stood at 5.18% as compared to 8.6%. So this was the overall picture that we have seen for Godrej Properties for the fourth quarter and the outlook for FY26.
All right. Let's listen into that conversation with Gaurav Pandey, MD and CEO at Godrej Properties.
First, let's talk about the quarter that went by, and then we'll get into what the outlook is for FY26. But can you break things down for us in terms of the booking value as well as the volume growth that you witnessed in the fourth quarter?
I think we had a fantastic quarter four. I mean, just to give you a bit of a context, we had an amazing head start in Q1. We've had the best ever quarter one, and then quarter two and quarter three, because approval delays were reasonably fine, but we had an amazing comeback in quarter four. We sold about more than 10,000 crore worth of homes, which is the highest ever sold by us till date. It became a best ever quarter. And through that, I think we had a stellar year. We managed to do a booking value of about 29,000. 444 crore, which is like a 31% Y-on-Y growth. And if you see from a volume growth point of view, also it's about 29%. So we had a frankly very stellar year thanks to Q4.
Okay. Now, the bookings apparently are on a strong trajectory. You just pointed that out. What is the expectation heading to the new year? Considering that you've outperformed in this year, have you revised upward certain targets? Where do they stand right now?
I think if you take a step back, we're looking from a very stable, consistent growth. Our guidance to the market for FY25, the year gone by, was about 27,000 crores. And we were looking at, from a guidance perspective, we should have continued growth, so about 20% over a last year guidance, which means we would be looking something like a 32,500 crores sort of a guidance. And our endeavor is that we want to do it consistently, outperform our guidance. From a collections metric, because this is a business where cash flow plays a huge important role, we did a fantastic last financial year. We did about 17,000 odd crores, close to about 49% Y-on-Y growth. And our guidance for this metric was about 15,000 crores. So our endeavor this FY26 is to do about 21,000 crores from a collection point of view. So not only from a sales perspective, we want to have robust growth, but even on cash flows perspective, we want to have a very strong trajectory.
Okay, but the number for sales growth, where does that, where have you penciled that in?
32,500 crores.
Got it, understood. Okay. When I look at the business development guidance, that is, if I'm not mistaken, at 20,000 crore rupees. Is that correct? And if it is, then it is the same as last year. Considering that you achieved the target for last year, I believe, in the third quarter, why is this not being penciled higher?
I would be very frank on the business development guidance. We have when we give guidance to the market, it's very, very conservative. And this is the only metric we don't get extremely driven by. It's more market opportunity relevant. I mean, with some degree of confidence, we can easily beat this. But yes, we don't want to guide the market that we are driven by this metric, because finally we want to see prudent deals, because we have got enough and more inventory thanks to the wonderful acquisitions we did in the last 2 to 3 years. We have more than 50,000 crores worth of inventory readily available for us for the growth perspective. The reason for adding more BD is to take the S curve even more stronger. So yes, idea was that we would like to add good quality projects and we would look to have something like a 20,000 crores worth of revenue potential added in. But there is no reason we will not beat it, and there's no reason we have to really be driven by this metric.
Understood. I'm trying to understand how you're seeing the trends play out with regard to pricing as well, Mr. Pandey, because we're speaking at a time when there have already been a couple of rate cuts. There's likely to be another one in June if things go as they are expected. What is the expectation in the circles that you operate primarily in? What is the kind of increase that we're seeing?
I'll be very frank and candid. I've always believed that interest rate sensitivity to things which is slightly upper mid income to premium plus and sub luxury is not very, very high. Having said that, it has an indirect impact because it improves the overall sentiment to the market. It also creates a huge boost to the economy in general because the capex cycle tends to pick up, which through a domino effect definitely positively impacts real estate sector. So I feel that this is a good trigger for the sector to continued growth, but I'm not overreading into this as the only metric. I'm saying that overall the sector is more driven by the state of economy. And if you see the commentary the government has been doing and the steps the government has taken are very positive, especially the last 4 to 5 months. So monetary policy is a subset of the overall measures that either the fiscal side action we are saying or the monetary side. So I think a combination of this should lead to good volume growth. From a price growth perspective, I think it will be very market specific. So I feel there are some markets which have not at all taken off from the potential revenue per se. I see those micro markets within different geographies or different cities will see a very good uptake. But yes, there are certain markets which have already seen a very strong price growth. There I would say the price growth will be more nominal.
Okay, that's the word coming in from Godrej Properties. Stock under a bit of pressure this morning, but what's in focus are banking stocks. Now, interesting note out from BofA on banks, and they've given a call on a variety of banks. So I'll just take you through that very quickly. This is what BofA is saying on Axis Bank. Their stance is neutral. They've gone from buy they've gone neutral from a buy. They've cut the target price to 1300 versus 1350. IDFC First, meanwhile, is a buy as well. It's an upgrade for IDFC First, so that's important. They've hiked the target price from 65 rupees to 80 rupees. For RBL, it's an upgrade to a buy. They've hiked the target price to 235 from 175. And for AU Small Finance Bank, it's an upgrade to a buy, and they've hiked the target price quite significantly from a 630 to 800 rupees. So why is this? They're saying these are the banks benefiting from the rate cut cycle. It's a favorable balance sheet mix for these particular banks. They see the scope for PE multiples to re-rate more than 20%. On Axis Bank, meanwhile, there's a downgrade because they say valuations continue to trade at a discount to peers. Re-rating likely delayed as growth performance is going to remain soft. ROAs also to come under pressure from the rate cut cycle. But the bank that we should be talking about is Kotak Mahindra Bank. I just want to pull up the stock. So the top line was a pain, but overall the rest of the numbers didn't look that bad. Stock is down 5% now. Harsh, what is worrying the street?
Well, I'm going to try and highlight 5 things which possibly is worrying the street. First off, with regard to loan growth, Kotak has always guided that they will do 1.5x to 2x of industry growth. They've not done that this year. They've done just 14% YOY, likely because of headwinds, but not really justifiable. Likely, that's how the street is interpreting it. The second piece is credit cost. You've seen a bit of a spike with regard to that. Microfinance within their portfolio not doing as well. So that's the other one. The third piece is no growth in core operating profit. So while there's a soft number with regard to advances as well as net interest income growth, core operating profit also very, very soft in that sense. You want that to grow probably through other income and other levers, but that's not happening either. The stock price has outperformed over the year-to-date period. It's gone up 22% as of close on Friday, and therefore that's the other reason why you're seeing upgrades when it comes to target prices set by brokerages, but downgrades when it comes to the stance. So it's fascinating, that piece, and we'll put some of those out. So first off, with regard to CLSA, downgrade to hold from outperform. Target price up to 2,225. Nuvama as well, JM Financial as well. So all of those seeing hikes with regard to target prices, but a cut with regard to how they are positioning themselves in terms of their stance. Maybe a couple of those factors playing out.
Okay, that could be where the pain point is as far as Kotak Mahindra Bank is concerned, but definitely a 5% knock is a huge one there. Meanwhile, State Bank of India has also released its Q4 results over the weekend. Looking ahead, the State Bank of India has said that it has a substantial corporate loan book pipeline of 3.4 lakh crore rupees. Listen in to what the chairman C.S. Setty had to say in his conversation with us.
You highlighted a 3.4 lakh crore pipeline for corporate loans on your book at this point in time. Just a couple of days ago, the Reserve Bank of India put out a survey of companies, of private sector companies, which talked about a decline in the confidence on capex by these companies. I wanted to get your view. I mean, 3.4 lakh crore is a very good number, but in terms of overall outlook, are you seeing that maybe companies are still a little hesitant, or they're a little scared after the recent global turmoil that you talked about, the tariff uncertainties? Do you see any of that?
So much of the pipeline, what we have been seeing for the last 2 years, has been coming mainly from the renewables, a bit of power, thermal power, data centers, roads. What we have not seen is major investments coming from the private core sector.
Okay.
In the core, if you really talk about steel, cement, we haven't seen any major announcements. Steel particularly, I think people believe that the global uncertainties, the fear of dumping by China, all these things are weighing. That probably one of the reasons why the RBI survey indicates the lower confidence level. But certain segments continue to attract the investments, and that is where the pipeline for us is emerging. It is a fact that the core sector is yet to take the plunge in terms of capital expansion and capital expansion programs.
Okay.
So I think the tariff confusion also is probably adding to, though it is not going to really majorly impact India, but the investment decisions, particularly in the core sector, are getting delayed.
So that's the management of SBI, clearly indicating what's the trajectory looking like going ahead. But moving on and staying with the auto pack today, Tata Motors, as Tamanna was mentioning, is an interesting one to watch out for. But now, fresh from acquiring a majority stake in SML Isuzu, Eminem is set out to come out with their fourth quarter numbers today. Let's actually head across to Puneet. The stock is up almost 1.5%. Puneet, if you could help us understand what is on the cards, because the street is seeming pretty excited.
Well, definitely, it's expected to be a very strong quarter for Eminem on a standalone basis for the auto as well as the tractor business. The company is expected to report a 20% growth in revenues, coming in at roughly 30,024 crores. Its EBITDA margin is also expected to rise by roughly 160 basis points to come in at 14%, with the subsequent growth in net profit also at 22%. Almost close to 2,490 crores is expected in terms of net income. Now, that has of course been aided because of very strong sales growth. In this particular quarter, we've seen sales rising by 18% for the passenger car business, coming in at 1.49 lakh units in this particular quarter, and that's roughly averaging 50,000 units, something that was almost half just 3 to 4 years ago. So it's been a very strong jump for the company, led by its models. Even on the tractor sides, it's actually seen a higher growth of 23% in this particular quarter, coming in at 88,000 odd units, and at a time where most of India is not growing the tractor space, the western side is growing, and Eminem has a 50% market share there. The biggest update in this particular quarter was also post that the company had acquired SML Isuzu 58.96% stake for roughly about 555 crores. And what was interesting is they had acquired this stake from the promoters as well as Isuzu Japan, which is the public promoter, for roughly just 650 rupees per share. Before the acquisition, it traded between 1500 to 1700 on the NSE. So definitely it was an acquisition bought at a very great price for the company. They will launch an open offer at 1554 rupees per share. But there'll be three key things I want to know from this result as well. They've continued their growth momentum in the month of April, 28% growth. If that sustains going forward, the second key thing will be the outlook for the passenger vehicle side, because now they have a very high base of sales growth in FY25. And finally, how has been the, in case of, the integration of SML Isuzu, what are they looking at with the entry also in the electric vehicles through SML Isuzu? Those will be some of the things to watch out for, but definitely a positive result expected for Eminem today.
Okay, so Eminem in focus, and definitely it's looking positive. Thank you for that very comprehensive outline there from Puneet. We'll take a very short break. We're staying with auto because on the other side we're speaking with Rakesh Sharma, Executive Director at Bajaj Auto, on their April sales numbers. So all of that and more when we come back.
That's huge. That is a biggie. It's on.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Welcome back. You're watching India Market Open and steady as she goes. Nifty now over 0.5% up, 151 points up over the 24,500 mark and boosted by the big ones, HDFC Bank, Infosys, all the heavyweights coming through for the Nifty. Nifty IT is the star of the day really, and we should bring in the components of the Nifty IT if we can. Because that's where it's all moving, persistent, emphasis, TCS, all good. Global factors setting up for a good run on the Nifty IT. Bank Nifty a little shaky, dragged down by Kotak Mahindra Bank. That the street has not liked those numbers at all, and really nothing clear in a take on State Bank of India. But on the overall strategy, I thought this important note from Morgan Stanley that I should put out for you, where Rhythm Desai has put out this note. He says India will outperform a global bear market but underperform the bull market. So very balanced way to look at it. He goes on to say global uncertainty provides opportunity to buy India's long-term story, believes rewards will come in time, will require patience given potential for bad news from outside India. Domestic cyclicals are better than defensives in his view, and external facing sectors. He's overweight on financials, consumer discretionary and industrials, underweight on energy, materials, utilities and healthcare. Says this is likely a stock pickers market versus one driven by top down or macro factors, and we are capitalization agnostic. So that's the word coming in from Rhythm Desai. You've got the BofA graphics on your screen, so I'll go through that as well. This is what BofA is saying. They're saying Q4 earnings are better than expected. Nifty's 61% market cap is done, tracking 3% beat so far. Nifty earnings are up 9% Y-on-Y, led by financial staples, which have been muted. Similarly, NSE 200 is tracking a 4% beat on earnings. Nifty has seen EPS downgrades of 2 to 3% for FY 26-27, and earning growth for FY 26 is seen as 13% growth. So pretty good on the results. But many factors to watch this morning, including Bajaj Auto and their sales numbers for April, which were down 6%, but commercial vehicle sales were up 3%. Puneet is quickly putting that together for us before we get to the conversation with the management.
Two-wheeler sales for Bajaj Auto has been slowing down. It's a trend that's visible in the domestic focus peers, but there are like a couple of things just wanted to know from the management. One is the motorcycle sales slowing compared to the scooter sales, because we've seen an outperformance from scooter sales in this particular time, as well as what is the management's outlook for the next year. They had guided for 6 to 8% growth in FY25. Does that still sustain in FY26? And finally, in terms of exports, the growth for April was just 4%. Africa, a market is coming back, which is a major export destination for Bajaj. Does the growth persist in this particular area because of the lower base in FY25? So those are the three things I would want to know for Bajaj Auto.
Thank you, Puneet. Rakesh Sharma joining in this morning, Executive Director at Bajaj Auto. Mr. Sharma, very good morning. Tamanna here. Glad to speak with you. as always. Let's talk about how April has fared. The numbers on the face of it show some signs of weakness. Is this because of a tightness in finance, or how are you looking at the whole month?
Good morning. Actually, the numbers show a weakness both for the industry and for us, largely because of the base effect. We have now entered an important mini season period, which is, marriages in the north, and this constitutes about 45% of the market which gets affected. So it's a substantial chunk. Now, last year, all the marriages were bunched in April, so we had a very good April, both for the industry and for the individual companies. And this year, the marriages are evenly spread right across April, May, and June. And therefore, an April comparison with last year's April doesn't tell us much. We, to understand the market and our own relative performance, we are looking at how April has performed sequentially. Going from March into April. And there is some good news over there. I think there is an uptick in the industry. And the uptick is almost 16 to 17% over March. If you recall, the Q4 performance of industry has been choppy. Numbers were like -3, -4%. That is the performance of the industry. And therefore, it was important to see how April starts to shape up Q1. And April has gone off pretty well. Things have improved over March, and we would rather look at that comparison.
Fair enough. The marriage season may have skewed factors for the month of April. But what about the financing capabilities or the finance which is available to customers? That has squeezed over the system. Are you seeing the impact of that even going forward?
No, we are not seeing that impact at all. I think that impact is felt in parts of the industry which had sort of overreached on finance and taken bigger risks. And now what we're seeing is pulling back. So a lot of our financing, almost 70%, is from our captive finance company, which has followed very even policies 6 months back, 3 months back, and currently. And we are not seeing any issues around that. We are aware that the risk has to be assessed very carefully, and the captive finance company, which is Bajaj Auto Credit Limited, is doing that. But I wouldn't say that our sales have got hampered because of BACL tightening any credit norms.
Right. Rakesh, that's an interesting point to make, because the read on the street was that probably Bajaj also would be one of the companies that would be impacted by the same, but that's a good clarification coming in there. We've discussed about the domestic part of the business. When you talk about exports, yes, you've seen 4% growth. However, it's lower than the peers and Bajaj Auto's historic average as well. So what is the aspect on that front? What is causing concerns? And is this a one-off?
Yeah, again, it's a base effect. I would say that going forward, we should be delivering the double-digit growth which we have been doing in the last few months. And I would say that, about 10 to 15% growth year-on-year basis is certainly visible.
Okay. And which are the markets where you think recovery could be faster? Because always when you talk about a Bajaj Auto, the moment there is weakness in the domestic market, you always have the exports which come to the rescue, and vice versa. The strategy just plays well for you. So this time around, when there is weakness across exports and domestic, which segments will be the green shoots in the coming quarters?
No, but first of all, let me clarify. I just said that I'm not seeing any weakness in the export market. We have been growing at about 14 to 15%. This is a one-off because of a base effect. And hopefully in the next few months, we should be in that zone of growth. Yes, we would like the overseas markets, particularly Africa, to pick up. They have been at a certain plateau. And there is a bit of an overhang of all that is going around in the world on tariffs and making currencies a bit jittery, holding back purchases, etc. So Latin America is also seeing a little bit of plateau, but Asia is coming back rather smartly. So all in all, I would say 10 to 15% growth is visible for us, which is in keeping with our trends in the last few months.
Enough. Mr. Sharma, let's get into a little bit of detail on what's happening industry-wise and where Bajaj Auto is standing in comparison. Because if I look at growth over the last, if I take November 2024 and look since then, industry-wise, growth has been petering down for the two-wheeler segment as a whole. If I were to compare or ask you to look at how Bajaj Auto is doing relatively, are you feeling the same pain points? And within that context, are you seeing an uptick going forward in demand? Because you're looking at this broader rural recovery story. I'm wondering what your take on that is.
Well, last year was about 5 to 6% growth for the industry. And this was led by the top half. However, the growth is not secular across the months and quarters. What we have found is that there are wide variations in growth. Quarter 1 last year was double digits. Then quarter 2 sank a little bit. Quarter 3, because of October, was 16, 17%. And quarter 4, like I just said, was -3, -4%. So it's been choppy. We think that going forward, the industry should clock about 6% growth, because the recent past indicates that that is what is going to probably unfold. However, again, I don't think that the growth is going to be very evenly distributed. We will have to navigate some sharp peaks and troughs. That's the nature of consumer behavior also. In parts, it is fueled by consumer behavior, which is waiting for festives and occasions to buy and things like that. The structure of the demand will also continue as it has been, which is the top half, which is the 125cc plus segment, should be growing at almost twice the rate of the 100cc segment. That has happened for quite a few quarters, 2 years almost, and we think that that is going to continue. So yes, about 6% growth led by the top half, but choppy. Each quarter will have to be dealt with on its own merit.
Oh, that's fine, but are you seeing two-wheelers pick up further? Are you seeing more focus on commercial vehicles? If you can just give us some color, what are you seeing happening with the EV space of it?
What I told you just now is all about motorcycles. So my comments were motorcycles, not about two-wheelers and three-wheelers.
Okay. So let's get into some more detailing on two-wheelers and three-wheelers, and what is the direction that you're seeing there?
Well, like I just said, we think that motorcycles should grow at 6%, but it might be choppy in the sense that every quarter will have to be dealt with its own merit. Within the motorcycles, the 125cc plus segment should grow at twice the rate of the 100cc segment. That is what our presumption is, and we are basing our forward plans on this hypothesis.
Right. So Rakesh, right to say, okay, domestic will be pretty much in line with what we saw in terms of FY25. Exports, we should start seeing that 1.6 lakh to 1.7 lakh kind of a number back again. And 3, from an EV perspective, how does it stand? Because I think this month there has been some bit of pressure in terms of market share. Bajaj has come down to peers. So how are you seeing that cycle play out?
In EV?
Yes.
Three-wheeler EV? Actually, I don't know where you're getting your numbers
from. No, not three-wheelers, two-wheelers.
Yeah, two-wheelers, EV, I think, is again doing pretty well. Despite a cut in subsidy, it is grown quite handsomely, and its march continues. I think we will see EV scooters grow at about 20 to 25%. Almost 25% of ICE scooters are now EVs, and there are many states which are under-penetrated still. So we are very, very positive about this. And in terms of performance, I think the top 3 players are within 700 units or 0.5 to 0.8% market share. And this is after, most of the companies, we were the first ones to pass on the part of the subsidy withdrawal. Most of the others followed by middle of the month. And so it's very good to see that EVs are holding up. And we are particularly also delighted is because one big change which has happened in our case is that we've launched the 3.5 series, which is a higher end series, where because of which, this business has now gone from the red zone into the green zone for us. Overall, almost 20 to 25% of our domestic revenues are now coming from EVs, which is scooters and three-wheelers.
I think that's where the growth story is going to be as well. But thank you, Rakesh, so much for joining us on the show and sharing the view. So that's the management of Bajaj Auto. If you see in terms of what the stock is doing in trade right now, 0.6% higher. Let's just pull up a 1-year chart as well, because there has been pressure. Let's deal with that fact as well. There you go. I mean, from the highs, it's actually crumbled down. 13 to 14% is the kind of cuts that you're seeing on the counter. And Tamanna, what's interesting over here is domestic, the kind of slowdown that you're seeing, no recovery that is expected. So that's telling you something. Expecting a flat number in terms of FY26.
Yeah.
Exports, what Rakesh is saying is will improve. So probably that 1 point, and that's just the hypothesis that they're looking at. 1.6 lakh units to 1.7 lakh units is what they will get back to after seeing a 1.2, 1.3 right now. EV, it's interesting. The top 3 players are still juggling. Ola, which was at the top, TVS has come to the top this month, right?
TVS is the interesting
And TVS in terms of earnings also has given out a spectacular show, because if you see a 5-day or a 1-month chart of TVS Motors, that is telling you the story that TVS Motors is looking at right now. Today as well, 1.8% is the kind of up move that you're seeing in terms of TVS Motors. So it's an absolute interesting play when you're looking at the two-wheeler space between Ola, TVS, Bajaj Auto, Hero Moto, and Eicher that comes in from the premium segment as well. So that's going to be one space that we should be looking at pretty closely. But moving on, AMI Organics, that's an interesting counter, because this chemical space has been on the back burner. Though earnings have been good, but now you have a Kotak Securities which has gone ahead and initiated a buy on AMI Organics. My colleague Varsha is standing by to tell us more. Varsha, if you could help us understand, what is Kotak Securities talking about in terms of AMI? They are bullish in terms of the stance. What have they done in terms of the target price as well?
Yes, thank you for that. So yes, they've initiated a buy coverage with a target price of rupees 1,450. Now what they're saying is, now basically the whole premise of AMI or giving a buy recommendation for AMI Organics is the CDMO sector, which is itself growing at a double digit. What they're saying is AMI is set for a strong growth story and healthy visibility into rapid growth ahead. And the growth drivers for AMI Organics include scale up of the pharma CDMO sector and specialty chemical business that they are going into. So basically they make intermediates which is used in your pharma and agrochemicals. They are expecting 30 to 35% CAGR in revenues and EPS over FY25 and 30. And what they're saying is the key risk that includes to this initiation is tariff roadblocks, regulatory challenges and execution missteps. But the overall story for AMI Organics is CDMO sector. Even in their Q4 FY25 numbers, they have beaten the estimates, they've beaten revenue and profit estimates. And in fact, they were expecting 30 to 35% for FY25 growth, which they have beaten. And the management has given a new guidance for FY26. They are expecting 20 to 25% growth on the back of CDMO and good recovery in pharma intermediates. And that's one of the reasons why Kotak has given initiation.
Okay, AMI Organics in focus as well this morning. I think what's interesting to see, Hiral, is how you have markets largely steady except the bank Nifty. And that was the big bet. That is the bank. You talk about any brokerage house, any analyst, they're all talking about the bank Nifty right now and how banks and financials is going to be in focus. But the key results that we've seen, and I want to pull up SBI and I want to pull up Kotak Mahindra Bank once again, where they have not really fired as per expectations. Even in SBI, about 2% down, because even though the profitability number was fine, it was led by non-core income that has actually pushed it up. Kotak Mahindra Bank, on the other hand, looking fairly dismal, nearly 6% down right now. So banks is the only outlier. I'm wondering if you can pull up that sectoral heat map very quickly, because that will give you a sense of what has worked and what has not. The sectoral heat map, these are of course internals of the bank Nifty, where IDFC First is the only one holding up. But if you look at the sectoral heat map, you will see that it's the banks which are flailing, banks and reality, that are overall looking weak this morning. Meanwhile, oil and gas doing well, because crude prices, of course, is something which is giving some support to the market. In the broader indices also, we should just take a look at what really is working and what is not this morning. And it's the Adani pack that's doing fairly well. Look at Adani Total, Adani End. Of course, standard disclaimers here. Adani Ports, also Adani Power, that entire pack doing well today. Green energy, all of the stocks on that pack seeing an up move in trade. Interglobe also, the crude impact is something that you should keep in mind, and we should get a report up on Marico actually. Good set of numbers there, and you covered it this morning as well. Marico is the other one that's working. You also have crude impact as one big factor. That's why I want to pull up Interglobe Aviation for a second. I want to pull up Asian Paints as well. So that is where you're seeing some positive impact, and IOC also working out. So is a Berger Paint. So you have that entire crude impact basket, which is also up in the green. So is Indian Bank, for that matter. Harsh, comparatively, Indian Bank is the one that's looking decent, with a bit of a question mark of what happens to the recoveries from Bhushan Power.
Well, yes, absolutely. You're bang on. Just in terms of the numbers, first off, a very decent set, 6% growth on the NII front. But really, it was the operating OPEX, subdued OPEX number, which has led to the operating profit being, seeing a good expansion, 17% YOY OPEX expansion. And then thereafter, your credit costs, which are in any case quite subdued on the back of healthy recoveries. Profit after tax has seen a solid jump of 30+%. So that is what is driving the ROA of around 1.3 odd %. Bhushan Steel, of course, is the one key overhang, and maybe some of those angles, is something that we need to have conversation with management about.
Right, that is going to be an interesting one to watch out for in terms of the exposure. But thank you, Harsh, for getting us the details. In fact, let's connect with Binod Kumar, MD and CEO at Indian Bank, to understand more in terms of what he thinks of the quarter. Welcome to the show, Mr. Kumar. I mean, firstly, the numbers have somewhere missed estimates. Have they met your internal expectations, though?
Our growth, if I talk of the growth has been, we missed the guidance, but that is on primarily, if I talk of on the deposit side, against a guidance of 8 to 10%, we have grown at around 7%. But that is a conscious call, because we have been able to raise resources through alternate sources like green finance. We have been able to, some green deposit, infrastructure bond, we have been able to raise around 10,000 crore of infrastructure bond, and also we have been able to take some refinance around 10,000 crore. So because of that, consciously we have not grown on the bulk side, because cost of deposit was there. We have maintained at 1.04 lakh crore was on at the end of the March 24, which is at flat level 1.06 lakh crore at the end of the financial year 2025. On the advance side, corporate book grew at 10%, and that was the primary reason. Otherwise, in RAM sector, we have grown by 13.7%. So growth has been good in RAM sector. And corporate, we have taken conscious call, and we have said credit, low yielding credit of around 10 to 12,000 crore. Because of that, our growth has been, muted. But that was a conscious call.
Okay, so that was a conscious call where you said that you would miss the guidance in terms of growth, taking a few of the parameters into consideration. But if you have to look at FY26 now, What is the growth outlook looking like? Do you think you could do better, or would it be in line with what FY25 has been?
Guidance I am giving for the FY25-26, deposit in the range of same 8 to 10%, advance in the range of 10 to 12%. We are seeing some good traction in the corporate side, which we missed last year because of the conscious decision we have taken to set some of the corporate loans. We are seeing some good demand in the renewable energy side. Infrastructure also we are seeing good demand, and we expect there will be good government spending in the infrastructure this side. So infra will be one sector. Then EV also we are seeing some good traction. Smart metering, and also we are seeing some good demand in the LRD sector.
Right. So are you expecting asset quality to improve further, and what are provisions looking like?
Asset quality, if I talk of, we came to 3.09% and gross NPA, and net NPA 0.20. So I think it is healthy number, and I am giving guidance of less than 3% for the next financial year of gross NPA, and net NPA will be maintaining around 0.20 or 0.19. Provision coverage ratio also we are at 98.10%, and that is healthy number. We will be happy to maintain this level of 98.10%. And one good thing, SMA stress in the book. Our SMA book, which used to be around 15.59% for the at the end of the financial year 24, has come down to 8.06% at the end of the financial year 2025. Some good initiative we have taken, and that has resulted in good numbers in SMA.
Right. Moving ahead, one of the key things, Mr. Kumar, we need to talk about is the Bhushan Steel case right now. Now that JSPL, overall, if you think about it, is the Supreme Court verdict has come in, which is negative. What is the update on that from a recovery perspective?
So we are waiting for the detail of the order. As and when it comes, we'll see. But that should not be too negative for the bank. Reason being, we have got, around 40%. As a consortium, banks has got around 40% out of the Bhushan Steel. And now it is up and running. So if at all it happens, I take it as a positive. Recovery percentage may go up rather. Of course, that may take time. And let us wait how it pans out. But my view is net it should not be very negative.
Okay, so what is the total exposure now?
No, it is not in our book now. It has already through NCLT, it has been resolved. So at the time of resolution, our outstanding book outstanding was around 2,600 crore. Which through NCLT around 40% recovery was there, and remaining amount we have already been it has already been retained now.
Right. Very lastly, how are you expecting the margin trajectory going ahead?
Net interest margin, if you see even sequentially, it has come down around by 6 basis points because of the repo rate cut of 50 basis points. And my book around 40% is linked to external benchmark, which we immediately passed on to the customers. So going forward also, I think there may be some few rate cuts. So presently, from present level of 3.47, I am giving guidance of in the range of 3.15 to 3.30 for the next financial year.
So, right, that's with regards to the net interest margin guidance going ahead. But thank you, Mr. Kumar, so much for speaking to us at NDTV Profit. The stock seeing some smart gains in today's day of trade, but completely out of time. With that, it's a wrap on this edition of India Market Open. To get your queries answered, log in next to Ask Profit. Lots more lined up, and Alex and Mahima will get all your queries answered with the experts. Stay tuned to NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Welcome to NDTV Profits, a very special conversation we have with us DPAM Secretary Arunish Chawla, who is leading the government, disinvestment and asset monetization initiative. Welcome to NDTV Profits, sir, and thank you for speaking with us. I would like to begin with asking you that how's the disinvestment pipeline look like in the current financial year, and given the uncertainty and market volatility, how you are planning in terms of big IPOs in the current financial year?
I should first tell you that we manage assets, not obsessions. We have done away with fixed disinvestment targets. And that is because we have adopted a composite value creation strategy. And this strategy rests on 4 pillars. 1, good corporate performance. 2, fair dividends to minority stakeholders. 3, CapEx as per the budgetary targets. And 4, a calibrated disinvestment. The calibrated disinvestment could either be in the form of IPOs, it could be in the form of OFS, it could be in the form of qualified institutional placements, or it could be in the form of strategic sales.
Mm-hmm.
What strategy we adopt for which particular public stock depends on market conditions, our own in-house research, which we call the Deepam model. And of course, our requirements to place valuable public assets to share them with ordinary investors. It is Honorable Prime Minister's and Honorable Finance Minister's vision that we should share the value of our public enterprises and public stocks with the ordinary households. And we are implementing it in letter and spirit.
Understood, sir. And I totally understand that, you may not able to give the big IPO plans at least, but could you please share the number of, disinvestment candidates which we could see government is, going for strategic sale? At least if you could share some number.
We did an OFS right in the first week of April. And that was from our defense portfolio, the Mazagon Docks Limited. We have an aim, a target, in fact, a moral strategy to share 25%, at least 25% of every major public stock with the people of India. In addition to that, as you know, we also decided to list one of the biggest financial institutions in the country, which is the LIC. And we have already disinvested 3.5%. And the SEBI, the regulator, has given us time till March 27 to bring it down to 90%. As you know, it's a very large portfolio. The market cap of LIC is now almost 4 to 5 lakh crores. And depending on how the markets evolve and depending on what the market research, the Deepam market research throws up, we would be bringing up with calibrated offers for sale. And through you, I must tell the viewers and the market participants, those who observe and take part in the markets, that public stocks are not in unlimited supply. As and when conditions are right, we will bring them through OFS and other mechanisms in the market. And we will give good discounts so that ordinary investors can partake in them. And as you know, the market investment is now fairly diversified. Ordinary households, ordinary investors, senior citizens, and now even housewives are investing in the stock market. We are grateful for the faith they have reposed in us. And we hope to live up to their expectations.
You mentioned two important, OSS. One is the latest one, which is Mazagon. The second one is LIC. On the LIC, I'll come a bit later. But on the Mazagon OFS, sir, when are you planning to sell the remaining 5% stake? Is there any timeline to it?
Keep watching the market news and keep watching the Deepam official. There is a Twitter handle that we have, which is Secretary Deepam. It's an official Deepam handle. And we give all the market news, the relevant market news and our offerings there well in time before they come on the market. So be on the lookout and don't miss the opportunity.
Of course, we track that, sir, regularly, in fact. But I wanted to understand whether the current market situation is conducive enough to come up with, more, OFS. And on the LIC point, I would like to ask that in 2022, the LIC listing happened. A lot of road shows, government has done. Do you think that this is the time to, offload some more stake in LIC?
Count on us to surprise you. Those who are in this business know there is a difference between macro and micro shocks. We manage a public stock portfolio of 40 lakh crores. That's a huge responsibility. The common mistake we make is that when the mood is down, nothing can happen. As you know, in first week April, we surprised everyone because the moods, it was Trumpian. That was the macro mood.
Mm-hmm.
But our own in-house research, which we now call the Deepam model, showed us that there are certain stocks which are holding on, and they are good hedge stocks.
Mm.
And in general, public stocks, because they give very good dividends and they follow a sustainable capex strategy,
Mm-hmm.
they are very good hedge stocks for anyone's portfolio.
Mm.
And if you follow it's up to you. You know, the dividend is in the hands of the investor. If you want to consume it, you consume it. If you put it in a growth portfolio,
Mm-hmm.
it will mitigate any macro shock in the market
Mm-hmm.
and will hold it up. And that is exactly what we will do. As you know, we track things very carefully.
Mm-hmm.
We have a very efficient, a large team of market researchers.
Mm.
And through them, we will be regularly coming up with OFSs of public sector stocks. They will be small in number because we are aware of the liquidity conditions in the market, what the markets can absorb. And we would always keep the interest of small investor in mind and always keep an opportunity for that.
My question remains, is there any timeline for LIC? Do we see some movement this year?
No asset manager gives out timeline strategy in the market.
Mm-hmm.
But as I mentioned and I reiterate, we will give every announcement well in advance to the market participants
Mm-hmm.
through the official Deepam handle.
Mm-hmm.
So please be on lookout for that.
Sure, sir. One, the public sector bank, which everybody is talking about, the IDBI bank, and the entire disinvestment has been, in works for last 2.5 years. Now, I know that it making its progress there. I wanted to understand, is there any change of stance, given the current external headwind situation, given the situation we are in where things are not, predictable, and waiting for more announcement from the US side in terms of trade negotiation, etc. Is there a wait and watch mode approach at this point of time when it comes to IDBI disinvestment?
IDBI disinvestment is on track. Government has taken a decision. It is publicly announced that we will strategically disinvest 30% of government stake and 30% of LIC stake to a strategic investor through a fair and open process. It's a complex, multi-stage, multi-layered process. We are working day and night and taking it forward. The data room has been established. The due diligence is being done. The share purchase agreement is being negotiated. And as it moves on, you will get the fair, correct news at an appropriate time. And I must emphasize that such decisions are not affected by macro shocks in the market.
Okay.
This is determined by a fairly well-calibrated, well-sequenced disinvestment strategy. And we are committed to implementing the government decision transparently and expeditiously.
But sometimes, just for understanding, macro shocks like, external headwinds, the tariff uncertainty, do have an impact on the valuation.
Yes.
Are you concerned about that?
Both yes and no. You see, what happens is if you approach the markets with a trader's mindset, then you are obsessed with long and short positions. But if you believe in the markets with an investor's mindset, and you are there for the medium and long term, then you know how to ride over these shocks and ride through them. And a fair dividend strategy achieves precisely that. It is to give comfort to small investors that your returns will come no matter what the market conditions are, what the shocks are. And I would urge all fund managers, I would urge all those who have demat accounts, all those who are small investors, to always put some public stocks in your portfolio. It will help you. It will give you a consistent, sustainable, fair flow of dividend incomes. It will make you a participant in the value creation strategy of public enterprises, in their capex plans, which we monitor very, very carefully and rather aggressively. So, you have reposed your faith in us, and we are appreciative and careful about that.
Well, you have been quite vocal in terms of fair dividend policy, particularly from the private corporation. You had some meeting also. Did you raise this issue with private sector? And what is the response so far? And also, do you think that they are not doing enough?
I'll clarify. This is moral suasion. We are not imposing any regulation on the private sector. When we do market research, and we did a comprehensive round of that research over the last 1 month, when, the closing of the March, and we found that we compared the public sector stocks that we manage with the Nifty 50 corporates. The public sector stocks now form 10% of the market cap in India. And as you know, the Indian stock market is now third largest in the world after US and China. And this 10% of the stock or the paid 25% of dividends on the market. Right? And when we compared it to Nifty 50, we found that in terms of dividend strategy, if I may use a technical term, they both first and second order stochastically dominated the Nifty 50. And that is why we just give a fair message that we should all follow a fair dividend strategy on the market. This will make our markets a better place for the Aam Aadmi.
I'm sure, sir, with your approach and, you've been talking to private companies, I'm sure that will get reflected in the dividend as well. Moving to the MTNL issue, sir, here, the debt, which is there, a huge debt, in fact. And recently, government approved the asset monetization. But considering the big land parcel of MTNL, is it a struggle to, monetize those assets? How are you going about it?
Good question. We have set up a National Land Monetization Corporation. It has now been staffed. It has a new CEO. We recently approved a land monetization matrix, which is a strategy to move forward with monetization of these assets in an organized way, so that MTNL can quickly dispose of its assets. Sometimes it may not be an outright sale, it may be another asset monetization strategy. But things are moving, and you will see results during the course of the year.
Okay. You think that you will see some progress in this fiscal year itself?
Absolutely.
Sure, sir. So recently, government has invited bids on, on minority stake sale in the public sector banks. What is the status of that? Did you receive, any bids, and how are you going about it? When we could see that this is coming? Have you appointed anybody? What is the status there?
I'm happy to tell you that we received a very enthusiastic response. And the leading merchant bankers in India have applied for it. They include both Indian and multinational merchant bankers. The big names that you know of and can think of, I would not name them.
Okay.
And also the big, all prominent legal firms have applied for it. We have evaluated their submissions. We have taken their presentations, we have empaneled them, and you will see that we will move ahead in accordance with our announcement.
Out of curiosity, why the, oversight required, while selling the minority stake in the PSB? What is the trigger behind it? And if you could also mind sharing what all, what all the companies are where you're looking at, selling stakes, the minority stakes of government?
As I mentioned, it is government policy, and that at least 25% of stakes of our large public enterprises should be shared with minority stakeholders.
Yes.
These are called minimum public shareholding norms. And as part of that strategy, Honorable Finance Minister reviews it very regularly. And as part of that strategy, we had given out this RFP that wherever we are above the minimum public shareholding norm,
yes,
we should bring it down to the 75% level. It achieves the twin objective. On one hand, the public wealth is shared with the people of India. And on the other hand, it disciplines that particular public enterprise because it is subject to market discipline.
So in that case, I wanted to also understand about the minimum public shareholding. As you rightly mentioned, the deadline is coming. It's in August. How many CPSEs you think will meet the deadline in August, and whether is there a consideration on the extending the deadline in case if some of them are not meeting them?
Most of the PSEs have already met the 75% level. They have been brought below that. A few more which are going to be taken up during the year. Individually, we've already extended the time required to some to next year and some to the year next, depending on how large the stake sale is being offered. And you will see that this year we will regularly offer stake sales through fair public pre-announcements, well-warned, well-announced, and this will go into the next year as well.
So the additional question for LIC particularly, the deadline is actually FY27. So because you get 3 years after listing, so you think by the time the deadline comes, LIC would be able to offload 10% of the stake, which is required?
I can assure you, we do our homework well. We will not sell anything in distress. We will sell these stocks in an evenly paced manner, in small installments that liquidity in the market can live with throughout this period. So, as I said again, watch out for Deepam Official.
Thank you so much, sir, for sharing your insights and observation on all the important disinvestment candidates. Appreciate your time, sir. Thank you for speaking with us.
Thank you very much.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations of European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims?
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew. With me is Mahima Vajrajani, and we'll take you through next 35 minutes of trade. We're starting a little late today for obvious reasons. If you were tuned in, you watched the interview with the DIPAM secretary talking about the prospects for disinvestment going forward. Let's also take you through how the markets are looking right now. It's looking decent. And you have gains of about 0.6%, about 150 points on the benchmark Nifty 50. And well, you are at the high point of the day today, more or less. And the broader market's looking better, if anything. You have the mid-cap index that's gaining about 1% or so. And you have the small-cap index that's up about 0.8% or thereabouts. And it's looking like a decent start to trade. Let's also take a look at the advance decline ratio just to drive home that point. I won't be surprised. There you go. So it's a widening, if anything, of the advances and more advances than declines. But let's also pull up the Nifty 50 heat map just to drive home what is working and what is not. And you have Adani Enterprises, if I'm not mistaken, that is doing quite well in trade today. You have Trent that is up and about as well, gaining about 3.7% or thereabouts. You have Adani Ports that is doing quite well, up about 5%, billing on the gains from last week. And this is a stock that has gained quite considerably, about 15+% over the past month or so. Reliance Industries also up and about in trade and doing quite well. By the way, Reliance Industries up about 19%. In fact, let's pull up that 1 month chart for Reliance Industries, and it is lending quite a bit of support to the benchmark, 18.5%, 19% over the last 1 month, playing catch up, so to speak. The banking index, though, is underperforming in trade today, understandably so. It's gained quite considerable in the recent past. It is losing about 0.2%. Quickly pull up the contributors and you will notice that State Bank of India is lagging just a tad bit, and so is Kotak Mahindra Bank on the back of its numbers. Not too satisfied with the Q4 numbers is the street. What is gaining? IDFC First as well as Fed Bank and HDFC Bank about 1% as well. We've got Mahesh Ojha as well as Gaurav Sharma joining us this morning. Thank you so much, gentlemen, for taking the time. Gaurav, I'll come to you first. Just on a very quick technical check and how you would play this. Would you buy at this juncture, go long, or would you hold your horses considering everything that's happening? Of course, we're reacting to what's happening overseas as well. Risk on seems to be the mood.
Yes, good morning. Good morning to all the viewers. Firstly, market is holding ground. Yes, Bank Nifty is underperforming. Despite that, Nifty index is performing pretty well. So, from where I see it, that the markets are likely to test 24,800 mark going forward. So, till the point 24,200 is held, we will suggest short-term traders to look for buying opportunities. And there are some bit of good buying opportunities being witnessed every now and then. So yes, overall we are keeping our view on the buy side, still maintaining a cautious view considering the ongoing rift between India with the bordering nation, and it can just crop up anytime and no one would get a clue of it. So what we are trying to say is our stop loss is 24,200 and we are long with it, looking for targets close to 24,800 in the near term.
That's the view with regards to where technicals are concerned for the Nifty 50. Let's dig in and start with the first query. Satyan is writing in and he has ITD cementation at an average price of 120. He's been a long-term investor in this counter and he says that this is a part of his core portfolio. Wants to know as to what is the fundamental view for this and wants to know the target, if possible, for the next 24 to 30 odd months. Mahesh, a very good morning to you. I'll come to you on this one. What's the view like for ITD cementation?
Good morning. So I think he can hold further from a 12-month to 18-month horizon. I think upside could be 580 to 600 plus level could become in ITD cement. So from my perspective, he can hold further.
Okay, so that's the view like for ITD cementation where fundamentals are concerned, of course. Our next caller, Suresh, is calling in from Hyderabad. Suresh, a very good morning to you. How can we help you?
Hi, very good morning. Just wanted to know, Bajaj Industries fall from its previous high to 50%. So, for long-term outlook, is it right time to take an entry in Bajaj Industries for 1 to 2 years?
Okay.
Both technical and fundamental. Entry point which I need, and can we take an entry on that?
Okay, got your point, Suresh. I'll take this up with Gaurav. Gaurav, do you think the charts are attractive enough right now to make an entry in Bajaj Industries?
Little risky as of now because the stock has been beaten down too much, lot more than what it was expected. Currently trading below its important support levels. So it is better to wait for some time, let the stock consolidate around these levels and surpass 500 mark. Then I think it will be a better opportunity to look for some kind of a buy position for a medium or even a long-term perspective.
All right. So that's the view on Bajaj Industries. By the way, since it was mentioned, I think we should address it as well. The earnings came through not too long back, and I think the stock reacted negatively, very sharply so, to the Q4 numbers. So, Mahesh, if you have coverage, what did you make of the numbers, and would you hold your horses or would you deploy based on the fundamentals?
From price perspective, we are optimistic in buying in lower level. I think a 425 to 440 range could be a good buy from a price perspective. I think we are not looking for a 1 or 2 quarter, but yes, we are optimistic for some upside. That could be a 570 to 575 range. So in lower 425 to 445 range is, I think, attractive level to buy.
So no, but not for the next quarter or two. Bear that in mind, Suresh, when you're thinking about the fundamentals. And in any case, I think you pointed out that you have a 1 to 2 year time horizon, so that should be fine. MediAssist is the name of the counter that we're talking about. next. And this is a question from Siddharth, who's writing in from Kolkata. He's in a loss, but not a very substantial one. He's bought at levels of 468. The stock is currently at 437. He's got a quantity of 95. He's got a long-term outlook, and he's wondering whether this is a stock to hold for the long term, or should he switch to another one? Mahesh, on the fundamentals, what's your opinion?
I think he should switch the same, because we are not covering much. Stock is not looking good from a longer term perspective. I think he can switch in another stocks like Apollo Hospital and other things. So where they can make at least some money.
So that's the view with regards to where Medi Assist stands. Our next question is on Bajaj Finance. Vivek Pratap from Delhi is writing in. He's holding 750 shares of Bajaj Finance, bought at 4,200. 2 to 3 years back is when he bought it. And he's a long-term investor, and he wants to know as to what should be the outlook for this particular counter. He's sitting on a significant profit of 36 lakhs rupees right now. Mahesh, I'll again come to you on this particular counter. What's the view like? The company did come out with its earnings in terms of brokerages. They did downgrade the counter. The earnings in terms of the overall earnings was a thumbs down, because there was a negative bias on the numbers, and the commentary coming in was also not very attractive. FY26 guidance, if I'm not wrong, was cut by the company. And there was also a bonus plus stock split. Lots happening with the counter. What's the view like?
I think 50% profit could be booked here, and the rest can be hold for a longer term perspective, because not looking much more upside. But yes, 9,700, 9,800 could be a level where I think a stock could be capped. But yes, 50% profit could be a booking is a good idea from in these levels.
Let's go to our next caller. We've got KS Babu, who's calling us from Visakhapatnam. Hi, Mr. Babu. Thanks so much for calling us. How can we help you today? Mr. Babu, can you hear me? Okay, just as we were going to listen to Mr. Babu, he's lost the line, but let me go ahead and take his question in any case. He's got Cochin Shipyard, a stock that has been in focus in the recent past, bought at levels of 2,597, and he's still in a loss because he's bought at very elevated levels. I don't know what his time horizon is. He could have told me that, but then on the charts, let me go across to Gaurav on what he makes of Cochin Shipyard and the recent move and the run up. Should he hold on? Elevated levels, as I pointed out, 2,597.
It's better to hold Cochin Shipyard. It is a good stock. Things are in favorable. I think the ongoing, the war type of situation is a blessing in disguise for the defense sector. And Cochin Shipyard is one of the major suppliers of maritime to the Indian Navy. So it is better to hold on considering the higher levels. So I think it should be at least 1 to 1.5 years of journey that the viewer will have to hold. Give it some time and it will perform.
Okay, so that's the view with regards to where technicals stand for Cochin Shipyard. We have two questions coming in on Ease My Trip. The first question is from Mahendra Raj, who's writing in from Jaipur. He's purchased 5,100 shares, bought at 13 rupees a piece. Is that correct? Yes. And he needs an advice from a longer term perspective. The second question is also with regards to where Ease My Trip stands. And since this is a long-term question, Mahesh, I'll come to you. Any view with regards to Ease My Trip?
I think he can hold further from a longer-term perspective. I think some upside could be come in stocks, like a 16 to 70 level could come in stocks. But yes, keep stick stop loss near 10.50 rupees and try to hold.
Quickly, Gaurav, your view with respect to where technicals are concerned, because Ajit bought at the levels of 21 rupees, so he is also sitting on a significant loss right now. What's the view like? Should they continue to hold Ease My Trip?
The stock is not looking attractive. All the highs have been sold off. The stock has not been able to sustain at any of its recent peaks. So these are not good signs. Since he is already in a loss, so I'd suggest just to hold on to it and utilize a recent bounce. If it gets somewhere close to 13.50, better to start offloading the positions.
Okay. All right. Neva from Chennai has got the next question. Ratan India Enterprises is the name of the counter. 72 is a buy price. Neva would like to know the fundamental view and whether the stock can bounce back from the current levels of 42 or thereabouts. Mahesh, coverage on the fundamentals. If so, would you buy? Would you hold on?
The fundamental, if you're looking on fundamentals, that some quite we are looking for if you're looking for a longer term horizon, I think a 75-80 level could be come. But yes, you need to hold more than 1 year. I think 1 to 2 quarter is not giving you full chance. So I think he can hold further. But yes, your horizon could be more than 12 months. So I think 80-85 level could become easily.
Okay, our next caller, Harish, is calling in from Visakhapatnam. Harish, a very good morning to you. How can we help you?
Good morning, madam.
Good morning. Go ahead with the query.
I'm having 800 shares for Reliance at the rate of 1231.
Okay.
Can I sell the shares?
Okay. Got your point, Harish. I believe you want a long-term view on this particular counter. Am I correct?
Yes.
Okay. I'll take this up with Mahesh. Mahesh, he's sitting.
But before you do that, I want to know, Harish, why do you want to sell the shares? Do you have an urgent need for money?
Because the RSI graph reached to 79%.
Say that again, sir.
RSI graph was at 79.
Oh, understood. So you think that it's in overbought zone. But Harish, when did you buy this stock?
Around 4 months back.
Okay, and you bought it for a perspective of less than 1 year?
Huh?
You bought it.
Pardon?
You bought it with the intention of holding for less than 1 year?
More than 1 year.
More than 1 year.
Long term.
Long term.
Okay, interesting. So
But it is again cumulative, na? That's why I am asking.
Okay. Okay, got your point, Harish. I'll take this up with Mahesh. Mahesh, in terms of the earnings, numbers were largely in line. In terms of the oil business, margins did contract, and this was led by the oil and gas business. In terms of Jio, well, the growth was on account of higher subscriber addition. Retail, they're going through a restructuring. What's the view like? He wants to know whether he should continue to hold or sell the shares right now. He's sitting on a profit of 1.6 lakh rupees, by the way.
Firstly, I'd like to giving disclaimer because we have recently given the Reliance industry advice to our clients on a before the exact result. So I think first giving disclaimer. If you're looking on a result basis, then if you see the results, that all the sectors are giving some participation in Reliance industry. And some other things are giving some positive signal on Reliance Industries. So stock is performing good. But recently we have seen some rally from a lower level. So I think some consolidation can't deny on these level. That could be near with 1360 to 1420 level in some consolidation. But if you are looking for a longer term horizon, I think 1550 to 1575 level could become in 12-month horizon. So if your horizon is a longer term, then you can hold. From a shorter term perspective, you may see some consolidation. Consolidation can't be denied.
Okay. So since it's Reliance Industries we're talking about, I did market at the start as well. What's your view on this one, Gaurav? He has pointed to the RSI. And I don't know whether that makes a lot of sense to look at if you're buying for the long term. Of course, the Nifty 50 also RSI above 50, about 70, right? So therefore, one could argue that both the index as well as the stock are in overbought zone. But it is, if anything, making a comeback and playing catch up with the rest of the large cap space. So would you hold for higher levels?
See, first of all, I'll just explain the viewers what RSI indicates.
Yes.
RSI is an indication of relative strength index, whether at current levels the stock is having the strength and the momentum to continue, or it has started losing its momentum. RSI above 80 mark, as the viewer and the shareholder of this particular position said that it is into the overbought territory. He rightly mentioned that because trading somewhere around 80 odd levels is the overbought territory. Having said that, a stock or index can continue trading higher in an overbought territory for a much longer time as well. Stocks in long terms remain overbought for a very large period and continue their performance. So this should not be the sole indicator while considering whether we should book it or not. Now coming on to the levels front. Reliance Industries has achieved its short-term targets that we were expecting, that is 1435 today itself. So from a technical standpoint and from a medium-term perspective, it is better he should consider and take some profits off the table. Hold the remaining one for the next targets, which is probably close to 1500, 1550 odd levels in the coming 6 months.
Okay, so that's the view with regards to where charts are concerned for Reliance Industries. Okay, our next caller, Murli, is calling in from Bengaluru. Murli, a very good morning to you. How can we help you?
A very good morning to you, and thank you for taking up my query.
Our pleasure.
I got Indian Bank,
Okay.
1,000 shares at the rate of 580.63. 580.63.
Okay.
Currently, the results have come on Friday or Saturday. It is excellent results with the highest ever dividend.
Right.
Should I hold to avail the dividend, or if it goes up to cover my dividend plus my investment, should I sell, because public sector banks are always slow movers? And the SBI has expressed the concern about credit growth, risk credit growth in 26-27 financial year.
Okay.
25-26 financial year.
Got it. Got it. Okay, got your query, Murli. I'll take this up with Mahesh. Mahesh, I hope you've understood his question. And, clubbing his question with the entire banking space, now that a lot of earnings have come out from the entire banking space, what's the view like?
I think from a Indian bank perspective, if you are looking on the numbers, that numbers are very good from all parameters. I think from NPA perspective, if you are looking from a net interest margin perspective, numbers are good, pretty good. So I think he can hold further. And if you're looking on a dividend, that is 16.50 rupees. So from both perspective, if you are holding the stocks, so we can see some more journey. If you are looking at stock journey from a 2021, then it could be in near 140 level. From that level, we have seen some upside continues. So I think stock has a more potential from a result perspective. I think 650 level could be come in near term also. So he can hold further. Dividend is quite good, and stock bank is good, doing perfectly. From other banking perspective, if you're looking on number basis financials, so I think the number are good. And we have seen yesterday also, we have seen SBI number, Kotak number. In Kotak, we have seen some number are not in line with expectation. Rest, if you are looking on SBI number was good. But SBI is down due to concern of they want to raise the fund from QIP, FPO. So that is the concern in SBI. So stock is not moving higher. But yes, numbers are pretty from a SBI perspective also. We are optimistic for some more upside in banking. And if you're looking from a RBI perspective, RBI is giving more liquidity to banks, and all the things are positive for banking sector. But we have seen recently a lot of journey from a lower level in banking, in bank Nifty also. So some consolidation could become in these level, and that could be healthy for a longer term. So I think in the overall banking sector, if you're looking, I think we are all optimistic for more upside. But yes, some consolidation can be done on these levels.
All right. So that's the comprehensive view on Indian Bank as well as on the banking space. Indian Bank, by the way, doing particularly well on the back of its numbers that it reported over the weekend. Let's take the next question on Shakti Pumps. And Gaurav, this one's for you. And we've got Lokesh who's tuned in, who's asking for the next 6 months or less, whether you would buy at this current juncture and where would you place the target and stop loss?
Yeah, Shakti Pump is well placed at current levels. Currently, just trading above its 200-day exponential moving average mark, which is providing the needing support for the stock. So I would recommend that he should keep a closing stop loss at 800, wait for some time. That the time period is 6 months, as he is mentioning. So I think he should comfortably be in a position of 1050 to 1100 should be the levels that he should be eyeing at.
Okay. All right. So that's the view on Shakti Pumps. Hopefully that answers your question. We've got our next caller from Hyderabad. Govind is calling us. Also on the banking pack. And Govind, hi, good morning. How can we help you today?
Hi, Alex, sir. Good morning, sir. Good morning to all of you. Yeah, sir. Actually, regarding this Karur Vysya Bank, sir. I can add some more at this price, sir, for long-term prospects, 2 to 3 years, sir.
Okay, so you bought at levels.
I can invest at least another 5 lakhs, sir.
Understood.
I can plan.
Understood. So you bought at levels of 220 and you want to know whether you add more to your position. You've got quite a big holding as well, 2000, right? So let me.
What is the fundamental reason?
Got it. Mahesh, you've already spoken about the banking space, so perhaps restricted to Karur Vysya Bank. Within that context, would you add more to this particular bank or something else?
No, he can add fundamentally if you're looking on a Karur Vysya, that is also good. If you're looking on the chart also, if you're looking on the numbers also, I think Karur Vysya is good. If your horizon is 1 year, we can see 250, 260 level. And if you want to add in lower level, that could be a nearby 195 to 205 zone there. That could be a good idea for accumulate more on that level. From these level, we are not suggesting for add, but in lower, yes, if anyone get nearby 195 to 205 zone, there could be add. From a 1 year perspective, 250 to 260 level could become.
Okay, so that's with regards to where Karur Vysya Bank stands. Our next question is on Inox Wind. Somik from Kolkata is writing in. He's bought 21 odd shares at 169 a piece, and he's looking at the stock from a longer term perspective. Should I add more at the current price is his question. I'll take this up with you, Gaurav, first, because I want to understand if the charts are attractive enough right now to average out. His buying price is at 169.
Yes, the stock is well placed. These are good attractive levels. He should consider averaging the stock. And if he is taking a view which is anywhere above 6 months, so he should look for targets that are close to 220, 230 levels are pretty much possible.
All right, Raju is calling us from Andhra Pradesh. Hi, Raju. How can we help you today? Good morning, Raju. Can you go ahead with your question?
Yes, I am having HFCL shares, 200,
right,
at the rate of 150. So now 14,000 rupees I am on loss.
Right.
So what can I do now?
What is the time frame that you had in mind when you bought it, Raju? And did you buy it for the long term?
It's a long term only. But since 6 months I am seeing that it's not coming up.
Right.
So I want to know what's the real scenario.
I got it. Okay, so you need to know whether to have patience and to hold on. Raju, I'm going to take your question with Mahesh. Mahesh, HFCL coverage, do you have, and would you hold on to this? What are the fundamentals looking like?
Not a specific coverage, but yes, on these levels, we are not suggesting for sell HFCL. I think many clients have stuck in these stocks. So if a stock is started some more upside, then we can see 110 to 125 level. But yes, currently stock can see some more consolidation. Breakout could be lead 110 to 125 level. There he should try to exit on the same. But yes, not advisable for accumulation on these areas. So if your horizon 12 months, you can hold. Wait some more time. We can see 110 to 125 level, I think.
Okay, so that's with regards to where HFCL stands. Our next query is from BV Nayak, and Major BV Nayak in fact, and he's holding 250 odd shares of Tata Motors and wants to know if we should add more at the current levels or not. He's a long-term investor and also wants to understand whether he should continue to hold his current holding or not. The stock is up 1.5% today as we speak. Mahesh, I'll come to you on this one. What's the view like for Tata Motors?
See, if you are looking on an auto sector, if you look on Tata Motors specific, P is quite reasonable and management is quite good. So numbers which we have seen that was not in line for a market expectation, that could be a reason for a lower consolidation. If any downside, if you are looking on nearby 610 to 630 range, that could be a good idea to add in a small tranches. But yes, in longer term perspective, some target could be a lower from an earlier one. So I think a 775, 780 zone could be, if your horizon is a 1 year, then that target could be keep in mind.
Okay, so that's the view with regards to where Tata Motors stands, and Alex was mentioning earlier as well that JLR has now started exports back to US. Okay, so that's with regards to where Tata Motors stands. Our next caller, Dipendra, is calling in from Haryana. Dipendra, very good morning to you. How can we help you?
Yeah, good morning, ma'am. Good morning, the entire panel. My query is regarding the Tata Technology shares. I bought 1,000 shares at 670.
Okay.
My hold expectation between 3 to 6 months. What should I expect?
Okay, got your point, Dipendra. I'll take this up with Gaurav. Gaurav, what are the charts indicating for Tata Technologies?
First of all, it is quite a weak chart, but he has purchased at a good level. That is just about 7 odd rupees higher from where it is trading. So I would suggest him, first of all, he should maintain a closing stop loss at 600 for this stock, and he can expect somewhat target close to 750 in the time frame that he is looking for.
Okay. All right. Capital market players have been under a little bit of pressure. CDSL, one of them. I wonder what BSE is doing in trade today. We've got Kashyap calling us from Andhra Pradesh about BSE. He's bought at levels of 467. Wow. Kashyap, what an acquisition price, and when did you buy this?
Yeah, good morning, Mr.
Good
Alex.
morning.
Good morning.
Good morning.
Yeah, actually, I acquired this in 2023, March 9th. That day, I bought 55 shares of BSE. Now it is trading around 6,400, 460 rupees, right?
Yeah, yes.
Yeah, my confusion, my question, my request for guidance is, BSE is going to announce bonus shares. So, what should I do? Can I accept and continue? My time frame is, I can wait another 3 years.
Okay. So then why wouldn't you accept the bonus issue if you got 3-year time frame?
Yeah, that's why I'm asking. Is it? I want to book. I want to sell and book the profit. And buy freshly, or can I continue accepting bonus shares? Stay another 3 years. That is the only confusion and my question, my guidance. I require your guidance.
Okay, so are you asking from the perspective of the tax angle, or is it on the fundamentals?
No. Okay, can I continue in this accepting bonus shares? Can I continue, or can I sell and book profit? And if his price is down, can I re-enter again?
Okay. I got your question.
Yes.
All right. Because after the bonus share, there'll be an adjustment of the price should you buy at that point. All right, I got your question. But do bear in mind that once a bonus is issued on a certain amount of your shares, you will have capital gains. On the rest of it, you will have capital losses. So the net off happens after that, right? So, but on the fundamentals, let me ask Mahesh, what do you make of this? Would you hold on? He's been rewarded handsomely for his patience.
Firstly, I like to congratulate to him for holding for such a long-term period. If you're looking on a fundamentals, I think stock is quite expensive from my perspective or a fundamental perspective. But yes, BSE kind of stock where horizon is more than 2 year, 3 year, that could be a much more potential to hold from these levels also. Some parts are profit booking. If you like to book, then you can book and re-enter in lower level if any chance given. But a downside could be limited as per a stock pattern. Downside could be limited. So I think if your horizon is 2 to 3 years, then you can hold for that.
Yeah, just bear in mind, booking your capital gains at this juncture would not really make sense, because if you have the intention of buying it again, why would you do that? You would effectively have your fresh shares that are issued and you would start at scratch, and you would lose a certain amount of value on the stocks that you hold right now. So net, you would not really gain or lose anything. Let's take the next question. It's on, I believe it is on Airtel. Okay, so we've got a viewer, Abin, who's writing in from Mumbai, who's bought from when it was levels of 718, and he's continued to buy upwards, and he's wondering whether to book some profits at this juncture. I know that a lot of international investors are also looking at this very closely, Gaurav, and deploying. We spoke to somebody, Matt Orton, this morning as well, and Airtel is on his list. So assuming that you have more buying interest come through, would you hold on?
Airtel is on my buying list as well, and this is probably the best share one can have and a must hold in a portfolio. I suggest that he should continue to hold on to his position, because when we look at other telecom players, it is listed players. So it is Jio, which is in combination not solely available. Idea which we are not suggesting. So it narrows down to Bharti Airtel only. So I think it is a must to have.
All right, so that's the view on Bharti Airtel, and hopefully that answers your question, Abhin. We have run out of time, unfortunately, on today's program. Mahesh as well as Gaurav, thanks so much for taking the time. Pleasure speaking with you. Of course, today's was a little bit of a curtailed session, but tomorrow, hopefully we'll have the entire program. And of course, if you missed out your question today, you can always log in the evening at 7 p.m. 7 p.m. Is that it? 7 p.m. All right, 7 p.m. is when you have the evening edition of Ask Profit. Up next is Know Your Company, so do stay tuned.
That's huge. That is a biggie. It's out.
Gold Plus Clear Glass. Far ho ya near, sab kuch dikhe clear.
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Hello and welcome. We are in the thick of earnings, and in between all of those, we're going to try to squeeze in SBFC Finance. Now it's interesting because it's an NBFC firstly. It trades at around 3 times price to book. And when it comes to the ROA and the credit cost, it's held up very, very well. Even in terms of growth guidance, there's been no concern as of now. And that's why in this cycle, this one becomes very interesting to understand. Let's first understand as to what I want to really look for when I'm trying to analyze this one. Can the credit cost and asset quality sustain? currently NBFCs are seeing pressure, a lot of them, with regard to asset quality. This one is not seeing too much pressure. Even in terms of credit cost, you're not seeing too much of that impact coming on the P&L, and therefore can that sustain, because that will lead to likely better growth outcomes. And that's probably my second point here, to try and understand whether there's a downside risk to that 5 to 7% QOQ growth guidance. So very, very strong growth guidance. Can that really sustain is my second question. My third question is with regard to increase in leverage, and why I say this is because the capital adequacy of SBFC is at 35%, which means that it has a sizable amount of equity within that capital base that it has and that it disburses from, and therefore it has good bandwidth to take on borrowings onto its balance sheet and reduce its capital adequacy to grow. So they will now likely start using more and more of borrowing, which they've already been doing. But as they do that, their capital adequacy will come down, but their interest cost will go up, and therefore their margins will come down. And therefore in such businesses, better to look at spread than margins. But as the margins squeeze, does the ROA, which is the return on assets, which is a measure of profitability, does that also come down? So that is the other piece that I want to look at. And last off, cost efficiencies. Its cost to income has come down from 50% to 40%. And therefore, what you're seeing is a better profitability, which is coming through. Can that continue, and to what extent? So we'll try and bring out all of these points when we have a chat with the management. But that's the first piece of it, what I want to know. Now I'll come to the fact as to what the company does, because that's what we do on KYC. We try and break this company down. We'll first start off with what the company does. It was incorporated in January of 2008. It was incorporated as MAPE Finserv Private Limited, renamed to Small Business Fincred India Private Limited on the 3rd of July 2017, and then called SBFC Finance Private Limited from the 24th of October 2019. It converted into a public limited company on 30th of September 2022, and thereafter listed on exchanges on the 16th of August 2023. It raised around 1,000 crore worth of capital, and it is co-promoted by Clermont Group and Upwood Group. Now, in terms of product, it includes MSME loans, secured MSME loans, and gold loans. So loan against gold and secured MSME. Understanding is 100% of the book is secured. We'll obviously get better perspective as to what the risk could be in case of default. How long does it take for them to liquidate some of these assets, if at all there is a default? It also offers, and this is where it becomes interesting, loan management services to third-party financial institutions, particularly in Tier 2 and Tier 3 cities. It's known to have a good process in terms of loan disbursement and loan collections, and it leverages on those. It operates through 205 branches. Branch count has increased by just about 10 or 15, so around a 7%, 8% kind of branch count growth over the last year or so. And it has around 4,294 employees in 16 states and union territories. So good, large presence as well that it has. In terms of its key milestones and what it really likes to boast about, one is it first off acquired Kavi's lending book at 845 crore. That was what happened. Now on top of that, it also had between 2017 and 19 adopted the phygital model, which is combining technology with in-person customer service. They in no way continue to push digital only. They are very much physical plus digital. They converted to a public limited company for their IPO, of course, and they listed in August of 2023. The IPO price was 54 rupees a share. They listed at a 44% premium. And currently, the stock price sits at around a 25%, or has given 25% returns from the listing price as well. So decent amount of returns as well that the stock has given. But let's quickly look at the key metrics, and what we'll try to break down in terms of giving the KYC rating that we do on this one. We'll start off with the income statement. We'll thereafter look at the balance sheet, the operating metrics. We'll look at asset quality. We'll also look at the shareholding pattern thereafter. We'll look at valuations, street cred, and street coverage, which we generally always do. So broadly, that's how we'll try and cover all the bases. I'm going to first start off with income statement as we do. And, it's a fairly healthy setup here. You look at the way in which your net interest income has gone up. It's gone up from 250 crore in FY22 to 777 crore in FY25. Very, very strong growth on that net interest income number. Also, the NII has grown faster than the AUM, which is again a very healthy sign. Provisions are up around 27% at a compounded rate, and profit after tax is up a very solid 74%. OPEX, as I did mention, is one of those reasons why your profit after tax has seen a bit of a surge, along with scale and economies of scale playing out with regard to the business. But that's how the numbers stack up. A clear thumbs up with regard to how the income statement has shaped up. The balance sheet last 3 years, very similar, strong balance sheet that we've seen. AUM has gone up from 3,100 odd crore to 8,700 odd crore, which is a 40% growth YOY, and compounded for 3 years. That's very, very strong. Look at the capital adequacy. It's gone up because of that fundraise that they had in the middle of 2023. So that has led to an increase in capital adequacy. Currently sits at 36%. Again, very healthy capital adequacy. Now let's look at operational metrics, and this is where some of the details start to come through. So you had ROAs which were sub 4% prior to listing, which is FY23. Thereafter, it crept up to above 4% and continues to go up. Can it sustain is the question again. Margins, which were at around 9.5%, have gone up to 10.2%. I did mention that you could see a margin shrink because interest costs could go up. We'll quiz management on that, but that's a risk, and therefore we've given this a neutral, whether that ROA number can sustain or not. Spreads have also gone up from 7.5% to around 8.5%. OPEX to assets has come off sharply, and we spoke about this as well. OPEX to assets has come down from 5.5% to 4.65%. Whether this can continue to shrink and how much scope is there for that will be one of those questions which will likely determine how ROA shapes up in that second row. So that will hold the key. But that's how the operational metrics setup is. We've given this on neutral, and of course we'll quiz management on how this plays out. But let's look at asset quality. And this holds the key from a perspective that you look at the stability on that, 2.6, 2.4, 2.7. So you're seeing very little variation in that sense, at least over the last 3 years. You're not seeing some major concern there. And you look at net NPAs as well, and that is also fairly robust, 1.6, 1.4, 1.5. That's how it's played out. You look at the last 3 quarters journey as well, 2.7, 2.7, 2.74 on the GNPA count, and on the net NPA count 1.6, 1.6, 1.5. So fairly steady in that sense, but not necessarily a space where asset quality will continue to remain steady. You want to continue to watch out for this metric. Don't have a very large history with regard to this one, so you want to wait and watch. A neutral on this count because you want to be conservative where asset quality is concerned. Shareholding pattern. Now, in terms of how that has evolved, look at promoter holding 53 to 54 odd percent, fairly steady in that sense. FIs hold around 5 to 6 odd percent, 6.5 odd percent. So yes, DIs hold around 17.5 to 17.5ish percent, and the public shareholding is roughly 22 to 23 odd percent. That is how some of the shareholding has evolved. We've seen a bit of inch up in terms of FII holding over the last quarter or two maybe. And within the DIIs, you have SBI Small Cap Fund which is featuring, and you have AB Sun Life Fund which is also featuring. with regard to this one. You also have Franklin India Smaller Companies Fund, which also features. Among public holding, again, very interesting, you have an Amansa, which holds around 3.8%, but has been very, very mildly reducing its shareholding by around 0.01%. And you have Aseem Dhru, who's the MD and CEO. Again, interesting, because Aseem Dhru is ex-HDFC Bank, the current MD CEO of SBFC, who holds around 3% in the company. And then you have Malabar India as well, among others, which holds around 2%. So you have some interesting shareholders as well within this basket. And a thumbs up with regard to this one. Mind you, the market cap on an SBFC is 11,000 crores. So something to keep in mind in terms of the shareholding and how much of the market cap gets derived from some of these promoters and how much do they own. But let's look at valuations now. And we've kind of compared this to a Manappuram from a perspective that it gives you some flavor with regard to gold lending. But gold lending is a very, very small composition of the overall loans of SBFC. It currently trades at 3 times 1 year forward price to book, which is certainly not cheap by any standard. Credit Access is a pure play MFI, which trades at around 2.2 times, but it has its set of asset quality issues. So again, may not be the best comparable in that sense, but we'll give it a neutral with regard to where valuations is concerned, not the cheapest on the street. Let's look at street cred. And in that sense, it's done okay when you're looking at the street credentials. Again, since listing, it's not given a significant return from the listing price. So if a shareholder had bought at IPO, they've made decent amount of money. But post-listing, we're not seeing a very substantial rally in the stock price. Just about a 25% fair return. And for a small cap, that's still quite decent, given the way in which some of the small cap indices, or rather the benchmark, has done. Let's look at street coverage now. Last off, you have 4 buy calls, 1 hold call, 1 sell call with a potential 15% return. Surely a thumbs up with regard to that. You have a decentish kind of coverage and a decentish kind of return expectation on this one. But that being said, let's quickly move on. It's time when we go across and speak with the management. We have Mahesh Dayani, who is the Executive Director at SBFC, joining us right away. Mahesh, good speaking with you. Thanks for coming in. I want to first talk about the fact that what are you seeing on asset quality trends, and what are you seeing with regard to how your asset quality is evolving at this juncture? Because several NBFCs are facing asset quality headwinds at this point. Your book looks relatively okay. Talk to us about that.
So I think you'll have to differentiate between various asset classes. So you've got largely secured and unsecured, and the conversation is largely related to retail. Unsecured obviously has been going through some bit of turmoil, and a lot of noise and a lot of warnings were placed sometime last year. What you're seeing currently is basically the outcome of what excessive lending had happened over these years. And if I were to talk in terms of priority or in terms of quality, I think MFI was the worst hit, followed by unsecured business loans, personal loans, credit cards. So you have a commentary which isn't too positive, but incrementally what you see is that largely the unsecured or some bit of credit card, the stress seems to be easing off, still not out of the woods, but incremental stress seems to be easing off. MFI, I guess the stress is still there. And that's what, when you look the Q4 results, that's what really comes out. If you look at secured, I would say most of the players in the affordable side have reported a reasonable, stable quarter. We've been no different. Last year, we had paused our disbursals, so we didn't really have a significant jump in disbursals, but that was being cautious right at the beginning of the year. The numbers, the bureau numbers that were coming out weren't too great. So we took the foot off the accelerator way back then. And what you're seeing the numbers now is just largely on account of prudence in terms of the disbursements that we did last year. The way we look at it, I don't think significant change has happened at the leverage level. But we're a small company, so to commit our momentum, whether it's on disbursal or the asset quality moving forward, isn't too difficult. So we've always maintained that our delinquencies are going to be range bound. Credit costs is going to be somewhere around 1%, 10 basis points here or there. And the NPAs are also going to be pretty much range bound. So that's some degree of solace if you're completely a secured lender, either by property or gold.
Sure, point taken. But what gives you that confidence, Mahesh? Because while you are secured, I take that point, but you still lend to the MSME space.
So I think one of the key things is that we're well diversified across the country. So we've got almost an equal contribution from all zones. So you don't really are clouded under an event risk. So an event risk in a Karnataka or a Tamil Nadu or any other state that may happen really doesn't impact us. It doesn't take the wind away from the momentum that we've been building. And because a concentration risk is limited to at best 8-10% in a single state, we wouldn't really see us getting stuck in an air pocket for a fairly long time. If there is a particular event, at best you're probably impacted by a month or two, but it really doesn't disturb your apple cart significantly. So that gives us the confidence saying that unless and until obviously you have a large event which impacts the entire country, then it's a different thing. But some spurts here or there is obviously not going to rock the boat too much.
Okay. And is there a specific cohort? Is there a specialization of the type of borrowers that you lend to, Mahesh? Because again, that credit cost number of 1% which you are targeting, and maybe 10 basis points here or there, I'm trying to assess, judge what's the downside risk to that.
So, if you go back even during COVID times and you look at most of the bureau numbers, the highest delinquency that's gone is anything between 4 to 5%. And I'm talking about roughly ticket sizes ranging anything between 1 lakh to 30 or 40 odd lakhs. And even if you have an LGD of say 30 odd percent, slightly higher, your credit cost is not going to completely go out of the park beyond 1.5 odd percent, or probably nearing 175. So that's the worst possible outcome when your entire country is shut. You don't have the ability to lend, you don't have the ability to collect. That's the worst possible outcome. So even if we were to look at that kind of a scenario, we're saying that your standard deviation is almost 2 times from where you are, which is very unlikely to happen. So even if you look at any cohorts and you probably cut down data to events which are state specific or pan-India specific, you're pretty much range bound on a secure lending side. So whether it's home or non-home, so you will have a particular range to play. Obviously, your efficiencies and your ability to execute comes into play, and that's what probably shows up in our numbers and the guidance that we've been given.
And Mahesh, the security that you take, one is loan against gold. What are the other assets which you give loan against? That's the first part. The second part is, in case of default, how complex, how complicated, what's the kind of time lag for you to make that recovery?
So in terms of properties, you rightly mentioned, gold obviously has the gold as the collateral as the security. With respect to properties, almost 85% is residential property, largely self-occupied. You have close to around 7 to 8%, which is commercial. And the balance is a bit of a mixed use kind of a properties. Answering your second question with the time that it takes, if loans do qualify under SARFAESI, then you have a fast track of resolution that could range anything between 18 to 24 months. If those are outside of SARFAESI, then it could go to 36 and 48 months.
Understood. And what's the risk like on growth, Mahesh? Likely the only risk is the fact that you could have an asset quality slip up, but that you seem to be confident of that. and therefore this 5 to 7% growth, how long do you expect this to be sustainable for QOQ?
I think the only risk is going to be our own stupidity of not executing it well. I don't think we're going to go down because of the market not being large. So the market's almost at 3.5 lakh crores, growing at almost close to 21 odd percent. And that practically means that you double every 3 to 4 years. So I don't think growth is a challenge. How well do we execute it? How well do we execute it efficiently? How well do we execute it without burning too much of human capital, financial capital, and remaining profitable at a branch, at a unit level? I think that's what probably keeps us awake. I don't think there's an overhang of growth. And that's the reason what we've always maintained, that growing at 5 to 7, which means that you're annually growing anything between 25 to 30, doesn't seem to be a challenge on a segment which is a priority for the economy, for the regulator to grow, even not for the next 1 year, but obviously for the foreseeable future as well.
Sure. And what does, of course, you'll be looking to increase leverage, right? You're at a 35% capital adequacy. What do you expect and when do you expect your next fundraise at? Is there a thought process there? 20% capital adequacy, 25%? What's the kind of bandwidth you leave? And therefore, as your debt goes up, explain to us where your margins will normalize at.
So currently we are on an ROA basis closer to 4.5 odd percent. So practically at a leverage of close to around 3. Our exit ROEs are closer to 13 odd percent, slightly more. So we have some degree of leverage which is available. I think our first milestone is to hit 15% in terms of ROEs, which should probably happen by the end of this particular financial year or the first quarter of next year. But that's something that's been consciously designed to go in. Because our ROAs are high and we keep on accruing profits on a year-to-year basis, we don't see ourselves going back to the market at least for the next 8 quarters. Clearly, I think the first of these milestones have to be achieved. Adequate return has to be delivered on the business that we're delivering before we go ahead to the market. On a debt to equity, we're barely less than 2. I think we have enough room to take it to 3.5 on an operating basis, considering that the rating upgrades that we've had consistently, obviously subject to our operating performance. We don't see a challenge going up to the leverage of 3.5 times from where we are.
Point taken. And therefore, where should your NIMs and ROAs normalize at, Mahesh? How should one look at those numbers?
So I think instead of NIMs, one has to look at spreads in a business. So largely what it means is that at what you lend and at what you borrow, and that brings in the efficiencies. If you're really doing well, your rating is on your side, so your borrowing cost technically should keep coming down. Ability to lend at the right price is important, whether transmission of interest rates happen on time. That seems to be very critical. So what we've maintained is we will continue to maintain our spread, and that's been our narrative all through. Some minor basis points here or there, but largely our spreads are going to remain constant all through the year. So we don't see that changing.
And ROA, Mahesh, therefore, and cost efficiencies and their impact on ROA, how much more can you optimize OPEX?
So what tends to happen is, we swallowed the frog upfront and took a higher cost at the start.
Sure.
And so what you would see is a downward sloping curve with respect to our OPEX. So we've been always maintaining that our OPEX should start seeing a downward towards almost 50 basis points a year. Last year, we, I think, did well on that count, where the OPEX came down by almost 70 basis points. This year, we continue to maintain the same trajectory that our OPEX is going to continue dropping by 50 basis points. So if you do the maths, if we continue our efficiency run and we are leveraged to 3.5, So your ROE impact is 50 basis points multiplied by 3.5. So that gives you almost 165 benefit on your ROEs. And that's what, gives us the confidence of hitting a 15% ROE by the end of the year or the next first quarter of next financial year.
Point taken. Thank you so much, Mahesh, for coming in, speaking with us. And of course, it'll be good to track this through FY26 as well. So looking forward to our next conversation as well.
Thank you.
But that's the management of SBFC. We've spoken about pretty much all that we had to. We're going to quickly look at the ratings on our KYC rating with regard to the parameters. That's how it stacks up. Good growth on income, balance sheet, operational metrics fairly healthy, but we've cautionary given it a neutral. Asset quality neutral as well. No major changes on any of those counts. Shareholding thumbs up. Valuation neutral given that it's quite steep in that sense. Street cred neutral and street coverage thumbs up gives it a 6 out of 8 on our KYC ratings. But we're out of time on this edition of KYC. We hope you found this helpful. Stay tuned, more action on the other side.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ.
Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Benchmark extends gains, but banks lose momentum as Bank Nifty and PSU Bank Index trade lower. Oil and gas sector gains the most. Kotak Mahindra Bank trying to keep Nifty under check on weak Q4, whereas SBFC Bank trying to bring in stability with equal contribution to Nifty. SBI trading with cuts of over 1% on lower growth guidance. Marico rises over 3% after reporting numbers largely in line with estimates, and Avenue Supermarts trades under pressure after EBITDA and net profit miss analyst estimates. Meanwhile, V-Mart slips more than 7% despite strong Q4 results on the back of profit booking. Eminem gains over 1% after Q4 profit jumped 22% and came largely in line with estimates while revenue topped expectations. RR Kabil gains close to 14.5% after revenue jumped over 26%, led by strong growth in core wire and cable segment, while Netweb Technologies jumps over 14% after reporting robust Q4 numbers aided by strong growth in AI system business. JSW Steel loses close to 1% in trade after the Supreme Court cancels the company's takeover of Bhushan Power and Steel, calling its resolution plan illegal, orders for Bhushan Power liquidation instead. Hello and welcome to Markets at 12. This is Varsha. Eminem is actually in focus today, and I'm here joined by Puneet, my colleague. Puneet, so Eminem numbers are out. How are you reading this?
Well, numbers are actually largely in line with what the estimates were. Actually, the revenue growth has actually come higher for the company. It's coming at 31,608 crores. That's up 25% compared to the same time last year. We were penciling in a growth of around 20 to 21%. What that has done is it's beaten estimates of about 30,024 crores just in terms of revenue. In terms of EBITDA, it's a 35% growth. That's bang in line with estimates. What we had, 4,219 crores. Same time last year, the numbers were 3,118 crores. And definitely, the estimates were roughly just about 4,200 crores. So definitely in those numbers in that range. The only aspect is that the revenue growth has come in higher, and because of that, the EBITDA margin number has actually come in at 13.34%. versus 12.4%. While this is almost a 90 basis point growth from the same time last year, we were largely penciling in a 14% number in terms of EBITDA margins. And hence, there is a slight miss, but that's largely led by the revenue growth that's been higher in this particular quarter as well. So just on these four metrics, on profit as well, it's coming at 2,437 crores as it's flashing on your screen. And that's also largely in line with estimates of 2,490 crores. So on these four numbers, it's largely in line with what we were penciling. It was expected to be a high growth quarter because the company had 18% growth in its passenger vehicle sales, but definitely something that the company has mentioned, it's in terms of EBITDA margin, they will be focusing on that because discounting has gone down. But overall, on these four numbers, definitely it's a positive for Eminem. What's also important to note is the segmental performance that the company has given in this particular quarter. We have seen the automotive business, which includes both, essentially the passenger vehicle side of the business has 24,975 crores in terms of revenue. That's a 25% growth on the segmental, as well as the farm equipment, which is essentially the tractor space, has come in at 6,428 crores. Again, a 23% growth compared to the same time last year. But, to discuss more on these numbers, we now have Avinash Gorashankar, the Director Research of Profit Mart Security, joining in. Avinash, Eminem numbers just have come in. In terms of EBITDA margin specifically, it seems like there is a slight miss, but that's largely seems to be coming from a higher revenue growth. The base has gone up. But we are penciling in the numbers are largely in line. Do you also see the same?
Yeah, I think, Puneet, first of all, numbers which have come in are more or less in line, or I think, better than what the street expected. I think a 35% growth in EBITDA is definitely a very solid growth. If you look at all the other auto companies, I think Mahindra & Mahindra has been one of the few players who has shown us such a sharp increase in the revenue as well as in the EBITDA. And the bottom line, that is around 2437 crores, is also in line with expectations. So, the margin miss is not something so, major or anything negative to speak about. But I think some more clarification will be coming in the management call today in the afternoon. And I think there the management would clearly spell out what is the kind of vision and the growth strategy going forward. Margins are not important. The market wants growth, and that is exactly what the company has done. I think for them now, the electric vehicle business, which wherein they launched 2 cars, is going to be now critical. I think markets would like to see what kind of growth trajectory this product does for them in the year FY26. And most importantly, the tractor market has also grown. They have outperformed the tractor market. The utility vehicles also, they have continued to consolidate their market share. So all in all, this number is good. I think you have to see the overall performance in the light of this given fourth quarter number. So all said and done, the market should be pleasantly happy. There's no doubt about it.
Got that, Avinash. And Avinash, I'm just going through the press release as well. The company has mentioned that they've delivered 6,300 electric SUVs in this time. They had roughly, and they mentioned electric SUV bookings of 30,179, and that's again the day one booking. So they've not actually diverged the total booking numbers of electric vehicles that they sell right now. But just this number of 6,300, it essentially means that they've started to actually deliver and it's visible on the road as well. How are you viewing this number specifically?
So this is definitely a good number, Puneet, to start with. I think the markets would at least look at the fact that they sustain this number, this run rate, at least for the next, 1 or 2 quarters. And hopefully once they have the full capacity available, I think this number could easily get ramped up to something like 8 or 10,000 numbers. So I think, they have got very big plans for the electric vehicle market. Mahindra & Mahindra has spent a lot of capex on this product. So I would believe that, you could possibly see a bigger ramp up happening in the second half of this financial year. But to start with, this ramp up number of 6,000 vehicles is definitely not bad. I think it's a good beginning.
Also, Avinash, in terms of, the segmental performance that we are seeing, we are seeing the automotive margins come in at 9.2%. They hit a high of about 9.7%. How are you seeing this number penciling in? Are you expecting this to go up, of course, in the near future, but a low double-digit number, that will definitely help the profits as well as EBITDA going forward on a base of a high base on FY25 numbers as well. So in terms of this number, because we've seen the tractor margins also go up to 19.4%, that's 370 basis points higher than last year. But the automotive margins, do you expect them to go into double-digit and maintain that in FY26?
No, I think my sense is that initially, I think this margin improvement, if at all, if it comes, I think will be visible in the second half. In the first half, my sense is the markets would also like that margins improvement comes immediately. But I think the first half, we could see margins sustaining at around 9.2, 9.3%. Maybe the second half, Puneet, we could see double-digit margin improvement. Hopefully, once volume stabilize, you get a bigger volume growth from the traditional, utility vehicle kind of volume growth, plus the electric vehicle ramp up. As far as tractor margins are concerned, they are the best in the industry. And I think if at all the industry this year grows by about 8-9%, Mahindra & Mahindra is well positioned. Already the Met has said that there will be a regular monsoon. So I think, hopefully monsoon is good and you could see a larger kind of growth momentum coming in from the tractor sales also.
Last question, Avinash. We are seeing the press conferences scheduled at 12:30 today, and we also have the analyst call at 3:30. Is there something that you are penciling in apart from, I think a lot of analyst question will be on what's the total bookings that they've received for the electric vehicles. Anything else that you're looking for in the call?
No, I think my guess is that, typically the rate cuts which have been announced by the RBI, I think what impact it would have on tractor financing, that is something which is quite, important to note. And most importantly, within the utility vehicle market, any new product launches they are planning, both on the electric as well as on the, traditional, petrol or diesel side. So that would be interesting to watch what kind of product pipeline do they have.
Got that view. Avinash, thanks so much for joining in, giving us a whole host of views on the Q4 results, and wish you the best. Look forward to our next conversation. But overall, that's the headline coming in even from Avinash, and the Eminem numbers largely in line on all 4 headline numbers of revenue, EBITDA margins, as well as, essentially the PAT. We've seen the revenue growth being higher, and hence the number of 13.3% on margins versus 14% it looks like a miss. but the company's revenue growth has been higher, and hence, a very positive number from Eminem. I think the 6,300 crore number, Varsha, in terms of the electric vehicles delivered is another key positive, but largely both these aspects look very positive for Eminem.
Yeah, absolutely. Well, let's see what happens in the press release and conference call today, Puneet. But thank you so much for joining this conversation. Well, moving on, Marico is in focus. Its Q4 number shines with double-digit revenue growth powered by food and digital brands. We did speak with Saugat Gupta, who's the MD and CEO of Marico. Do listen in the conversation.
Your sense of how Q4 has panned out and overall FY25 has panned out, because India volume growth appears to be very impressive in terms of a tough macro environment overall.
So I think last year we continuously, showed sequential improvement in volume growth. A lot of it is because of the fact that the core remained resilient while we accelerated our diversification agenda in food and digital brands. And despite the fact that I think input cost impacted the entire sector, but our input cost increases perhaps one of the highest in the sector, and we remain resilient because of institutionalized cost management program to deliver also profit growth, and the fact that we continue to invest behind A&P. So I think as we go towards next year, this augurs well, because we are exiting the year with a 7% kind of a volume growth, and therefore we will strive to maintain this level of volume growth as we move towards this year and the subsequent quarters.
Okay, and in terms of your sense of the food business as well as digital first business, because that the food business grew around 44% for you this quarter. Even the digital first brand did grow spectacularly. What's the sense like, and where do you expect this business to go by the end of, let's say, FY26 or FY27?
So if you look at foods, I think we have grown 5x times since FY20, and we want to double it in FY27. Similarly, as far as the digital businesses is concerned, we earlier thought we will double in FY27. We're saying now we will move it to 2.5x. I think so. Food has three vectors of growth. One is our own Saffola Foods, which I believe is one of the great examples of how to do a TAM expansion in a master brand which has been under-leveraged. There is True Elements, and there is Plix, the nutraceutical part of Plix business. As far as the digital brand is concerned, there are two cohorts, which is Plix and Beardo. They are currently, positive. Beardo, in fact, is close to double-digit EBITDA. So these two we will drive significantly accelerated growth, because we believe that now there is a situation where they will be able to improve the operating margins with scale because of scale efficiencies. As far as the other two digital brands are concerned, which is Just Herbs and True Elements, which has a marginal bleed, we would first try to accelerate the break even in the next 18 to 24 months. So with this, we are extremely confident that the digital brands will deliver a double-digit EBITDA overall by 10%, around 10% by FY27. Food, in the last 2 years, we have, I think, made significant effort to improve the margin. And I think the entire endeavor in food is just like oats, and the oats, masala oats business, which has 400 plus crores today, delivers company level EBITDA. How do I get and scale up 2 or 3 more categories in the next 3 years, so that we rapidly, while growing foods also, once we try to improve margins?
Okay, and Mr. Gupta, in terms of your core business, largely this was a pricing led growth. Even in terms of value added hair oils, continuous steady recovery has been seen. So what's the outlook like when it comes to your core business? Do you still think that FY26 will be a pricing led growth, and will value added hair oils see a steady recovery?
We expect volume growth in the core to improve. I think if I look at this quarter, I think last quarter Parachute, while it was a minus 1% in transaction terms, it was positive. There was MLH drop taken. We expect Parachute growth to recover from Q2 onwards as the situation moves from hyperinflation to inflation. We are already seeing significant stress amongst the smaller players with respect to supply chain management and working capital management at these high input prices. Value-added hair oils, what we did is we did a slight bit of strategy retweak where we wanted to invest behind the mid and the premium segment, we also have higher margins. So we expect value-added hair oils to, the value growth on that to steadily improve as we move in the subsequent quarters. As far as Saffola is concerned, I think we have taken a conscious call is not to chase volume growth, but to operate at a threshold level of profitability. So even if it delivers low single-digit volume growth, we'd be happy as long as we get good value growth.
Okay, Mr. Gupta, correct me if I'm wrong here. In your con call, you did mention that first half, at least of FY26, might be a pricing-led growth. Just wanted to get a sense there that do you think around 8 to 9% of pricing growth is something that we can pencil in?
So the way we see it is that definitely first half, if we maintain this volume growth and obviously there will be a certain pricing-led growth, there will be a comfortable double-digit revenue growth in the first half. In the second half, we'll see as it pans out. But overall, the way we see it is there will be higher revenue growth in the first half in terms of inflation, maybe slightly lower in the second half, while margins will improve in the second half. So overall, we are extremely confident delivering double-digit revenue growth this year, and we also strive to deliver double-digit operating profit growth this year.
Right, and you spoke about margins because copra inflation has kept margins under pressure, and you've said that you are likely to see recovery in FY26. Where do you expect the margins levels to be at, and do you think that will be a back-ended thing, or do you think that the frontline margins will improve?
So I think it will be a combination of both the input cost, copra input cost softening, as well as improvement of the mix, which is digital business and foods margin improvement, along with VAHO growth, because VAHO, as you know, has higher margins. So a combination of that. But you are right, I think the margin improvement will happen maybe more in the second half than in the first half.
Okay, and lastly, in terms of FY26 outlook, where do you expect the revenue growth as well as the bottom line growth to be at?
So as I said that we are extremely confident of delivering double-digit revenue growth, including double-digit constant currency growth in the international markets, subject to there no black swans there. As far as operating margin and the operating profit is concerned, we will strive to deliver double-digit growth.
Well, this was Marico expecting double-digit revenue growth in FY26. But moving on, RR Kabel is other stock which is in focus after the company announced its quarterly earnings with a growth led by its strong cables and wires segment. My colleague Mahima spoke to the management about the company's guidance for FY26. Listen in.
FY25 has ended on a higher note, though 9 months were slightly under pressure. FY25 has ended on a higher note, and the key wires and cables segment revenue grew by around 28% YoY basis, which was a beat completely in terms of what Street was expecting. What's the view like, the sense as to how quarter has gone by, how FY25 has gone by, and overall how things are panning out for the company?
Good morning and thanks. Yes, we had a very good quarter, and since first half of this year was not that much great, and that's why we could, whatever we have done in Q4 have improved our year-on performance also. We have seen a very good growth in our wire and cable business, and same way in FMCG also. It was like we have seen a best in the industry growth. Particularly in wire and cable, we have seen growth in domestic as well as our export markets. And now with the new expansion coming, we are expecting to grow even much more better in coming year.
So, Mr. Jain, I wanted to understand that, you mentioned that the quarter has been exceptionally well, but I just wanted to understand that do you also believe that the copper prices have been on a rising trend in the past quarter? Do you think that channel stocking has also led to this kind of growth in the wires and cable segment?
Prices are on upward trend. It gives sentimentally, it gives positive sentiments to trade, and they stock up more, and we have seen in this quarter that there is very good demand from channel in this quarter.
Okay, and Mr. Jain, in terms of the FMEG segment, although the growth overall has been great, this quarter the growth was seen moderating a tad bit. It came at around 13%, and this was on the back of delayed summers, if I'm not wrong. What's the sense like here? And in terms of losses, they continue to decline on YoY basis. What's the outlook there?
So if you see on a yearly basis, we have grown almost 21%, while industry is growing at 8 to 10% only. So, of course, due to delayed summer, there was some impact, but still, even our last year quarter base was also high, so we have performed better only. Yeah, on the profitability point, also again, like our profit, like rather loss have reduced by almost 500 bps when we compare year-on-year basis. So we have seen, though still it is loss-making business, but we have done a very good progress in this year and quarter as well.
Okay. And in terms of the margin outlook, wires and cables in terms of Q4 FY25 almost stood at 10% in terms of margins. Do you think that these kind of margins are sustainable going forward as well? What could be a reasonable range of margins that one can look at in the wires and cables segment for FY26?
So, of course, this quarter was at a very high note, and we are not taking that as a benchmark. But when we see on a yearly basis, like this segment was closed at around 7.4% on yearly basis, and this we expect to improve by another in the range of 8 to 8.5% in coming year.
Okay, and what will be the key drivers that will drive this margin improvement?
So both, one is of course scale. Once we are getting scale in our cable business, and if we are going it in the range of 15 to 18%, this will improve our margins by product, better product mix. Also, we are expecting a good growth in our cable business, where still we are very small, and our major expansion is coming in that sector only. So this will give us good returns and growth in margins as well as volumes also.
Okay, can you help us understand as to how this product mix will change and any new product categories that you're planning to announce in FY26?
Not exactly product category, but within category of cables, we are coming with new range, even in our export cables also, which was earlier it was wire-driven export, but now we are getting very good orders and from our export markets for medium voltage cables, which will be new product category where we are going at faster pace. Within we are expected to grow very good in solar cable or power cable, MV cables in domestic market as well.
Okay, Mr. Jain, you mentioned about exports and you said that you are getting new orders from the export side of business. Just wanted to understand as to what are the export strategies that you'll be adopting going forward in FY25, FY26, plus new focus geographies for you, because as compared to FY24, FY25, the mix in terms of revenue, export business still stands at that 24% mark. Do you think that this mix will change going ahead?
To some extent it will improve, but since we have equal focus on domestic as well as export markets, or both markets are expected to do well. Yeah, within exports, yes, we have seen a very good demand coming for cable, which is high margin business from Europe or even from US market also. So we are expecting a good growth from export market in this year.
So then that 24% share of revenue in the total revenue, that will improve to, let's say, 26, 27 odd percent?
Yeah, in that range only.
Okay,
yes.
All right. And, Mr. Jain, in terms of the competition intensity going up overall, there are new entrants which are entering into the cables and wires space. What is your sense like? How do you actually right now view competition as?
First, if we see this industry, really it is doing very good. It is expected to grow in the range of 13 to 15%. And as of now, if this industry is at 90,000 crore, we may expect in the range of 2 lakh crores by FY31. That's why there is enough room to grow for everyone. And whosoever have good market presence, quality controls, and they will grow. So we are quite optimistic looking to the Indian and domestic export market that this industry will do good, and we will try to perform better than industry in this.
All right, Mr. Jain, one last question before I let you go. FY26, what is the kind of growth that you're penciling in terms of the top line as well as bottom line?
So we have announced our 3 years project Rise, which has where we have penned down around 18% CAGR growth in our wire and cable business, and 25% in FMCG business. So this year will be almost in those lines only.
Okay, just one more question, Mr. Jain, before I let you go. You did approve capacity expansion at the Waghodia plant for around 1,000 odd crores. What's the sense like, what are the kind of growth revenues that you're expecting from that particular capacity expansion?
So overall, our capex plan is around 1,200 crores, which includes some part of Silvassa also, and this is expected to give top line of around 3 to 3.5x revenue growth.
Well, this is RR Kabul speaking about the growth prospects when it comes to FY26 and the future years. But let's just look at how markets are doing. Let's see where Nifty is. Well, Nifty 50 is near that's 24,500 mark. Well, let's see who are the gainers when it comes to benchmark. You have Adani Ports, Adani Enterprises, Trent, Shriram Finance, who are on the gaining list when it comes to benchmark indices. While on the losers list, though, you have Kotak Mahindra Bank on the back of earnings. You have ONGC, down when it comes to benchmark indices on the back of oil prices tumbling down. You have Dr. Reddy's and SBI on the loser side when it comes to benchmark indices. Well, let's pull up sectorial heat map. Let's see which sectors are buzzing. I think barring Nifty Bank, everything is in green. There you go. Nifty Bank is down almost 0.5%, while Nifty Auto, Nifty FMCG are on when it comes to the auto and FMCG, they've gained almost 1%. When it comes to sectorial heat map, while broader markets are also up today, so quite good when it comes to market check. Well, that's all the time we have on the show. Take care and stay tuned to NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations of European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as
And welcome, you're watching Profit Buzzers on NDTV Profit with me, Somit Sarkar, and my co-anchor Mihika. Well, Mihika, if you look at the markets, they continue to remain range bound. It's just the financials which have been dragging the overall markets?
Yeah. If you look at the Nifty 50, we're up almost 0.5% right now. And if you had to look, at advance decline ratio for the Nifty 50 and the markets in general, for the Nifty, you have 39 advances versus 10 declines, something that's gained significantly on the Nifty. You have an Adani Enterprises up 8.5%, followed by an Adani Ports up 8.3% as well. You also have some strength coming in a Trent up 4%, Shriram Finance up 3% in terms of the point contribution. HDFC Bank, Adani Ports, RIL are what showing strength for the company. Something that's not doing so well is a Kotak Mahindra Bank, down about 5%, followed by an ONGC, which is also seeing some pressure, down about 2%. I also want to quickly highlight the Nifty Next 50, which is actually up 1.6%. Some of the counters out there also seeing some significant moves. Actually, the entire Adani pack, Adani Power, Adani Green, Adani Energy, all seeing gains of 7 to 10%, followed by a Swiggy, which is up 6% right now. You also have some strength in oil marketing companies, BPCL, IOCL. You did see oil prices slip early in trade today below multi-year low. BPCL, IOCL up 3 to 4%, followed by an Interglobe. And even in terms of the negatives, you have Macrotech, ICICI. In terms of the broader markets, they are outperforming. The Nifty Mid Cap 150 is up 1.3%. The small cap up 0.7%. I want to just kind of highlight the Nifty Mid Cap 150, the clear outperformer. If you go to see 118 advances on the Nifty Mid Cap 150 versus 31 declines. Something like an HPCL and KEI Industries are also buzzing in trade. But we're going to shift to Eminem, who is holding a post-earning press conference right now. Let's cut across to the management.
The presentation, I just want to share that we've had a very strong set of results, which you will see not just in numbers, but also in the steps we've taken to build a strong foundation for growth for the future. Let's start, therefore, with the key messages, as always. Auto and farm see continued strong execution. And you see this in both the market share as well as the margin numbers. We had promised SUV growth of mid to high teens a year ago. And we have come in a bit ahead of that at 20% growth year over year in a market that has been a difficult one. Revenue market share is up 210 basis points to 22.5%. And margins for the auto business are up 110 basis points. So all around very, very strong. The farm business similarly has seen tractor volume growth of 12%, again in a tough market. Market share is up 170 basis points. Not easy to do that when you're 40% plus. And margins here are even higher at 210 basis point growth at 18.4% for the year. What you will also see in the results is some write-offs to category B subsidiaries. We had talked about the categories a few years ago, and as a reminder, category B were subsidiaries that had a strong quantifiable strategic benefit but not quite a profitable path. We have seen the strategic benefit from both Mitsubishi as well as Sampo, and we have now pivoted them to ensure that we have lower losses from them going forward, and hence the write-offs that you would see in this quarter. Both Tech Mahindra and Mahindra Finance are on a good path. Strong execution again. A lot more to do in both cases, but we're very happy with where they've reached so far. TechM has outlined its margin path to 15% in F27. It's on that path at this point. Mahindra Finance has achieved a significant milestone of maintaining GS3 at below 4%. We typically would like to be below 4.5%. We've actually been even better than that at this point. And that transition from a 7 to 8% normal GS3 to a 4.5% or lower number is a difficult one, but the business has done that very well and puts itself on the path of much stronger growth going forward. What we'll talk about also is our scalable growth gems and the foundation that we are building to ensure that they can be profitable and strong businesses for us in future. But all in all, a growth of 20% from a profit standpoint, and we continue to maintain an ROE of 18%. That's what you see here. While revenue is up 14%, profit is up 20%. Profit does exclude the mark to market on KG Mobility, which is SsangYong. It really has no impact from a cash standpoint or an operating standpoint. But we had seen profits in the prior year and losses in this year, which essentially offset each other. But in the percentage numbers, you see that impact, and which is the reason why we've taken that out. And 20% profit growth in the current environment is clearly a very strong execution, and you'll see that across multiple businesses. Standalone is up 17%, both revenue as well as profits. And with that, we'd like to share a chart on the positioning of our various businesses. And you see this in terms of competitive position on the y-axis and the scale of the business on the x-axis. As you would expect, auto and farm are in the top right, a very strong competitive position, and both scale businesses. Mahindra Finance and TechM have scale, but aren't quite at the level of where we'd like them to be from a competitive standpoint. And there's more work to be done to take them higher on this graph. And then we have our growth gems, and we are now categorizing them into what we call scalable growth gems that have a strong competitive advantage in their industries, and emerging growth gems which have some competitive advantage, but there's more work to be done to be able to get them higher again. And we are defining valuation targets for them, 2 to 3 billion for scalable growth gems, and getting to 1 billion, which is where we start getting a lot more competitive in that industry for emerging growth gems. Let's look at the performance across businesses. I'll cover auto and farm fairly quickly. Rajesh is going to cover that in a lot more detail. Key highlights for auto. Number one, SUV player. Very strong electric vehicle order pipeline. Deliveries have begun, and we have very quickly gotten to the number one share from a revenue standpoint already. And disciplined execution with high margins. You see that in the numbers. Farm, new products, a strong geographical focus to drive growth outside India. Margins up 210 basis points, and you see that in the numbers as well. Mahindra Finance has seen a 17% growth in assets under management, despite pivoting to a business which is much less volatile, much more stable. And you see GS3 under the 4% threshold, as we outlined earlier. We have deprioritized disbursements last year to make sure we can transition the business to a more stable GS3 level. And you see that in the numbers as well, which is a very strong profit growth at 16%, and a very good outcome in terms of that transition. TechM, good deal wins, strong pipeline, bringing in more customers from a consumer and a BFSI standpoint, continuing well on the margin trajectory, and therefore positioning the business very well on the path that it has outlined already. Let's talk a little more about growth gems. Hospitality. 5 years ago, we had 3,700 room keys. Today we have 5,800. And we're moving to a target of 2 to 3 times that, which we'll cover in more detail later as those plans are finalized, which will effectively give it a 5x growth in terms of room keys alone. Logistics, we see revenue as a key metric there, up from 3,500 to 6,100, and they're targeting again close to a 3x growth in the next 5 years. And there also we will come back to you with further details on that as those plans are outlined. With the new CEO, Hemant Sikka, coming in, we see that business on a very strong growth trajectory. Life Spaces, these are the numbers that have been presented by the Life Spaces team publicly. We have grown significantly from 670,000 in pre-sales 5 years ago to 2,800 crores today. And the target there that the business has outlined is actually 9,500 crores, which we're taking the liberty of rounding up to 10,000. And that is really a 14x growth over this decade and positions this business extremely well. More importantly, again, has been shared by the business. Everything that's required in terms of pre-sales in the next 5 years, 70 to 80% of that has already been acquired in terms of land, and it's only execution from here on. There's also a very strong focus on profitability, and which is the reason why we are going ahead with the rights issue, putting more capital into the business and enabling its growth. Sustain, up 5x, our renewables business. Last mile mobility, up greater than 10x, possibly even 15x by the time we are done with it. Up from 14,000 to 78,000 already. So you see a significant growth over the last 5 years. And we are still again trying to target 2 to 3 times that growth over the next 5 years. Trucks and buses we've talked about recently with the SML acquisition. And we feel fairly confident that we can get to a 10 to 12% growth in F31 as we've outlined. So very strong set of numbers in our scalable growth gems, and this is how we are building these businesses to be larger over the next 5 years. And that's what we want the group to do, is have multiple large businesses. And as we go on, we'll share more about other businesses that will start getting to a stronger trajectory as well. This has enabled a consistent delivery in our commitments. We had committed to 18% ROE and 15 to 20% EPS growth on 28th of May 2021 when we reported our F21 numbers. And what you see here is a consistent 18% on ROE, and our EPS growth has actually been 63% year over year since that time. With that, I'm going to invite Rajesh to come up, talk about the auto and farm businesses.
Hi everyone, I'm going to quickly zip through this so that we have time for questions. On the FES side, the key highlight has been the gain in market share. This has been our highest ever Q4 market share. We gained 1.8 share points and also grew quite significantly for the full year ahead of the industry, where in the year we gained 1.7 share points. So a very strong market performance. You can see that here, and this is actually the highest FES market share that we've ever achieved at 43.3%. Farm machinery, we've spoken about quantum growths. We haven't quite got to where we would have wanted to, but crossing 1,000 crores is a critical milestone, and we've accomplished that in the year F25. The farm margins have been very, very strong, and for the full year, the margins in farm have been at 19.7%. A very that's for the core tractors, and for the farm standalone has been at 18.4%. To clarify, core tractors is all domestic tractor sales plus tractor exports from India. That's what we call core tractors. This indicates, this chart is a chart we always show to show how we are able to manage a band of margins in spite of what happens to industry volatility. And the strong feature here has been quarter 4 tractor margin of 20.8%, which is a very, very strong margin for a quarter 4 volume. On a consolidated basis, the FES quarter 4 PBIT grew 25% and for the full year 14%. This is farm consolidated overall. Just a quick update on the commitments that we had made for 2025 and where we are. The revenue growth is green. We've grown strongly. We've grown significantly on tractor market share, which I just spoke about. We've not achieved the quantum growth we wanted in farm machinery, but we are at 1,000 crores revenue in F25. The one area we haven't done as well as we would have liked to is the international and the exports. This is because around the world we've seen a significant slowdown over the last year and a half on industry size in different markets in which we play.
And that was the Eminem management at the press conference, and we'll bring you more details as and when they come by. But we're going to stick with the auto sector for now. Rural demand was the only contributing factor to retail sales of cars in the month of April. Now, this is according to the data from the Federation of Automobile Dealers Associations. Passenger vehicle sales grew over 1% versus last year at 3.5 lakh units, while two-wheeler retail sales came in at around 17 lakh units, which is a growth of 2.3%. Now, we spoke to C.S. Vigneshwar, president of Fada, on the auto sales number. Listen in to what he had to say.
I just wanted to break up how this month has gone essentially in terms of vehicle categories. I wanted to start off first with the two-wheeler growth. It's been roughly about 2.5% compared to last year, 2.25%. And this number has actually grown 11% sequentially from the previous month. Now, we had, months like Gudi Padwa also go into March this year compared to April last year, but still this number is quite positive. If you could just start off first with, in terms of two-wheelers, in terms of the growth momentum, has this largely been led by rural demand according to you?
Thank you so much for having us over. Yes, it's been modest growth, but it has been a growth which we are certainly enjoying seeing these figures because it's quite encouraging. We have grown at about 2.25% year on year in April, the two-wheeler segment, which is quite decent from the fact that we've also had the OBD price increases. So that also has been a little bit of a headwind. But despite it growing at about 11.84% month on month and 2.25% year on year, I think it's extremely good. And we are really hoping for the other sectors also to do well.
Mr. Vigneshwar, there has been a lot of, brokerage notes as well as on the ground the financing requirements have slightly gotten tighter for two-wheelers. Are you also seeing that on the ground currently? Because we have a lot of two-wheeler listed companies who have their own financing arm as well. But largely amongst the NBFCs, there has been some notion of tightening in terms of credit quality. How are you seeing that on the ground?
We are seeing some things very, very similar. Our tag times between getting a customer connected with the financer and then the financer giving the loan to the customer is taking longer. We call it the tag time. We are also seeing that a lot of rejections are there compared to what it was 6 months before. And we also seen that financiers and the bankers are asking for more documents. So these things have actually been a little bit of an impediment for growth.
And in terms of, just let's move into the passenger car side because while there has been growth shown in this year, according to the data from yours, 1.55% on a YOY basis, do you see that this has largely been fueled, of course, by SUVs, but also by discounts?
Yes, discounts are certainly pushing these vehicles inventories to customers. And it is, again, a question of having stock because right now, throughout the industry, we are having about 50 days of stock, which is clearly 2 times the stock levels what FADA recommends. And discounts would be, of course, a factor of stock because higher the stock, therefore, we are giving out more discounts. So we are working with OEMs, but the OEMs need to take a little bit more attention, give more attention and spend more time in seeing how they can optimize these inventories, bring it down to 21 days, which is what is the industry and the FADA recommendation. The moment this happens, perhaps things would be better because as a dealer, not only we are paying higher stock interest but we are also paying higher discounts. So our books are not looking great. This needs to improve, and we really need to work with OEMs to make that happen. From that's one point of view. This month rather, we've also given out data regarding different fuel types. So that is also something which is quite interesting. We are seeing that alternative fuels, which are CNG, LPG, we also talk about hybrids and EVs, they are right now constituting nearly 30% of sales. So which is a good thing. Slowly we are replacing fossil fuels in different ways. The traditional fossil fuels were of course pure diesel and pure petrol. So these are being given a run for the money, so to speak. And this wasn't even 1 or 2%, let's say 5 years ago. So I think the whole industry has come together to give the customer a choice and also to give a relief to our exchequer, because we are trying to help the drain in our forex reserves by selling only diesel and petrol vehicles.
And Mr. Vigneshwar, in terms of, you mentioned inventory at roughly about 50 days for passenger cars. Would that be a safe assessment to say that inventory currently stands at roughly about 5 to 5.5 lakh vehicles?
Yes, about 5.5 lakh vehicles is what we are thinking. That we know that the inventory is there. So we really need to reduce this to 21 days.
And so would that be a visible trend? Because we are also seeing companies come out with their quarterly earnings right now. And a lot of commentary has been that rural sales is outpacing the urban growth, and that's slightly visible in your data as well, that the car sales have actually shrunk in the urban markets in April. Do you see that as a trend going forward as well, that because of a lot of marriage dates also coming up in May and June, do you see that trend continuing for the rural growth market to outperform the urban, either across segments or at least in the car space?
The rural segment has been outpacing urban segments in two-wheelers and passenger vehicles for quite some time, at least a year. And what we have seen is that the rural economy has been benefited by good harvesting, which was a result of good monsoons and the reservoirs also being full. And the government also has given minimum support prices, which have helped the industry. At the same time, we are seeing stress in the urban sector, because the urban sector, the salaries haven't grown as much as the cost of the vehicles have. If you take 5 years before and compared to what it is right now, the vehicle prices have actually gone up nearly about 60% because of safety, because of other environmental measures which have been, upgrading which has happened in vehicles. But we haven't seen the salaries keep pace. So this is something which the government really needs to think about in terms of policy, also in terms of how the urban economy can be revived, because it can't be a one-horse race. We need both the urban sector as well as the rural sector to support the industry, not only in automotive, but across the economy.
Mr. Vigneshwar, would you say that the tractor demand has actually been positively surprising in this particular time frame? Because while there was anticipation of Rabi crop being very well, we've seen the last quarter, essentially from January to March as well, the numbers being strong, and April was another strong month. So in this time where the car sales are slowing down and we started seeing that impact on two-wheelers as well, tractors will be one of the key growth areas for FY26. Would that be your view as well?
The tractors have been doing decently well in the last few months. The tractors are kind of a humdinger to what is to come in the rural economy. So we've seen when there are good tractor sales, it has been followed by decent performances in the two-wheeler and in the passenger segment in rural areas. And we are hoping that this good, strong tractor demand would bring in good results for the automotive sector and the rural area.
Final question, Mr. Vigneshwar, in terms of outlook for this year. You mentioned that we spoke about tractor growth being strong. Two-wheelers as well as car segment, we are seeing rural outpacing the urban market, while commercial vehicles will largely depend on government spending. So how would you view the next year in FY26? Do you see that these trends which have started off in April at least should continue in the near term, at least the next couple of months, and growth areas, any kind of outlook that you have, what do you expect in this year in terms of outperformance? Where should we look at that aspect?
Well, I think it should be quite a a modest year in terms of growth. We also need to remember that we've been having breakneck many years after COVID because of personal mobility, a lot of infrastructure spending. So it could be a year where it is modest. We probably need to see how the industry corrects itself and then again grows at in the double digits. But we need to give it time for that to happen. Right now, the industry is doing decently well. When you look at the stock markets, they are back to the pre-tariff war levels, so which are good. And there are a lot of positives there. There is a decent enough festive season which is going to come in. With all this, I think there would be better performances across different sectors, which would result in better growth in the stock markets too. Another thing, we also seen that this year, the summer is not going to be as severe as it was last year. The meteorological department has also said that a lot of showers are expected throughout the summer to bring down the heat, which means that not only is good for the water availability for farming, it is also good for customers going out and shopping. Last year, because of the severe heat waves, we had customers who were not willing to step out. It wouldn't be the case this year, where people would step out and shop. So all these things would augur well for the automobile industry.
Well, that was Fada on the auto sales outlook in India. With that, let's slip into a short break and we'll be back with more news on the other side.
That's huge. That is a biggie. It's on deck.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in?
Benchmarks extend gains, but banks lose momentum as Bank Nifty and the PSU Bank Index trade lower. Oil and gas sector gains the most. Kotak Mahindra Bank trying to keep Nifty under check on weak Q4, whereas HDFC Bank is trying to bring in stability with equal contribution to the Nifty. SBI trading with cuts of over 1% on lower growth guidance. Marico rises over 3% after reporting numbers largely in line with estimates, and Avenue Supermarts trades under pressure after EBITDA and net profit both miss analyst estimates. Meanwhile, V-Mart slips more than 7% despite a strong Q4 result on the back of profit booking. Eminem gains over 1% after Q4 profits jumped 22% and came largely in line with estimates while revenue topped expectations. RR Cable gains close to 14.5% after revenue jumped over 26%, led by strong growth in core wires and cable segment, while Network Technology jumps over 14% as well after reporting robust Q4 numbers aided by strong growth in its AI systems business. JSW Steel loses close to 1% in trade after the Supreme Court cancels the company's takeover of Bhushan Power and Steel, calling its resolution plan illegal. Orders for Bhushan Power's liquidation instead.
Well, SBI Q4 delivers a solid SBI's Q4 was a solid set of numbers that has come in. Let's get in Harsh with more details on that.
Your expected margin was roughly around the 2.9% mark. That came in at 3%, which was a bit of a relief. But going forward, FY26, the outlook seems to be difficult. Margins expected to decline. That's what the management suggested. With regard to OPEX, well, they've provided a little bit of additional OPEX this time around in employee costs on the back of a reversal, and that reversal has been recognized in the treasury income, and therefore other income has come in better than expected. So non-core is what led the beat with regard to profit after tax. Provisioning was also higher than expected. Credit costs rose on a low base. Two reasons for that: there were lower recoveries than anticipated, and therefore that credit cost number saw a bit of a spike. So all of those, largely PAT was in line. They maintained that 1+% ROA number even for full year. They're expecting to do that in FY26 as well. In fact, growth, and that's the other key number, came in at 14%, 4% QOQ. Best growth among the larger private sector banks outside of maybe HDFC, which matched that. In terms of growth expectations, 12 to 13% is the expectation for FY26, which is lower than their 14 to 16% band, which they had earlier guided for. So maybe a slight bit of taper even with regard to growth going forward.
Well, thank you, Harsh, for giving us those details on SBI. But we're going to again cut into the Eminem presser, which is
would you say that is an indicator of a wholesale shift towards how India buys cars, or do we still need small cars to grow car penetration in India? To Mr. Jejurikar, we saw the dealership data come out today, Vahan based, where there's been absolute lack of urban demand, which is negative territory, but the rural sales is up 5%. How is your sales evolving in such a picture, and what would you look for the year to come? And what is happening in the case there is a trade deal? You're seeing great volumes in South Africa as well as Australia. If a trade deal happens, it also works in your favor. Will you look at opening up to the Europe as well as the US market, because both the trade deals are in negotiations there? Mr. Barua, you've mentioned about the EV business is a bit positive at this point of time. Can you talk to us about the impact on overall margins of the meal business? There's a doubling of the other income, if you can talk to us a little bit about that.
Okay, so to start with your first question, as I said earlier, it's again the product set that we have out there, which we feel is generating a very high level of demand. And many of them are fairly unique products, the Thar in particular, Scorpio, which we've obviously had for a very long time, and the new electric vehicles coming in. So it's to a large extent driven by the uniqueness, the quality of the product, and the fact that customers are getting a very high quality at a very reasonable price as well. So for us, that's a great place to be right now. and our effort is to continue maintaining that kind of a product portfolio that will give us that growth. And I think that's what's driving consumer demand more than just whether it's small versus larger cars.
So would you say that India has graduated to become a large car market from a small car market?
No, I wouldn't say that. I think in smaller cars also, if there are products that come out at a very high quality, then people will buy those. I think it's a trade-off between what you get for a certain price, and that's really what's driving it, I believe, at this point.
Yeah. Tushar, I'll just build a little bit on this question and then answer your other questions. So, like Anish said, we want to have the right products for customers, and hence we've defined our metric as revenue market share, so that we're not necessarily forcing ourselves to play into a segment where we may not have a right to win. So really everything that we make is what we believe should be highly differentiated and should create great value for customers, and which is why our average selling price is much higher than most of our other players, which is what makes us comfortably revenue number one in SUV. So that's really the goalpost, and it stays as that. We haven't seen that much of a slowdown in urban, though there is no doubt that the urban economy at this moment is much tighter. There are many enabling factors in rural economy, as we are seeing in the tractor rebound. We haven't yet started seeing that, as we said in the past, in LCV less than 3.5 tons. So there we have 60-65% of our portfolio is rural, but we haven't really yet seen the industry. Again, you saw in Q4 was a negative growth industry. So hopefully in the year F26 we will see the LCV industry rebound. We're projecting high single-digit growth for LCV less than 3.5 ton industry for F26. But you are right, overall there is urban demand stress at the moment. To your question on trade deals, I don't think that's actively under discussion right now with either Australia, that part of the world, Australia, New Zealand or South Africa. The priority is North America and EU. At this point of time, we have no plans to go to North America. We do have a plan to go to EU with our electric vehicles at some time in the future, as we've shared, but that will be in a calibrated way. Like we've said, we will do right-hand drive EVs first and then do left-hand drive, so we are a while away. And of course, based on what gets negotiated through the EU agreement, it will facilitate us to make in India for the world. Anish, want to add something on the last?
Shahar, you had a question.
Hello, hi. So you just talked about the growth.
I'll come back to you, Tushar. I'll answer both those questions. Yeah, good. Sorry. No, that's okay. That's okay. We'll come back at the end.
Yeah, you talked about the growth gems. You talked about the new platform which is coming up on 15th August and again the capacity expansion. So just wanted to understand from your side, what kind of capex or investment are we looking at for the next 3-4 years? Is it part of the guidance which you gave like earlier, or is there any change which has taken place now?
And on that note, let's welcome our guest for today. Joining us today is Sharmila Joshi, founder of sharmilajoshi.com, as well as Amit Bhuptani, derivatives and technical research analyst at Nirmal Bank Securities. Sharmila, I'll come to you first. You had the Eminem numbers come out. What's your first take from how the quarter went by?
Well, more than the quarter, I have frankly a longer term view on the stock, and which is positive. So yes, I think numbers, we do know what has been happening with the sector over the last couple of months, and I think in that sense, their numbers are good given the environment that they are operating in. But I think, going forward, their offerings and waiting for their electric car, the margins the stock is trading at, all those things make the stock quite attractive to me from a longer term basis. And as a disclosure, I own the stock.
Got it. And Amit, I'll also come to you. Before we cut to the Eminem presser, we were talking about SBI and its numbers. But on the charts, how does the State Bank of India look to you?
Currently, if you look at the overall setup of the SBI, the stock is having support at 770 level. There is a situation like it will be a buy and dip strategy we need to maintain in this counter. The confirmation for this counter comes only above 798 level, where we are witnessing the 200 DMA resistance is also getting placed. So once if it gets traded about 798 level, then only new long need to be created, or else wait for the dip towards 775 to 770 level. At that point of time, we can create new long position, and once the stock manages to hold the support of 770 level, then a good reversal will be witnessed in the stock.
Right, another counter that has been in focus is Marico on the back of the Q4 numbers. Let's get in Mahima with more details on how the company fared and in fact what the brokerages are saying on the fourth quarter numbers.
Right, so in terms of Marico, numbers were largely in line. There has been a double-digit revenue growth. This was a volume-led growth of around 8%. Foods and digital first brands were something that has really picked up and what aided the top line. Copra inflation, of course, remains a key thing to watch out for because that creates pressure on margins still. In terms of numbers, revenue was up 20-odd%, EBITDA was up 4%, margins came at 16.8%, PAT was also aided by other income which was up around 8-odd%. The company did declare a dividend of 7 per share. In terms of segmental performance, core businesses was where volume growth was muted. Growth in Parachute, Saffola and value-added hair oils was led by pricing. New businesses grew by 40-odd%. India business volumes grew by 7-odd%. International business grew by 11%, and home and personal care business saw double-digit growth. In terms of outlook, the management expects a double-digit growth in FY26. Pricing-led growth in first half will continue for core businesses. Food business will grow at 25%. Foods and premium personal care to account for 25% plus of the business by FY27. They expect double-digit EBITDA margin in digital first business, and management also expects digital first portfolio to scale by 2.5 times. Average revenue rate by FY27 for Beardo is set to reach in terms of double-digit margins. In terms of brokerages, Jefferies has maintained buy and hiked the target price to 800 from 780. They believe Q4 was a reasonable outcome and India volume growth appears impressive in the context of a tough macro. Macquarie has again maintained outperform and hiked the target price to 790. They believe that 8 to 9% price hikes bodes well for Parachute. Continued steady recovery for value-added hair oils is seen, and confidence in food is reiterated, and FY27 digital brands growth outlook also raised. Lastly, Goldman Sachs has maintained buy and hiked the target price to 780. Q4 was a strong quarter driven by high growth business, and margins are likely to recover in FY26 but will be back ended. So this is the overall view as to how Q4 has panned out for Marico.
Right, and how are the Avenue Supermarts number? What stood out? I guess the margin was a big miss here, right?
Absolutely. So margins was a big miss here in terms of Avenue Supermarts, and overall EBITDA and net profit also did not meet the analyst estimates. And in terms of why margins contracted, of course, competition going up for the counter, which is putting pressure on the margin because of higher discounts. In terms of the numbers, revenue was up 17-odd%, EBITDA up 1.2%, net profit declined by 2-odd%, and margins stood at 6.4 versus that of 7.4%. So 100 basis points downtick was seen in margins. In terms of key metrics, like-for-like growth, however, stood strong at 8-odd%. Revenue per square feet rose by 3-odd% despite of the higher store additions that took place in this quarter. Bill cut per store increased by 3-odd%, and overall average bill size remained flat. DMart Ready grew by 23-odd%. Management did allude to the fact that higher growth in home delivery is taking place and losses in online will continue in FY26 as well. In terms of store additions, as I mentioned earlier, they opened 28 new stores, taking the store count to 415, and this is the highest ever store addition in a single quarter. DMart has seen a 22% YOY growth in terms of its store addition as well. In terms of commentary coming in from management, it's on a negative note. They indicated pressure on gross margins driven by higher competitive intensity. They are seeing a surge in wages due to demand-supply mismatch, which will impact the margins going forward as well. Seeing better growth in tier 2 towns and seeing relatively higher like-for-like growth where stores are fewer in terms of cities. In terms of brokerages, Citi has maintained sell and cut the target price 3250. They believe Q4 was a double whammy of competition on gross margin and OPEX and expect revenue supermarts to turn into net debt from net cash for over the next 2 to 3 years. They seek a better entry point in terms of valuation and risk reward seems unfavorable right now. Lastly, Jeffrey on Avenue Supermarts maintained hold and cut the target price to 4,100. Margin came as a big negative surprise according to them, and they trim EPS estimates by 4 to 7%. So this is the overall view as to how Q4 has panned out for Avenue Supermarts.
Right. Coming to you, Sharmila, first on Marico and DMart numbers. DMart, in fact, Q4 margins were how are you seeing the company recover from here, or on margin pressure would continue even going forward?
Do you want me to talk of Marico or DMart?
First DMart.
DMart. Yeah, so I think, the case here is precisely how you all have outlined it. It's basically the pressure that you're seeing on margins and the increased competition. And there was a time when even at this valuation, the stock was perceived to be reasonable because you are, the growth expectations were so high. But now in this new light of the kind of competition that you're seeing, as well as the management itself sounding a little negative on how margins could be going ahead, the stock seems a tad expensive. But I would still say that let's wait and see how the monsoons shape up and how they really address these issues of whether they kind of pivot and move more towards tier 2 cities and how they take their business forward. But certainly at this valuation, the stock.
Right, right. And what are your views when it comes to Marico? Sharmila, your views on Marico?
Okay, talking of Marico, I think here things are a lot more upbeat, simply because, first of all, I think right out, as you all mentioned in your commentary, in a challenging sort of macro environment, they've delivered good numbers. Again, there is sort of new businesses, those look to be very attractive and they look like, they're going to be more active going ahead. That's always a good sign. Again, I think valuations look a little expensive. But given the fact that, the commentary is so positive, as well as the fact that, volume growth was strong, we are moving into a monsoon and, demand picks up during these months. I am a lot more positive on Marico, and I would think, targets of around 810, 820 are possibly that.
Got it. Thank you for that coming by. Another stock that I want to highlight is a Gravita India. Now, it's gained over 6% after a strong Q4 as well as a very positive long-term guidance. Now, revenue was up 20%, EBITDA up almost 28%. Margins have expanded a bit, 8.9% versus 8.4% a year ago. And we've also seen net profit growth of 38% this quarter. Even in terms of the EBITDA per MT, which is the unit EBITDA across their lead, aluminium segments have seen strong growth, whereas the volumes have also seen a steady uptick during the financial year as well as the quarter. But something that was highlighted was the FY29 outlook. The company aims for 25% volume CAGR, 35% profitability growth on the bottom line, 25% of ROIC, as well as 50% contribution from value-added products, which is one of the key factors that aided their margin growth for Q4 as well as FY25 was more of this, this vertical contributing. And on that note, Amit, I'll come to you. Something like a Gravita India, how does that look on the charts?
If you look at the overall setup on the monthly chart, the stock is about to give breakout at 2050 level, which is the downward sloping channel breakout. Also 200 DM resistance come at 2050 level. So currently the major breakout which we will witness in this stock is 2050 levels. About that we will see the fresh buying initiation in this counter. Currently if you want to trade on the momentum front and the short term front, once the counter again gives a breakout about 1950 level, 1950, then after that we can play for 100 points trade on the upside level, but at this point of time we should wait for 1950 breakout.
Sharmila, I also want to come to you on something like an HPCL. It's up 6%. It's slated to even post its earnings for Q4 tomorrow. And the current oil price environment is fairly positive for oil marketing companies. And any outlook on this space?
So, this is typically a space that I don't like much, very honestly, because I think that even when the factors are in favor of them, as you were stating, we find that, I find that some of the other tax comes and that sort of takes away from their profitability. So while we are, because this is this whole sector is so tied in with your inflation that prices are never really allowed to go up or go down too much, and they are pretty much to stay on a middle path. So we've never really got the benefit of lower prices. So I've really steered clear of oil marketing and whether it is upstream, downstream, and looked at other sectors too.
Yeah, fair enough. But thank you, Sharmila, as well as Amit, for joining us today and helping our viewers get a better understanding of the stocks that we spoke. And, let's just take a quick look at how markets are faring right now. The Nifty 50 up about 0.4% in trade. If you look at some of the sectoral, if you look at this, the sectoral movers, Nifty Bank, Nifty Finance, and the Nifty PSU banking space are the three that are under pressure, as well as the Nifty Private Bank. Something that's doing very well today is a Nifty Oil and Gas. You've seen an Adani Total Gas with the Adani entire pack up 10%. HPCL, IGL, BPCL, IOCL, MGL, all of these counters, your oil marketing companies and your gas companies, have seen gains of over 3% in trade. This is followed by a Nifty Auto, which is up 1.2% right now. You have 12 counters in the green, a Samvardhana, which is up 3%. Also some strength in something like a TVS Motor, as well as an Eminem, which has gained 2% post its earnings. Lastly, let's just quickly look maybe at a Nifty Small Cap 250. You have 168 small cap in stocks that are advancing versus 75 declining. RR Cable up 14.4%. We also spoke to this management right today, and you can catch the entire conversation on our YouTube channel as well. Easy Trip Planners up 11%. You also have another cable and wire counter, Finolex Cable, which is up 7.5%, followed by Motilal Oswal, which is seeing gains of almost 7% as well. On the losing end, however, you have something like a Jindal SAW, KFin Tech, and Aether Industries, which are seeing cuts of 3 to 5%. But moving on, the DPAM Secretary Arunish Chawla, in an exclusive conversation with NDTV Profit, said that the IDBI Bank stake sale is on the divestment. Is on track, and the things will be strategically divested. Do listen in.
IDBI disinvestment is on track. Government has taken a decision. It is publicly announced that we will strategically disinvest 30% of government stake and 30% of LIC stake to a strategic investor through a fair and open process. It's a complex, multi-stage, multi-layered process. We are working day and night and taking it forward. The data room has been established. The due diligence is being done. The share purchase agreement is being negotiated. And as it moves on, you will get the fair, correct news at an appropriate time. And I must emphasize that such decisions are not affected by macro shocks in the market.
Okay.
This is determined by a fairly well-calibrated, well sequenced disinvestment strategy, and we are committed to implementing the government decision transparently and expeditiously.
But sometimes, just for understanding, macro shocks like external headwinds, the tariff uncertainty, do have an impact on the valuation.
Yes.
Are you concerned about that?
Both yes and no. You see, what happens is if you approach the markets with a trader's mindset, then you are obsessed with long and short positions. But if you believe in the markets with an investor's mindset, and you are there for the medium and long term, then you know how to ride over these shocks and ride through them. And a fair dividend strategy achieves precisely that. It is to give comfort to small investors that your returns will come no matter what the market conditions are, what the shocks are.
Mm-hmm.
And I would urge all fund managers, I would urge all those who have demat accounts, all those who are small investors,
Mm-hmm.
to always put some public stocks in your portfolio.
Mm.
It will help you.
Mm.
It will give you a consistent, sustainable, fair flow of dividend incomes.
Mm-hmm.
It'll make you a participant in the value creation strategy of public enterprises.
Mm-hmm.
In their capex plans, which we monitor very, very carefully
Mm-hmm.
and rather aggressively.
Mm-hmm.
So, you have reposed your faith in us,
Mm-hmm.
and we are appreciative and careful about that.
Apollo ties. Now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Apollo ties. Now there's a buzz of a positive corporate development related to one.
and welcome to NDTV Profit. You're watching Profit Top Trades. I am your host Varsha. With me is Anushi Wakharia. Well, NetWeb is key focus today, as on the back of Q4 numbers that the company has put in. Very good set of numbers. Let me just read out for you. Revenue was up 24%, while EBIT was up 38%. Margins were at 13.6% versus 12.2% last year, and net profit was up 42%. Well, pretty good set of numbers. But what was good in this quarter? What went wrong in this quarter? Just to speak about that, and what is the growth outlook when it comes to FY26 and future years, we are here joined by Mr. Sanjay Lodha, who is Chairman and Managing Director of NetWeb Technologies. Hello, Mr. Lodha. Welcome to the show. Well, good set of numbers by NetWeb. Just wanted to have an update. What were the growth drivers behind the solid numbers that you have given?
Thank you for the opportunity. So basically, this is the eighth quarterly result which we have published after listing. And if you see consistently, we have shown consistent growth quarter after quarter. Every time we have grown by around 35 to 40%, which we have committed. And we have still, the same momentum has been going on basically quarter by quarter actually. And basically because this reason is because all the three areas we are into, we are very, very focused. We are fully integrated company actually, wherein all our products and solutions, we basically design our hardware, we manufacture our hardware, we have our own software stack. So basically that actually helps us so as to increase our penetration. All the three areas we are there, all the three areas are high-end computing areas like supercomputing. Supercomputing constitutes around 35% of our business, and it has been consistent over a period of basically last maybe 10 quarters approximately. The second area for growth is private cloud and HCI. How data center industry is booming. So basically that is helping us so as to keep our growth momentum there. That is also 35% of our business. And AI is the third pillar for us, which is basically around 15% of our business. By year end, we feel that since the lot of momentum we are seeing on all the three segments, but AI definitely we are seeing a lot of more momentum. So we feel that it will reach around 18 to 20% by the year end. So we are basically the total, if you see the total revenue and all, primarily it has been a good quarter, and always our Q4 is always good. And basically primarily because our customers are basically primarily large enterprises and large government enterprises. So primarily around 50% of business comes from the government, 50% of business on an average from the large enterprises actually. So the momentum is still going on, and basically we are seeing the current trend also for this year also. I see a very robust funnel. Basically, we have a funnel of around 4,000 crores on which we are working. And basically, as you know, we are a proactive company. So we are not reactive on our products and solutions. So definitely, basically on all the deals and all, we personally feel that basically the new financial year which has begun now, we'll all be able to achieve around 35 to 40% growth without any problem.
Okay, so Mr. Lodha, this is Anushi joining in. You've mentioned about a 35 to 40% of a growth for the upcoming fiscal. Now, considering what we've seen in the past 3 years, we are looking at an average CAGR of around 60%. So, what do you understand from this high base that we are seeing? This revised guidance that we are seeing, what are the key growth levers that is leading to this kind of an upside that we are seeing? You've mentioned about AI contributing to a bigger chunk going forward. This export also, if you can give us more details as to why we are looking at a 35 to 40% of a figure going forward.
Yeah, actually, this is a very, very predictable kind of a business. You see basically how supercomputing is evolving. Okay, we are a very uniquely positioned company. Basically, we don't have any domestic competitors primarily, or our competitors are MNCs actually. Wherein basically, so the supercomputing industry is growing. Adoption of supercomputing is increasing from R&D into various kind of enterprises, and also supercomputing, the growth is already there. We did installation for Vikram Sarabhai Space Center, which is the largest supercomputer for ISRO this year. Same way, basically, we see the same momentum going on the supercomputing side. The second segment we are into is private cloud and HCI. There again, basically, we have a very unique proposition with a hardware and a software combination. And I have not seen data center growing in India better than currently how it is happening in my 20 years of business life. So basically, that will be fueling the private cloud and HCI. So basically, it will remain around 35 to 40% of my total revenue pie. AI, we have been into basically AI since the year AI became popular now. But we started working with GPUs and all way back in 2010. So we have a complete stack there. The new product which we have launched is Kailas.ai, That's again a basically very, very innovative, and that helps so as to basically optimize and use the AI ecosystem. And India is poised to become the AI factory of the world. So that will be again a very, very great growth driver for us. So all the three areas we are into, these areas we have not started just yesterday. All the areas we are working in it for a very, very long period. We are very well experienced. Our team has grown. Our R&D basically team has been really very, very steady and quite good. We have 100 plus people into the R&D teams now, both in software and hardware R&D. We are one of the major design partners, manufacturing partners for NVIDIA. There are very few in the world. We are working on the latest architecture for GB200 and all. So we have a couple of very good things actually happening. And the market momentum and the kind of demand pull which we are getting completely gives me the conviction to maintain, because my earlier guidance was also 35 to 40%, and I will like to maintain the same kind of guidance.
Understood. Mr. Lodha, let us speak about the export segment that you have. Currently, I think it contributes almost 9% to the overall business. I just wanted to know where you want to take this contribution to, because considering the exports have higher margins, will your margins go back to 15% that you used to enjoy?
Yeah, so basically, actually, you can see export was something new which started happening from this current financial year. So basically, it is around 9 to 10% or 8 to 9% of my total business. I personally foresee, because we see a lot of good domestic demand as well. So basically, I would like to guide that the export will remain around 9 to 10% of my total business in the current fiscal also, because basically all my products and we don't sell to any SMBs and small businesses, primarily all are large enterprises. So support ecosystem and everything is required for exports, and basically whoever is buying, we want our customers to have a very good experience. So we want to go a bit slow on that and go gradually into that market. So around 8 to 10% of market basically exports, which will be hitting in the current fiscal also. And basically, the domestic market growth is also phenomenal. So I think comfortably we'll be maintaining the same kind of standards. And as regards margin is concerned, margin basically we have always said that it will remain around 14%. So that is there. It can be a little bit up, few basis point up and down, but my guidance will remain the same actually.
Okay, so 14% is the kind of mark that we are looking in terms of where the margins are concerned, and exports to remain at the 8 to 10% of a bracket going forward as well. Understood. Now, considering the order book picture, if you are seeing now, you have an order book of around, order pipeline of around 3,970 crore. Want to understand from this, where do you see the current order book which is there at the end of March 25 to March 26, let's say in this 1 year period, where do you see this order book ending up at? What's the kind of order pipeline that you have, the success ratio in that, if you can give us more outlook about the order book going forward?
Great. So very good question actually, ma'am. Actually, really speaking, our kind of company, it's very difficult to gauge in the terms of order book. Order pipeline makes more sense for us, because if you see my December quarter, my order book was somewhere around 350 crores, wherein we did around 440 crores. The reason is basically my order closer from order to order closer is only around 8 to 12 weeks. Okay, so basically that will not give you a very fair idea about how the business is growing. But the business, you can get the very good fair idea from the business pipeline. Business pipeline is around 4,000 crores at this point of time. And we have a hit rate of around 60% out of that. Okay, and basically it takes around 6 months to a year approximately for closure and all those kind of things. So that gives me a very robust confidence, the kind of growth numbers which we have delivered and which will be delivering in future.
Okay. Also, you have almost 180 crores of cash, sitting on the balance sheet as of March 2025. Just wanted to understand any kind of inorganic acquisition that you are eyeing for?
Yeah, actually, we are definitely scouting for good opportunities actually, wherein basically some kind of acquisition which can really speed up our R&D process. If we can acquire something which can really speed up our R&D process actually. So we are looking for something, but it will be only very, very strategic, and those kind of things we are looking into. So that has been there on our mind for approximately more than last year also. This year also we have that target, but once we have that, we will definitely announce it to the market.
Okay, interesting update that we are seeing in terms of it. There could be some possible acquisitions. My final question to you, Mr. Lodha, would be also on the AI mission. Now, you've spoken enough about AI and how that is going to contribute, but are we looking at more inquiries as we move forward to FY26? There were some expectations of RFPs also with the AI mission in place. So just wanted to get an opportunity size of this particular area that we are looking at.
Yeah, so you know that government's focus has been very, very phenomenal on the AI thing, and the government is doing the right thing. So basically, India became the software powerhouse of the world. Same way, India government wants to create basically India the AI factory, because that will really help to boost the employment and everything. So there is enough focus from the government side, and basically we are all being an NVIDIA partner, wherein we are trying to manufacture on the latest technologies, so we can offer all Make in India products and solutions. So all that is in that direction. As regards the RFP process, the government is in process of doing that. We are expecting the RFP2 should be out very soon, wherein basically government themselves will be trying to basically implement a large kind of AI cloud, which can be given to various researchers, developers, startups, and all that, and for the different regions. So that is definitely there. That is the target, and the total outlay there was somewhere around 10,000 crores. We personally feel the RFP in totality should be around 3,000 to 4,000 crores.
Okay, well, thank you, Mr. Lodha, for joining and sharing your perspective on how the quarter and the year was for NetWeb Technologies and the outlook forward. Once again, thank you so much for joining it. But let's talk about markets now. Let's have a quick check on how the markets are doing currently. Now, if you look at the benchmark indices, firstly, let's pull up Nifty 50, currently seeing in the green, seeing gains of around 0.5% over here. Not much of an activity that we are seeing in the last half an hour or so. At the levels of 24,475 is what we are looking at for Nifty 50. However, it's the Nifty Bank which is under pressure today. Nifty Bank down about 0.25%. Now, if you pull out Nifty Bank top constituents, we have seen results of various companies over the weekend. Kotak Mahindra and SBI Bank, some of those counters which were in focus today post their fourth quarter earnings. Let's also pull out the point contribution table to see how the overall Nifty 50 is panning out to be. Kotak Mahindra Bank, in fact, we are looking at cuts of around 5%. So in the red, we are seeing something like Kotak Mahindra Bank, SBI, Axis Bank all under pressure. While in the green, HDFC Bank, Eminem just reported its fourth quarter earnings a few hours ago. Adani Ports is another counter seeing gains of around 8% in trade today. So that's as far as where the point contribution table is concerned. Let's also pull out the sectoral indices to see how that is faring up. So in terms of where the sectoral action is concerned, we are looking at almost a sea of green. Nifty Bank being the outlier here. Nifty Bank, Nifty Private Bank seeing cuts of around 0.3% and 0.7% over here. Nifty Auto up around 1.7%. So so that is something in focused. Nifty Defense, another one of those counters, seeing gains of around 1.6%. So this is where the sectoral indices concerned. Quickly moving to the broader market, if you are looking at Nifty Midcap 150, broader markets performing fairly better. We are seeing gains of around 1.4% for Nifty Midcap 150. Nifty Small Cap 250, we are looking at 0.8% of gain. So this is how the overall market picture is building up currently. But to talk more about this, let's welcome in our guest for today. That's Gaurang Shah, Senior Vice President of Geojit Investments. Firstly, Gaurang, welcome to the show. Your quick check and quick assessment on how the markets have been.
So thank you very much for having me on the show. Good afternoon to all of you all. Resilient is the word. I think I won't be wrong using that. Given the kind of backdrop of events that we have lined up earlier, we were just getting out of the tariff shock, and then of course the unpleasant, unfortunate and a misadventure across the border from Pakistan in form of terror attack in Pahalgam, J&K, and market awaits in which way, what manner, to what extent, how and when will India retaliate to what has been done in form of cross-border terrorism. Having said that, I think good part is that numbers, whatever we've seen up till now, they were more in line with expectation, barring 1, 2 or 3 companies, a shade better than what corporate India delivered in Q3. I think Q4 was a shade better. In terms of lower crude oil, multi-month low crude oil prices, again a positive. Rupee gaining strength against the dollar, close to about 84.35, 84.50, again a positive. And my sense is that the from sell side, domestic, my bigger pardon, foreign institutional investors have turned net buyers for the last couple of days. I hope it stays that way, but the clear and present danger is in form of how India retaliates to Pakistan.
Right. Thank you, Gaurang, for that view. Well, Eminem is in focus after the company announced its earnings with financials mostly in line with estimates. Puneet joins us with more details.
Well, thank you for that. So results largely in line with estimates for Mahindra & Mahindra. Actually, the revenue growth has come in higher for the company at roughly 25% growth. 31,608 is what they've reported on a standalone basis. This is versus estimates of about 30,024 crores. So definitely a big beat there. The EBITDA is up 35% with the overall margins coming in at 13.4%. versus 12.4% the same time last year, so a big beat there. Although the estimates were of 14%, the revenue growth actually has been higher, and hence that margin percentage, while has not met estimates, but numbers were pretty good for the company. Net profit up 19% at 2,437 crores, again meeting estimates of about 2,490 crores. When you look at the segmental performance, the automotive margins for the company have come in at 9.2%. This was roughly 9% the same time last year, while the tractor business, which is the farm equipment business, has reported 19.4% margins versus roughly 15.8% the same time last year. So another big beat on the tractor segment. In this particular quarter, this was supported by strong sales for the company. In terms of passenger vehicle sales, the four-wheeler car business has grown 18%. At 1.49 lakh units in this particular quarter. This is versus 1.26 lakh units, while the tractor business has shown at 88,000 units versus roughly 71,000. And the company also just concluded its press conference right now, and they did emphasize that they are seeing a mid to at least a high single-digit growth in the tractor business, and essentially in the passenger car business, they are looking at a mid double-digit growth. So definitely somewhere in the 13 to 15% range. For this year, it's actually grown at 20%. So while the growth will moderate slightly compared to the FY25 numbers, but that's a very high base. Overall, the results were largely in line, and they have also mentioned that they've sold roughly 6,300 electric vehicles. So overall, in this particular quarter, results largely in line, and estimating a strong growth compared to industry in the next year as well.
Right. Thank you, Puneet, for all the details. Gaurang, so inline numbers that we are seeing, how are you reading the numbers, and is it right time, to enter the stock?
So, Varsha, I think in some places the numbers were better than what we had anticipated for Eminem, and that's a good sign. And as your colleague was just referring to the breakup of the consolidated business, I think our sense is that it is one of the most strongest plays in terms of diversified product offering that they have. Whether this is the right time or not, honestly, I can't answer that. But I think if you're a long-term investor, for companies like Eminem, you should not waste your time trying to find the right price and time. Take a step forward and start getting invested would be a better strategy. Don't put all your money at one time. Don't go all out. Stagger your investment in large cap companies like Eminem over a longer period of time. And as and when you get dips, because we are facing uncertainty, so use those dips as an opportunity to accumulate the stock.
Right. So stagger your investments is the view coming from Gaurang. Well, next few stocks which are in focus on the back of earnings. Let me start with RR Kabel, wherein good set of numbers overall. Revenue growth was led by strong growth in their core wires and cable segments, and the margin uptick that you are seeing was due to operational efficiency, which led to the margin beat. And they've also approved capacity expansion at one of their plants with investment of rupees 1,000 crores. So good number coming up there when it comes to RR Cable. The stock is up almost 17%. Next on my list is Gravita India. Again, good set of numbers. The growth was led by strong demand across its lead, aluminium and plastic recycling verticals, and also higher volumes and value-added products aided margin for the company. So margin, if you're seeing, margins were at 8.9% versus 8.4% last year. EBITDA was up almost 28%, and they've also given their FY29 outlook, wherein they aim for a 25% of volume growth and 35% of profitability growth that they are expecting. And also they are expecting 50% contribution from value-added products, which I'm assuming will help to aid their margins. Well, the stock is up almost 8%, 7.2% in trade today. Well, Gaurang, Gravita and RR Kabel, both the stocks or both the companies have given good numbers. What's your pick?
Well, honestly, so RR Kabel, if my memory serves me right, the company came out with an IPO in September of 23. and the shares were given out at a higher price band, about 1036, if I'm not mistaken. We like the sector. That's a disclosure from our side. We had given a subscribe to the IPO of RR Kabul at that point of time. But in terms of coverage, clear competitive company, KEI Industries is what we like. Would like to make viewers of NDTV Profit aware that there is a huge competition that is likely to come up in the next couple of years, given the kind of opportunity that this sector throws it open to. And I would also like to add that there is more room for more players to come in. It is not like if the new competition comes in, the existing companies will have a huge business loss. No, absolutely not. So we are positive. RR Cable is a very strong and fundamental strong sound company. In terms of preference, KEI Industries would be preferred. Gravita India, I think, again, one of the strongest performers in terms of numbers in its sector, and quite a promising company.
Okay, so KEI Industries, a preferred pick in cable and wiring segment, is something that we should be eyeing out for. And of course, there have been increasing discussions about the increasing competition in the cable and wiring industry that we've seen, especially after the new entrants that we've seen. But another company to be focused in is something like an Avenue Supermarts, and this is after the company reported its fourth quarter earnings, where we saw revenue up around 17%, but the net profit, however, was a disappointment with a fall of 2%. My colleague Mahima is standing by with more details on this.
So in terms of Avenue Supermarts, both EBITDA as well as net profit were a miss in terms of analyst estimates, and in terms of margins, they further contracted on the back of higher discounts and competition intensity going up. In terms of numbers, revenue was up 17%, EBITDA was up 1.2%, margins did contract to 6.4% versus that of 7.4% earlier in the same quarter, and net profit was down 2%. In terms of key metrics, like-for-like growth, however, was strong at 8%. In terms of revenue per square feet, that also rose by 3%. The average bill size remained flat, however bill cut per store increased by around 3%. In terms of DMart Ready, the growth was strong here. 23% YOY growth was seen in DMart Ready. Management did allude to the fact that higher growth is coming in from home delivery, and losses in online, however, are set to continue in FY26 as well. In terms of store additions, around 28 stores were added this quarter, and this is the highest store addition in a particular quarter. DMart had already done 22% higher store addition versus last year. In terms of commentary coming in from the management, they've indicated pressure on gross margins driven by higher competitive intensity, seeing a surge in wages due to demand-supply mismatch as well, seeing a better growth in tier 2 towns, and also seeing a selectively better and higher like-for-like growth in cities which have fewer stores as well. So Avenue Supermarts, in terms of margins significantly contracting, and of course management commentary not being on a positive front, the stock might see some kind of a downtick in trade today.
Of course, Avenue Supermarts seeing cuts of around 1% in trade today, but something to be focused on is also Blue Smart drivers protesting yesterday at the Jantar Mantar in Delhi against as Gensol Engineering's case unravels. We have Aishwarya with more details.
As the crisis of the beleaguered Gensol Engineering unfolds, the Blue Smart drivers have been the casualty and have been at the receiving end. Here at Jantar Mantar today, drivers from Blue Smart, both female as well as male drivers, are protesting and are asking for their rights and certain demands. We're being joined here by some of the representatives from Blue Smart, their union and association that some of them have formed. Mr. Kamil is here, as well as Mr. Tejinder, who have been representing the union very actively on the front. हमसे बात करने के लिए बहुत धन्यवाद. सबसे पहले अगर आप हमें बताएं, संक्षेप में अगर बताएं कि आज का जो प्रोटेस्ट है, कितने अफेक्टेड दिल्ली एनसीआर रीजन के कितने ड्राइवर्स हैं, और आज के प्रोटेस्ट के बारे में आपका क्या हेतु है, उसके बारे में बताएं.
देखिए, हमारा जो प्रोटेस्ट का आज यहाँ पे जो हमने किया है, उसका मेन उद्देश्य है कि जितने भी हमारे ड्राइवर्स हैं जो अचानक बेरोज़गार हुए हैं, उनको कोई ना कोई रोज़गार का साधन मिले, और कंपनी के कानूनों में संशोधन होना चाहिए कि अचानक से किसी भी रोज़गार करते हुए ड्राइवर को एकदम से नहीं निकाला जाए. कम से कम 3 महीने के उसको सैलरी दी जाए या नोटिस एडवांस दिया जाए कि भाई हम 3 महीने बाद कंपनी को बंद कर देंगे, आप वहीं और रोज़गार ढूंढ लें.
अप्रैल 16 को जैसा आपने मुझे बताया था कि आप लोगों को सबको नोटिस दी गई थी और कहा गया था कि अभी के लिए ऑडिट चल रहा है, तो उसके बारे में, उस इंसिडेंट के बारे में बताएं। और क्या अब कोई उसके बाद में कोई रिस्पांस आया है कंपनी की तरफ?
जी देखिए मैम, अभी तक तो कोई रिस्पांस नहीं आया है, क्योंकि 16 तारीख से जैसे ही इन्होंने हमसे कह करके ब्रेक डाउन लगा करके हमारी गाड़ी इन्होंने हमसे खड़ी करवाई है, तो उससे हमें अभी तक कोई भी किसी भी तरीके का कोई मैसेज नहीं आया है। इन्होंने हमसे कहा था कि अभी 2-3 दिन का अभी हमारा ऑडिट चल रहा है 59 सेक्टर के अंदर, जो इनका बड़ा हेड ऑफिस है, वहाँ पर इनका ऑडिट ख़त्म अभी तक हुआ नहीं है और 20 दिन हो चुके हैं और हम बेरोज़गार हुए पड़े हैं। मैम इन्होंने ना ही तो हमें कोई नोटिस दिया कि भाई आपको हटा दिया गया है, नहीं, इन्होंने एक व्हाट्सएप पे भी और एक हमारा ऐप ब्लू स्मार्ट का ऐप है, उसमें भी इनबॉक्स में एक मैसेज दिया है कि आप अभी हमारा वो चल रहा ऑडिट चल रहा है, तो 2-3 दिन के अंदर ऑडिट जैसे ही ख़त्म होगा हम आपको वापस बुला लेंगे। लेकिन मैं यही पूछना चाहता हूँ मैम, आज 20 दिन हो चुके हैं, क्या वो ऑडिट अभी तक ख़त्म नहीं हुआ? हम ड्राइवर ने ब्लू स्मार्ट को एक छोटे से पदके से लेकर के इतने ऊपर पहुंचा दिया, तो क्या आज हम ड्राइवर इनों के लिए इतने बुरे हो गए कि आज हमें एकदम से नीचे ला करके पटक दिया?
मैं सिंगल मदर हूँ।
Well, that's the update on the Blue Smart. But let me first thank to Gaurang Shah, for joining this conversation. Thank you, Gaurang. And viewers, this is all the time we have on this edition of Profit Top Trades. Stay tuned for India Market Close.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. Now, in terms of where we are on the Nifty, we're 0.5% higher, so doing fairly well for ourselves. Let's look at it intraday as well and get a perspective on how we've done. Pretty range-bound day of trade that way, as you can see. We've been in a very, very narrow band, around 120 odd points, and we're smack in the middle of that at this point. Not well off the lows and decently off the highs as well. So that's how it's playing out. Let's look at the Nifty 50 heat map, and within that you see some of the Adani stocks doing well, 7% up on both ports and enterprises. Trent also doing very, very well for itself, 4% higher. Shriram Finance is the other one. Bajaj Twins also doing decently okay. So it's a fairly diversified setup, at least in terms of how the gainers are shaping up. Eminem doing well for itself on the back of those numbers. What's not doing well is Kotak Mahindra Bank, again on the back of numbers. SBI also on the back of numbers, slightly muted. Outside of that, you'll see some or very few names which are actually in the losers. There's good advanced decline, at least on the Nifty. The breadth on the Nifty 50 looks fairly good. Now let's look at the advanced decline overall on the entire basket, and that's how it's shaping up. Nearly 3:1, and therefore positive breadth. Let's look at the mid cap and small cap indices before we look at sectors specifically, and then probably take views on the index. 1.5% higher on the Nifty mid cap, so very strong. Nifty small cap also at the day's high, around 1% up on the Nifty small cap as well. So both the broader market indices outperforming the index. Let's look at it sector wise, and likely the one languishing at the bottom will be the Nifty bank, and especially the private bank, with Kotak as well as SBI being the key drags on both of those indices. We'll pull those up in just a minute, but look at the one which is really shining. The Nifty Auto is shining. Defense is doing fairly well for itself as well. FMCG is the other one, and we'll talk about some of these indices, and we'll talk about some stocks within them. What's doing okay is the Nifty IT index, around 1/3%, and the Nifty Pharma index around 0.7% or thereabouts higher. So largely those in line with how the Nifty is playing out. Let's pull up the Nifty bank first, and thereafter the private bank in terms of constituents, and just try and zoom in to some names which are doing well. A positive BOFA note, you saw IDFC first on the back of that. Even an RBL is buzzing on the back of that. Fed Bank doing fairly well, and HDFC Bank doing fairly well. But what's not doing well is, again, Kotak, SBI, the key drags. Along with it, ICICI, IndusInd also pulling the index a little bit. No real contribution from an ICICI. Let's look at the private banking index as well, and likely it's those same culprits which are pulling down the index on the Nifty private bank in terms of constituents. So, well, that's how it's playing out. Let's go across to Akshay Bhagwat, take a quick check with regard to how the Nifty is playing out. Welcome, Akshay. Good afternoon. I want to first, Akshay, ask you the call with regard to the index, because we've made a little bit of a move today. Last 2-3 sessions we were largely flat. Today we've made a little bit of a move. What's the direction looking like now?
So first of all, good afternoon. Well, see, the data points are all positive if you go by the derivatives reading. Even if you were to see at the FIIs how they are positioned in the market, still there are buying numbers. I believe that it's been 11 straight sessions of buying in cash market by the FIIs, 5 straight sessions of buying in index futures. So data points are positive. The only kind of slight area where there is confusion is the India VIX. That's the volatility index, which is above 18. It's been up for 5 straight sessions, and there is an indication that there is some fear in the system. Now, if you go by the technical parameters, clearly leaving aside the fear in the system, Nifty is all headed for upside targets of 24,800. That's the first level of upside you can look forward to. And 24,200 is the key support which you need to consider if you're a short-term trader. So till 24,200 holds, all is good. The markets still are holding strong, and there is a chance or high probability that Nifty should aim for levels of 28,800 plus.
The one piece today, Akshay, that's not looking as strong is the Nifty bank. What's your take there?
See, if you look at the way the positioning has been broadly for the Nifty Bank, Nifty Bank has had its fair share of run up in the last 1.5 month. In fact, it was the leader of the indices. Now, with Reliance coming back very strongly, a lot of IT names staging a strong bounce back, it is time where Bank Nifty components take a backseat and Nifty, takes the leadership. So clearly, that is what we are noting in the current market scenario. Bank Nifty, though the broader trend is strong, it is getting into a time correction where the prices may spend a major part of the time consolidating in a range. So I believe Bank Nifty is more of a laggard index here, but it is not weak from a positional perspective. The levels one needs to keep a watch on is a key support of 54,000 basis spot Bank Nifty and the upside of 57,000. Still believe that broader strength is still in the Bank Nifty. It is just that short term you may see slight fluctuations or range bound trading action within this price range of 54,000 to 57,000.
And Akshay, what's the take on Kotak specifically?
I believe the results are done for Kotak Bank. Initially, the reaction, what we see today is a gap down. And, it's just a reaction to the results. But if you were to see the longer term charts, Kotak Bank had staged a monthly breakout of a 4-year long range bound scenario. This breakout was noted roughly at the levels of 2000, 2050 odd zone. So in all probabilities, if you were to look at this from a technical perspective, there is a very strong chance that once Kotak Bank nears 204050 zone, there is got to be some buying demand back again. So downside looks cap 2040-50 is the zone to re-enter Kotak Bank. So buy on dips is what this recommendation is for Kotak Bank.
Interesting, a couple of percent, and that could well be a good buying point. Your picks for this afternoon, Akshay?
Yeah. So two trading recommendations from a short-term trading perspective based on the technical readings. The first trade is in the IT space. The stock selected is Tata Technologies, which saw a very strong momentum gain in the last few trading sessions. It's just that the last 5-6 trading sessions has seen more of a lull in trading, but a bullish kind of a flag and pole pattern, which we label in the technical parlance, is suggestive that the stock is moving for upside targets of 17,200. You can keep a trade stop loss of 16,220 on this buy recommendation. Second trade is Bajaj Finance. Again, the results have been done and dusted. I believe there is a stock split and a bonus announcement already made. Ex-date is not known, but this news makes it more lucrative, and the downside definitely is capped in the stock. You will see buying at all possible dips wherever you get, and 9250 is the broader target which you can aim for in Bajaj Finance with a stop loss of 8772.
Okay, so that's those are calls coming in with regard to Akshay's picks for this afternoon. Akshay, I also want to quickly have your view with regard to some Adani names, because plenty of them zooming in trade today. Quick take with regard to an Adani Enterprises and Adani Ports. Just talk to us about what's the price volume action and what are your views from a charts perspective?
Absolutely. If you were to look at the longer term charts, most of the Adani Group stocks were in a basing formation. It is that the stocks have come in the limelight today because of the strong intraday surge in price, which we have noted. Breakouts in most of the names, specifically talking about Adani Ports. Today, you have a breakout at the levels of 1280, which we saw in the opening trades. And this is more of a 3 to 4 month resistance break, which positionally from more than 1 month plus holding has the potential to go all the way up till its all-time high levels of 1580, 1590. So the technical parameters are really very strong. Volumes are supporting this breakout, and I believe this is a stock which you can kind of have a strategy of buy and hold for slightly longer targets, which is almost near the all-time high levels. Now, talking about Adani Enterprise, similar kind of a price structure, but the breakout which we saw in Adani Ports is yet to unfold in Adani Enterprises. Now, the resistance zone here would be 2610, post which we talk about the breakout. So right now, as the charts are setting up, the bottom of 2200 clearly is in place, and the prices should first make an upside for the key resistance barrier of the double bottom I spoke of, that is 2600, 2620. So the first target one should work with is 2620, and after that we revisit the charts and take a stance whether the breakout is happening or not, but definitely a positive stance. 2600 is the initial target I look forward to in Adani Enterprise.
And Akshay, you know, there are these clutch of stocks all within the wires and cable segment, a Polycab, an RR Kabel, a KEI. Any view with regard to those? Because one in particular really flying in trade today, which is RR Kabel.
Yeah. So yes, very rightly said that this sector is in momentum today. And first talking about Polycab, this stock is trying to get back its lost glory, because if you recollect, I think a couple of months back there was a severe gap down and a very strong selling which we noted on back of some negative developments in the company. But today, as we stare, most of the pain is already absorbed, and we are looking at levels of 5726 as we trade. So that's a really strong development going by the price action in the past few trades, which just is suggestive of a clear bottom of 5,000 being in place. Now this is more of a positional trade today, although there is momentum but I believe 6,400 is where the stock should head forward to in the short to medium term scenario. So those are the targets you can look forward to in Polycab. And talking about RR Kabel, this stock again, it's more of a stock where you ride the momentum. Majority of the gains have come in through gap up in the morning, strong volume participation, but really the risk reward does not favor fresh entry at the current levels. But broadly, if we were to look forward for targets, 1280 is the short term upside one can look forward to in RR Kabel.
Okay. Thanks so much, Akshay, for joining us this afternoon. We'll let you go on that note. Good getting all of those views, and that's of course a general market view along with certain names, and we'll continue to get you more views as we keep speaking to our guests. But it's time to speak with one company in particular, and we're speaking about SIS Limited. Let's pull up the stock. There you go. Not much of a reaction with regard to the earnings which came out Friday, but we have with us Dheeraj Singh, who's the CEO at SIS, to help us understand better as to what's playing out. Dheeraj, firstly, good afternoon. Harsh here. I want to first start off with the facilities management business, because that's contributing, or rather that's growing faster than your security business. Is that the outlook going forward as well? Do you expect that kind of a trend to continue to play out?
Facility management is a smaller base compared to our security. It is India's largest facility management company, but still clocking about 200 crores per month only. Market share varies. We are about, in facility management, 4%. In security, we are about at 8-9%. So there's a larger opportunity out there for the facility management side. Also, if you look at the range of outsourced services that fall in the facility management ambit, there is far wider scope. So anything that the client wants to outsource as a non-core activity can be outsourced to a facility management company like us. And we are taking more and more interesting solutions outsourcing for the client, right from off-balance sheet in their entire engineering assets, and then running it on a long-term lease basis. So it helps the client to preserve their balance sheet, deploy their capital in the core business. So facility management will continue providing such solutions, and the growth rate hopefully will be faster than the security segment.
Okay. And with regard to the security segment, what's the growth rate expected to be at with regard to that segment, and in cash management in particular? And we've spoken in the past, what's the likelihood of that business sustaining or growing materially? Because that's the one business which has had its set of headwind, at least perception wise, from the market and the industry.
I'll start with the cash business. So we've been growing at about 15% in the cash. We've crossed 700 crores of revenue for the cash business. with a very healthy EBITDA of more than 17%, even a PAT level of about 7%. What is interesting is that our cash business is very less dependent on the ATMs. And while the ATMs are definitely under pressure and there is less of activity happening at the ATM level, but the overall cash in circulation and our other value-added services, including all the banking outsourcing solutions, that continues to increase. So we are positioning ourselves like a proxy to the banking industry. Almost 16% of our business now comes from value-added services for the banking industry. And we want to continue this focus, which should keep us pretty insulated and actually provide a growth impetus for us together with the banking industry. On the security side, while we are at a large base, India's largest, but still the opportunities are huge. There are new sectors opening up. Also, we have recently announced, as you might be aware, our brand for Cisco. It is the alternative platform for our security business, where we are combining our earlier businesses, smaller businesses in security like SLV and Unique, and maybe some other companies that we'll acquire. Together, they will form this platform of Cisco, which will go after that very large pie that SIS security had not been addressing. And this pie is for customers who want more competitive and services that are more customized to them. And so Cisco platform will provide the growth for us, whereas the SIS security platform will continue to provide the higher margin. And this is the balance for security business that we see going forward.
Understood. Sir, could you talk to us a little bit more about the Cisco business? What is the current share in terms of revenue? How should one see it over the next 3 to 5 years? What's the kind of growth clip? What's the kind of base we're looking at? And what's the kind of mix in terms of revenue that we're seeing?
So Cisco business currently would be about 15% of our total security business in India.
Okay.
In a 5-year time period, we definitely see this to be about 30%. So we see the share in our own security business doubling for Cisco. And it is a pan-India organization now, where we've combined the earlier entities. And we will look to add more inorganically to this particular platform. We have missed out on the BFSI segment for the security business for a long time now as SIS security. That by itself is a very large market. Similarly for the retail segment or even the residential segment. So Cisco will go after all the other segments that SIS security had stayed away from. And the growth rate is going to be much faster. And Cisco is going to be a business with a much leaner SG&A structure. So it's a lean structure, more customized, more competitive for certain sectors that we are going after. And that is the balance. And we don't see much conflict of interest with the SIS security business.
What will be the margin profile of that business, sir?
It will be less than SIS security, no doubt. But because we are keeping a very lean SG&A structure, so there won't be too much of a difference. But they will gain a much higher operating leverage because of the growth, which will be higher than the SIS security. So on an average, we maintain that SIS security in total, Cisco as well as SIS main security business combined will look at a 6% EBITDA margin over the next few years.
So what should we expect both in terms of growth and margin on the overall business? It's that kind of setup where can we expect mid-teens kind of growth, or would that be pushing it too much? And what would the levers be to get you there?
No, you hit the exact number and word from my mouth. Mid-teen is what we would be comfortable in giving a guidance for. If you look at our past 7-8 years time, that has been our CAGR around the mid-teens. And going forward, apart from the overall GDP growth that we as the services businesses are a big beneficiary of, as people invest more in infrastructure or manufacturing, they come to us for all the services and security. Also, a market share compared to Australia, where as a market leader we are 22%. In India, we are only, as I said, about 8% security, 4-5% in facility management. So there's a market share expansion. And through our Cisco platform, we definitely will consolidate a large part of that market share. A lot of the labor reforms, which will lay stress on more compliance, making a real shift that we have been talking about for a long time, from the non-compliant to the compliant sectors. And companies like ours will definitely be a big beneficiary of that. And last but not the least, our strong shift towards solutions, and we are moving towards whether it's on the drone side, artificial intelligence, even robotics, we recently started. All of them together will position us as the high-end consulting partner for the security and FM business for India. So, summary of it, yes, through organic and inorganic selectively, we should be able to achieve our mid-teen growth, both for our EBITDA as well as for our revenue. And at the same time, we want to focus more on our return on capital. I mean, this March end, our return on capital is at about 15%. It is healthy, but our goal is to move towards 20% very soon, which we will then thereafter maintain.
Okay, and so what's been restricting growth in the last couple of years? So what's changed versus the last couple of years? You've obviously had new wins. Talk to us about those. What makes you confident of the mid-teens kind of growth? Because it's been a sluggish couple of years, and therefore I asked this question.
Yes, you're correct. I won't deny that. But that's largely because of our focus on the margin side, where we wanted to weed out a lot of the low margin contracts, contracts that did not meet our commercial terms framework. And we've cleaned out most of that as of now. We set up our Cisco platform to meet another target segment. So combine all of this, we are now in a far better position to target the growth side. And that is going to be the big change. That and our Q1 is already supporting that. The pipeline is very, very robust and strong. And that's for the India story. Internationally, we have secured 180 million Aussie dollars of new wins in this year, which has been the highest ever since its inception in Australia. And a lot of that effect will happen in the following year. So the growth is robust on both the India side as well as the international side, which gives us that confidence that we'll meet the mid-teens.
And you know, last piece is with regard to the Q4 numbers in particular. You've done an impairment of around 306 odd crore from acquisitions that you've made over maybe the last few years. Any more impairment which will likely act as a headwind to your numbers, maybe temporary, but would act as a headwind to numbers? Is that anticipated or not at all?
No, we don't anticipate any further impairment, and that's been advised by our auditors too. As you know, the auditors have to take a yearly call on the impairment. And these impairment were on deals that happened pre-COVID, where we had provided more for the payout, but due to our ratchet structure, we had to pay them less. And it was sitting on a balance sheet, which is a non-cash cleanup. But summary again, no, we don't expect any further impairments.
All right. Thank you, Dheeraj, for coming and speaking with us with regard to SIS Limited. Stock not reacting much with regard to those numbers, but that's the outlook with regard to Q4. But joining me, Somit is here to give us everything that's happening with regard to dealing room chatter. Somit, FI buying persists, which is the one key positive, at least for markets. And it's probably also why markets have held up so well, despite the kind of rally we've seen. What is it that you're hearing now in terms of flows? Our DI is looking more and more interested as the weekend is now firmly behind us. And some of the uncertainty with regard to the war also not appearing absolutely clear. So
that threat is obviously coming down, and yes, there are buy flows in both FI and DI. This is what the dealers are indicating. But when it comes to stock specific action, the first one is AU Small Finance Bank. We had indicated about this block deal It happened today, 1.4% stake, where multiple PE investors have sold the stake. But now what we are picking up is that the demand was quite strong for this block deal. In fact, half of this was subscribed by long-only funds, and big mutual funds like HDFC, ICICI Pru and Tata were among the top buyers in this block deal. The second stock on the list is Archean Chemical. We don't often talk about this company, but what multiple dealing rooms are in fact recommending buy to their clients for this particular stock, and this is on the anticipation that there could be a potential uptick in bromine prices. Now, bromine is the key product for Archean Chemical. More than 50 or 60% of the volumes are coming in from bromine, so keep an eye out for Archean Chemical. Then there is SRF and PNB Housing. Dealers are indicating that there are strong buy flows from domestic institutional investors on both these counters. And when it comes to Indian Hotel, now that stock is also up in trade. There are DI buy flows on this counter, but dealers are indicating that smart investors have been selling their shares ahead of the fourth quarter numbers for Indian hotels. When it comes to Epigral and Balmalori, dealers are indicating that large influential HNIs have started to accumulate both these counters ahead of the both these counters currently. And lastly, when it comes to ABB, dealers are indicating that there are delivery-based sell flows on FI desk for ABB India. So keep an eye out for ABB India as well in trade.
Excellent. So that's a clutch of stocks, in fact, that Somit brought us. Thanks, Somit, for that. And what we'll do is we'll slip into a very short break. On the other side, you'll hear from the management of Eminem. That's going to be the interesting one. And along with it, of course, we'll talk auto, because that's the top sectoral winner for the day. Stay tuned.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize.
Hello and welcome to NDTV Profit. A very good afternoon to all the viewers. Eminem just reported numbers, and clearly you can see the kind of growth trajectory the company is aiming for. Joining us on the show is Dr. Anisha, Group MD and CEO. Welcome to the show, Dr. Shah. My first question coming to you is, I don't think so there is a need to look back at what the company has reported. The key is this trajectory expected to continue? And if so, what's the outlook looking like in terms of FY26?
So, the reason to look back is just to see what has enabled this trajectory. And it's been all our businesses contributing to it. In auto, we had talked about a mid to high teens growth for SUVs at the start of the last fiscal year. We have closed with a 20% growth. Farm, we have executed very well in a tough environment, increased share. Across Mahindra Finance and Tech Mahindra, both are on a strong path to be able to get to the kind of milestones that we want to. And our growth gems have built a very strong foundation. Now, with that backdrop, if we look at this year, we have again said that we will grow SUVs at mid to high teens. And it is a reasonably tough environment, but I'm pretty optimistic about where we will be. And hopefully we again come back with the same results as we did from an SUV standpoint at least. And other businesses are on a good track as well.
So would it be right to say that under promise, achieve higher than that? Is that the strategy?
Well, if you were to look at our promise last year, mid to high teens growth in SUVs was not under promised by any margin. Right? In fact, a lot of people told us at that point in time, are you sure you're going to be able to get there? So it was a very high promise, a very high set of expectations, and we've been able to get past that as well. So our goal has always been to set bold targets and be able to get our teams galvanized to achieve them.
Right. Dr. Shah, the key with Eminem was always tractors was a business that people looked forward to, right? SUVs, there was pressure taking into consideration the capacity constraints at some point in time, which is left far behind now. If you have to talk about the tractor business alone with all the tailwinds in place, what is the kind of growth that you're anticipating, not only in the domestic market, taking into consideration global markets also, where US is becoming a turnaround, and taking tariffs into consideration?
So the domestic market is expected to grow at high single digits for the year, which is a good growth rate to have after the last 2 years that we've seen. Internationally, there continue to be a lot of pressures. The US market has declined for 13 quarters in a row, and we see some pressures still continuing. If interest rates come down, we will start seeing that easing up to some extent. But on balance, that's still a very small part of our overall tractor portfolio, and therein lies the opportunity for us to grow. We have been gaining share in some of the key markets globally, and we will continue to do that.
Okay. And talking about the SML Isuzu portfolio as well, we've already spoken to you about all the tailwinds. One bit I want to touch base with is the trucks and buses segment. If you have to talk about the domestic market, yes, you already become number 4 position after the acquisition, but penetration in this segment is becoming absolutely difficult. I mean, you've seen global players as well, where in spite of getting into this segment, there are players who file for bankruptcy as well, right? How difficult is it going to be to actually garner that kind of market share and sustain only in the trucks and buses portfolio?
So first, that's happened in the SUV segment as well, not just trucks and buses. So our approach has been that we pick certain areas and look for very strong execution in those areas. Our business in this space has spent the last 3 or 4 years reinventing itself, coming up with a much better set of products, a much better customer service, a wider footprint, and so on. So that gives us a lot of confidence. In the LCV segment, we have a 51.9% market share, and that's up from the low 40s just a few years ago. And SML is going to really help us focus on the intermediate segment right now in commercial vehicles. And we feel we can do well in that segment. And then we should look at heavy trucks and buses after that. So that is going to be tougher to penetrate with some strong players there. But that's one where at this point in time, at least, we will focus on intermediate. And we will look at that at some point.
So would it be right to say that this is going to be a space where Mahindra is entering, which is absolutely growing, but complicated and competitive? So the gestation period to get where you want to get is probably 5 years down the line?
In the intermediate segment, we're actually much better positioned. Because with buses, for example, in this space, we will have a combined share of 20% or so. And yes, it is a competitive space, but that's what we are used to in all the spaces.
But the capex also becomes very high in this segment, right? And that's what you've seen in terms of trends with other players. And building the electric bus at scale is a capital intensive business. So how do you counter that?
So we don't expect any more capex than we have outlined in the plans for both businesses. And we should be able to have a strong position with that, as we have in other segments today.
Right. When you talk about the EV portfolio as well, overall, any plans to launch in the lower category, entry-level category? Because let's be honest, Eminem, top of the class models, but on the expensive side, right? There is a requirement of EVs in the entry-level portfolio as well. Any strategy on that front?
So at this point, our focus is what we call authentic SUVs and delivering very strong products in terms of quality at very reasonable prices to customers. Beyond that, our questions for a future point in time, our approach does tend to be focus on a few key areas, play very well in those areas. At this point, this is where we are.
Last question. In terms of businesses across the group, where will your energies be focused towards to get to that turnaround point, like the way we saw a turnaround coming in on the automotive segment in M&M? So which are the businesses which will need that focus way higher than the others?
So we are seeing that across multiple businesses. So Tech and Mahindra Finance are on a very strong track. We talked today about 6 of our scalable growth gems, and you've seen some fairly dramatic results from many of them. Last mile mobility business has gone from 14,000 vehicles it did in a year to 78,000. That's more than 5x. Real estate business has gone from 670 crores of pre-sales to 2,800 crores of pre-sales. So as we look at all of those, we've got a set of businesses that are really well positioned. 6 of these businesses are targeting $2 to $3 billion valuation each in the next 5 years. And then we have our emerging growth gems as well, which are targeting $1 billion of valuation. So we're actually moving well along the path of creating the Mahindra Group as one which has multiple large companies that plays today in 70% of India's growth.
Well, that's Hiral speaking with Dr. Anish of M&M. Of course, with regard to the numbers, stock up 3%. And let's quickly take views as well as to how those numbers looked on the fundamental side. But first off, on the technicals, we have Hemen Kapadia joining us, DR Choksey FinServ. Hemen, quickly on to how this one looks from a chart perspective. We've had a very solid rally in M&M. It's outperformed the index last month or so from the lows of around 2450 odd. It's currently sitting very, very pretty at 3000. Where to from here?
Very good afternoon to you, Harsh. Thank you for having me on the show. Sorry, the pleasure.
Good afternoon.
I agree, Harsh. It's relatively much stronger, actually. Keeping in mind the quantum of the rise, one would have thought that this correction, which came to roughly 2450, should have been deeper, but resilient. It stands out with its strength. And yes, now we were in a range between 2625 Harsh and 3222 for a few months. It gave a breakdown, which only on the hindsight can we say was a false move, and has recovered, and status quo sort of has been restored. So once again, 2600, 3222 remains a level to watch out for. I don't expect it to take 3222 out in a jiffy. But if it does, I think you could see another 10% upside. So a lot of strength in the stock. Thing is, it's moved up for 5 weeks in a row. So maybe closer to 3,100, we might see a spot of bother in terms of resistance. Harsh.
And, plenty of stocks within that auto pack and focus. I mean, any others on your radar? Of course, Eminem, you're playing a little bit of wait and watch from what I understand.
Yeah, I think, I would go and pick some of the losers. I won't say losers, but look at the stocks which have suffered maximum, and I would look for a contra call. I think Tata Motors stands out. It's virtually fallen off a cliff, Harsh, from 1190 to 550. It's become half, so less than half actually. Not much to lose. Medium-term bottom in place. A clear technical turnaround is in the offing. See, it's a recovery. It's not a rally. But if you see from where it has started, that's fine. If the stock goes up from 50 to 1200, give it a couple of years. But yes, so as of now, closer stop loss, everything is in place. So I would plump for something like a Tata Motors, which is a contra buy call for a trade, because I believe it's a pullback, a recovery, not a rally.
And Hemin, curious to know, I'm just shifting tack here, wanting to understand your call on the index at this point. How are we placed in terms of the index? We've had quite a few days of consolidation now. Where to from here?
It looks as if my level was 24,492. If we are struggling over there, I believe we go to 24,800. That would mean 3,000 points from the low. And for the time being, I believe overcoming 2,400 after a 3,000 point move would be a tall order. Nothing is impossible in the market. Price is always right, as we've been told. But closer to 2,400, I feel that this entire Jing Bang and this juggernaut moving would take a temporary breather. So I'm positive Bank Nifty's taken a breather, but Bank Nifty led the move, so it's okay. But everything seems to suggest that if we come to 2,400, which is a distinct possibility, I would say we are off for a 2-3 week time price correction. So at that point, I would exit all my trading positions.
Okay. All right. And Bank Nifty, Hemin, I know you hinted, but
yeah, right now it's a step behind, which is okay. It's led this whole move. I mean,
yes.
It's close to a fresh all-time high, which is not a joke. Having said that, it was on the anvil because the Bajaj twins, Kotak and HDFC Bank, I think we've spoken about this earlier, Harsh. Bluest of blue chip stocks, 4 years they did nothing, were hatching eggs. It's about time they started moving. They have, and I still believe they have a further upside, notwithstanding a little bit of a ruffle of feathers of the Kotak results. So Bank Nifty 56,000 is a headache. 54,250 is a support for the time. We've been range bound for a few days. It's fine. It's moving in a triangle. Above 56, I believe we are going to 57.5. So banks look good. PSU banks look great. So I believe there's a lot more headroom even now, though it may be a tad behind Nifty at this point in time.
And Hemin, opportune time to get your picks therefore. And you suggested PSU bank. So if that's not part of the picks, throw in a couple of names from the PSU banking space as well.
Okay, I didn't give any PSU banks because it's slightly from a 12 to 15 month point of view.
Sure.
The obvious one would be a PNB.
Okay.
I believe, at the risk of sounding overly optimistic, I believe there's a 50% upside from current levels. But once again, this is not a very short-term call. I have Bank of India, which looks great. So that is also looking good from a 1 year point of view. Yeah, the picks for today though. The first one is IRCTC. The stock is moving in a recovery mode after a 2.5 week consolidation. So a buy on IRCTC at 762, stop loss 747, target 792. Consolidation phase, taken support in the 55-day EMA, oscillators turning positive. So it's a buy call. And more importantly, the weekly picture has improved. Second one is Adani Green. All the Adani stocks are on fire today. So it was easy picking, but I picked this because it hasn't moved as much as the other Adani stocks, but the whole pack looks good. So a buy on Adani Green Energy at 975. I believe there would be a little bit of change in my levels because it has come off a bit. So I would need to sort of tweak the figure a bit. And one can buy Adani at 940, stop loss of 910, target of 1000, Adani Green Energy. Yeah, Harsh.
Interesting. Very, very interesting. Himen, while we are part of this conversation, quickly wanting to also close a couple of other auto names which are in focus. Motherson, JBM. While there's not much with regard to fundamentals there, what's happening on the technical front? Because some of those stocks really spiking in trade today.
Well, most of these are good companies, Harsh. If you look at Samvardhana Motherson 215 to 110, it's become half. Deeply oversold, positive divergences, bullish gaps, technical turnarounds, oscillators giving buy after almost 10 months. So frankly speaking, even if we are playing for a corrective rebound, Harsh, I think there's a lot more upside to go. So I believe Samvardhana Motherson should go to 151 or so in this recovery itself.
Wow, so expecting some real upside right off the bat on some of those names. The other one which is really spiking in trade is something like an RR Cabel. Stock of the day for us. Let's bring in Puneet to help us understand what's pushing the stock higher. But Puneet, just overall a fabulous set of numbers. I mean, what's sustainable first off, and what's the guidance like?
Well, definitely, Harsh. It's a surprising numbers to say the least. While the estimates were baking in a strong revenue growth, the wires and cable space has been news after entry of Ultratech, and it's been expected that it will lead to the smaller players have a lot of in terms of volatility in earnings, but that's not the case, at least for this particular quarter. Revenue growth has been up 26% in this particular quarter. We've also seen the EBITDA grow by 68%, while the overall margins have moved up by 218 basis points to come in roughly at 8.72%, and margins were expected to be slightly under pressure because of volatility in copper prices, but that is largely the company has taken up upfront. The last month or so has been slightly soft on that aspect, so definitely some positive pivot coming from there. Profits as a whole is up 63% because of that, handsomely beating estimates as well. In this particular quarter, there were three key highlights that you need to know about. The first one, of course, revenue growth has been led by the core wire business of the company. That's performed very well. The second aspect is better contribution margin as well as operational efficiency that the company has seen in this particular quarter, which has led to a beat in its margins. And finally, approving the capacity expansion, and I want to just go deeper into that, of roughly about 1,150 crores. Now, the Vagodia facility which the company has, they're estimating a planned phased expansion essentially by March of 2028, and that's another big positive number coming in for RR Kabel. They've also said that this accounts for roughly 58% of the company's current facility, so it gives some positive pivot as well in terms of growth, and as well as capturing that growth based on entry from multiple players, as well as the other facilities. They're spending 400 crores for the facility in Silvassa as well as Dadra and Nagar Haveli. This will be coming in December 2026 again in a phased manner. Finally, in terms of financial targets, what is the company anticipating? Overall EBITDA uptick by 2.5 times in the medium term. They've also said that the wire and cable segment is expected to grow at 18% revenue CAGR, and at a time where the company's valuations are considerably better as well as cheaper when compared to something like a Polycab as well as Havels as well. It's definitely a very interesting results that the company has come out with, and puts into pivot the growth prospects. And I think we'll cover that in the brokerages as well tomorrow, because we might see a lot of upgrades coming for this particular stock, at least in terms of earnings estimate over the next couple of years.
Very interesting. Thank you so much for that, Puneet. Opportune time to get views with regard to this one. Siddharth Khemka, Head of Research at Motilal Oswal, or rather Head of Research Wealth Management at Motilal Oswal, joining us. Siddharth, good having you. Now, in terms of just the commentary with regard to RR Kabel in particular, this 15% kind of up move, first off, is it warranted, and do you believe that the guidance is achievable?
Yeah, hi, good afternoon, Harsh. So I think definitely the earnings have been pretty much ahead of expectation. What was also a big factor is that, as you rightly highlighted, that the management guidance of a strong growth ahead. If you look at, they are guided for a 18% CAGR growth in the cables and wire segment. And a very high 25% growth in the FMEG segment over the next 3 years, which should drive the EBITDA at about 36%. The new capacity addition, as well as if you look at the product penetration and the expansion, I think that is something that is likely to drive the growth for RR Cable. Among the three, I think yes, what we are factoring in definitely RR Cable growth to be much ahead of the entire. So, for example, for FY26, we are factoring in about 25% earnings growth compared to a 14-15% earnings growth for both Polycab and KEI. And also in terms of valuation, it is trading at a discount compared to both Polycab and KEI. I think definitely with this kind of confidence, the stock should do well. What needs to be seen, yes, is that in the medium to long term, the capacity, or you can say the newer competition coming in from the Grasim or the Birla Group, how that pans out and how the entire valuation for the sector changes or moves once the concrete plans for the cables and wires business penetration by the Birla Group comes out. But nonetheless, I think pretty strong numbers, pretty strong commentary. Definitely, market is looking at, we are also factoring in the much stronger growth for RR Cable in the cable and wire segment.
Siddharth, therefore, how should one look at the whole space? Because you're seeing new entrants come in a big fashion and make an investment likely. So competition will be elevated in the space. Typically, when we've seen that, at least there is a likelihood of analysts looking at it as a squeeze with regard to return ratios and margins. Do you expect some of that to flow through into a Polycab, into a Havells, into an RR Cable, and therefore also at some point squeeze the kind of multiples that these stocks trade at? Would that be a very live risk to you?
Yeah, Harsh, I think the biggest risk is how the new entrant pricing plays a game in terms of pressure for earnings, both in terms of margins as well as in terms of market share that could be done by the new player to squeeze out a market share gain. And that could lead to not only market share loss, but margin pressure and hence the impact on return ratios. I think overall, what we are factoring in that there could be a mix of all these things plus the sentiments around the wires and cable segment that can be impacted as and when these strategies come out. But for now, I think in the near term and in the midterm, we don't see this competition coming up. They have just announced the plans. So at least for the next 1 year, these companies are likely to do well. If you look at Polycab, it has the highest return ratios of almost 19-20% compared to RR Cable, which is at about 14-15%. And hence, within the sector, we believe that market leadership by Polycab would continue. There will be competition, but that only goes on to show the overall attractiveness of the industry, the wires and cable industry in India, and there is enough room for growth for all players in the space.
There won't be a pricing war in that sense, according to you, Siddharth?
I think the probability which could play out and could impact the sentiments going forward. But until the plant is up and they come out with those strategies, we believe that at least a 12-15-month kind of window, which is there. Until then, we don't see any competition coming up. And till that time, these companies continue to report strong numbers.
And Siddharth, how do you, so switching focus here, how should one look at consumption at this point? Is auto the right way to play it? We had Eminem's numbers, strong set of numbers overall, even stronger commentary actually. That is what has really surprised, in fact, even the way in which the stock has reacted. How do you view that, as well as how should one play consumption at this point?
So yeah, Harsh, I think if you look at the broader consumption themes, especially the discretionary space, there are subsectors which are doing well. Within the broader consumption space, what we like, food and beverages is the segment we believe could do well this year on back of higher spending, rural consumption going up, and strong demand environment. So stock companies like Varun Beverages or companies in the QSR space are the companies that we believe could do well. Even companies in the, say for example, Tata Consumer, where results were in line with expectation, the management outlook or commentary was pretty strong going forward. So I think that's the space that we are liking. Within the larger discretionary spends, I think auto has many sub-segments, and among them, tractors is where we are seeing strong growth this year. So definitely Eminem is something that we are very positive on. It is among our preferred pick. Or you can say the top idea within the auto pack. They have despite being the market leader, they are far outpacing the industry growth in the tractor segment. And with the monsoon expected to be above normal, and the rural sector commentary from a lot of sector management, be it the autos, be it the consumers companies, be it the retail companies, they are suggesting that rural is something that is picking up pace this year, and that should help Eminem report strong numbers going forward as well.
Sticking with the consumption theme, hi Mahima also joining in. I just wanted to understand your view on how Marico panned out, because one side we're seeing FMCG heavy companies, staple companies, growing in single digits, but Marico did grow almost 20% in terms of its top line. And the commentary coming in from the management is also pretty strong. They're saying that they will recover their margins by the end of FY26. They are also penciling in a double-digit growth in FY26 ahead. What's the view like, and do you think that the right way to play staples right now is smaller companies like Marico or Zydus Wellness or something like a Jyoti Labs?
Yeah, hi Mahima. So I think yes, if you look at not only the results are strong, again another company where the management guidance has been pretty strong. We are seeing a revenue growth which has been an outperformance, 20% growth led by both pricing. While on the margin side, I think there is some impact because of the higher ad spends. But overall outlook remains pretty strong. Improvement in market share gains, accelerated growth in the food, premium personal care segment, and the healthy growth in the international business, plus normalizations of key raw material prices. I think that is something also helping Marico. What we are expecting 11% revenue growth and 13% EBITDA growth over the next 2 years. Valuations seems fair for this kind of growth. We believe staples are likely to pick up pace, and within that, the smaller names would be the preferred way to play the staples. So we have a buy rating on Marico and a target price of 800.
Right, Siddharth, thank you so much for that view, and I believe we'll have to let you go at that. So thank you so much for joining us and giving us all those insights. All right, with that, it's time to slip into a very short break, but we'll be right back on the other side, getting you your buy today, sell tomorrow, or sell today, buy tomorrow calls as well. So stay tuned.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. the last 1 month, if you see the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Welcome back. Thanks for staying with us here on India Market Close. Now we've spoken about quite a few names. In fact, before we went into break, let's take a quick technical view as well on some of those. Hemin, I want to quickly take your view with regard to a few stocks within that consumption basket. One of them being a PN Guardkill, the other one being a Marico. Give us your take with regard to a couple of these big ones which are really buzzing in trade today.
Okay, we'll start with Marico, Harsh. Okay, FMCG sector has bottomed out, but Marico stands out. It's posted a fresh all-time high. Almost, I won't say fresh all-time high, just missing the fresh all-time by just a bit. So, a lot of relative strength. Looks good. Has been an uptrend for last some 20 years or so and still remains in motion. So further upside, very much possible. And you mentioned PN Guardkill. Okay, relatively less data. Downside appears limited. It's forming a base formation at this point in time, Harsh. We need a close above 560 for a further upside. But yeah, there is a volume spike today. So things are beginning to look up, but I'd be more convinced when it's sustained above 560 from a weekly point of view.
That's the view with regards to PN Guardkill and Marico. Hemen, any view on Swiggy? I believe Swiggy is buzzing on a fundamental reason today, and this is on the back of Swiggy, which is kind of going big in terms of its 10-minute delivery format, that is Bolt. What they've said is that they've now expanded over 500 odd cities, partnered with 45,000 plus restaurants, and 1 out of every 10 delivery that they're doing right now is from Swiggy Bolt. Now, in contrast to that, Zomato's management did come out and say that the 15-minute delivery format is not working for them. They're saying that they're not seeing any incremental demand, and that the overall view is that the path to profitability will not be without kind of compromising on customers' experience. So that's the whole fundamental view. Plus, Swiggy will also see its lock-in period end on 13th of May. How are you reading the charts? I'm not sure if you have enough data, but with whatever data you have, what are the charts indicating for something like a Swiggy and also Zomato?
Okay, Mahima, I'll start with Swiggy, and like you said, paucity of data, but we'll do with whatever we have. Totally flat, range between 303 to 380. We need a close at least about 350 for things to improve. Things look as if we are on the anvil of a technical turnaround. We'll have to take it one step at a time. Doesn't look as if it's going to go down much. It is making an attempt to turn. So I would say I would be mildly positive on the stock. And okay, now it has turned to eternal. So, okay, we've consolidated for 1, 2, 3. This is the 4th month, okay, not counted. We just in the beginning of the month. So we consolidated for 3 months in Zomato, I mean eternal Mahima. And we are now on the verge of overcoming 240, which has been a pain for some time. So short-term outlook and medium-term outlook, Eternal seems to be a step ahead of Swiggy. And about 240, I think Eternal seems like doing something positive, high probability. So I'd be more positive and yeah, obviously more data, so a little bit more conviction.
Okay, so that's the view with regards to where technicals are concerned for both of these counters, that is Swiggy and Zomato. Now, let's shift focus. We earlier spoke to Matt Orton of Raymond James Investments about the upcoming FOMC meet. Here's what he expects from the US Fed. Listen in.
I've always been more of a glass half full person throughout all of this uncertainty that we have. And I think a lot of the reversal that we've seen over the past couple of weeks, I mean, we've just had 9 consecutive up days on the S&P 500. First time that has happened since November of 2004. So there's a lot of, I think, reversal hope that we're going to start to strike trade deals, that the worst left tail scenarios are off the table. There's going to be some key events this week that we have to pay attention to. Number one, the S&P 500 is approaching some key technical resistance levels. So can it hold its own? Can it break through some of those levels? We're going to see. And I think the most important detail is going to be the Fed meeting. And so on Wednesday, we'll hear from Powell. And I think that Powell is going to strike more of a hawkish tone. I think interest rate pricing, the expectation for cuts is a little bit ahead of itself, given that the data continues to hold up fairly well. We're seeing decent earnings, much better than feared across the S&P 500 companies as well. So I think amid that backdrop, the Fed's going to be very reticent to try and broadcast more cuts that are coming up. So I think we're going to have some adjustments, but I do think that dips are viable, and I would wait for dips to start to put more capital to work in this market.
Okay, and joining us now, Mr. G. Chokalingam, founder and MD at Economics Research as well. Good afternoon, Mr. Chokalingam. Good having you here. Quickly, with regard to the views, the FOMC meet is upon us now. In your view, how big is this going to be? Now we've got Mr. Powell already talking on public forums and giving his views. So largely it seems to be baked in that there's not going to be a change. But how relevant for India at this point, and what will you be looking out for?
It will be relevant to some extent because all of us know that cut in the interest rate there can attract FI money here to that extent. But I believe Powell would be under compulsion to cut down the rate, not from a political point of view, even from a fundamental point of view. Couple of days back, World Bank, informed that food index has come down quite substantially on year-on-year basis. And then we saw oil price crashing almost 32% from 52-week high. So inflation set to come down. Along with that, we saw a contraction of GDP in US. So all this would definitely augur well for rate cut, which would definitely favor India. Even if Fed doesn't cut, I am pretty confident that RBI would keep cutting down the rate, because last 2 monsoons were good. Now the forecast of monsoon are also good, and both the wholesale and retail inflations have hit the record low levels. And obviously 32% crash in the oil price also would help Indian economy. And I am pretty confident that the rate cut or the reversal of the interest rate cycle on downside would continue both in US and in India, which would be favorable to Indian equities.
Okay, Mr. Chokalingam, any view on Avenue Supermarts and its earnings? Because margin came as a shocker, one thing. EBITDA as well as net profit both were a miss in terms of what Street was expecting. In terms of the key metrics, like-for-like growth was decent at 8%. Even the revenue per square foot was at 3%, because the kind of store additions that they've done this particular quarter, it was not expected at 3%. But overall, brokerages are not very positive. They're cutting down the target prices, also downgrading the stock. What's the view like?
Certainly. There is a very interesting structural change happening, which we are all aware. The e-commerce is, taking off at the cost of the traditional physical stores. So interestingly, the large companies like Avenue Supermarket, even to some extent, in December quarter, we saw the Reliance retail also getting affected. And, while large retail firms are getting affected, on the roadside also we can see the individual vendors are also getting affected. So this structural change of the e-commerce taking off is real, and that's going to continue to grow in a big way. And that would mean the valuation contraction for the physical retail stores, those who follow the predominantly the traditional format. So I think it can correct quite significantly from current level.
Okay, so some scope for correction. Let's quickly switch focus to the other stock, and this is a Nifty 50 stock where we've seen downgrades with regard to stance but upgrades with regard to target price. It's an interesting one, and we've had quite a few brokerages do that. Let's first start off with the growth guidance. They've guided for 1.5x to 2x of industry growth. They've not done it in FY25. Can they do it in FY26 and beyond will be the question. Capability is certainly there, but execution not happening. So something to look out for. The bear case, of course, being that FY26 too will be this kind of a year where they're not able to do that 1.5x to 2x of industry growth. So that's on Kotak and on the growth piece. Let's talk about margins next. And with regard to margins, the management gave margin comfort, saying that there's plenty of levers available, especially on the deposit side, to cut rates on savings accounts and therefore protect margins. So that's the bull case here. But in the past, we've had a Bernstein note which said that Kotak has actually lost its liability franchise shine. And if that has happened, you may well see deposits too start to taper in terms of growth. We'll have to wait and watch whether that happens. But if that were to happen, you might well see an adverse impact of that with regard to margins. Let's talk about credit costs, because this time around, credit costs were slightly elevated. Now, it's been a conservative bank with low credit cost, always has been traditionally. But this time around, it's been a bit of a surprise. Microfinance and unsecured, they want to increase the pie of these within the overall loan mix. And if that were to happen, could credit costs actually continue to surprise and be elevated? Fourth piece is with regard to evaluations. It's trading at 2.5 times 1 year forward. Traditionally has traded, the 5-year average is 3.1 times price to book value. But stock has already outperformed sharply in the last 6 months. We've seen a very significant outperformance versus how the index has performed, of course. And Kotak has been a rank outperformer. Has that outperformance already been baked in is really the question. Mind you, the average analyst estimate as of today on Bloomberg is just an 11% upside. So a large part of the outperformance complete, or is there a re-rating towards 3.1 times warranted? Mr. Chokalingam, let me come straight to you. Do you believe that Kotak at 3.1 times price to book is a fair thing to expect? Because currently at 2.5, how are valuations looking to you versus the result, and which side of the fence do you sit on where Kotak is concerned?
I would say that at best it can be given a hold rating for medium to long term. I don't think it is going to create a significant return in the short term because private banks are going through a little difficult time in consolidating and growing the CASA deposits, low cost deposits, and industry credit growth also has come down to 12-13%. And even Kotak Bank, which used to grow at a phenomenal rate, its advances, has grown in this quarter on year-on-year basis 13% only, around 13%. So definitely it's going to have a little kind of pressures in the short term in growing business in a strong double digit. And still I would give for long term it's a hold, because it is one of the few banks which has not unlocked money from the majority of the subsidiaries. Still, majority of the subsidiaries are closely held. Last year they started unlocking only from one insurance venture, but there are a lot more ventures like securities, other insurance firm, and then wealth management, etc. So therefore, short term just a hold or buy on decline, but preferably below 2000, and hold it for long term. But definitely beyond 1 year, you might expect some significant return.
And Hemen, if I can take your view, I know you're bullish with regard to Kotak, but given the kind of reaction today, would you wait? Are there levels you're looking out for before you enter, and what are those levels?
Yeah, no rush, Harsh. We've not closed above, or we haven't sustained above 2250 in terms of Kotak in its listed history. So if the stock moves up from 1550 to 2300 and cannot sustain about 2250 in the first attempt, not very surprising. I think it's just making it healthy. Okay. Having said that, 2050 is the first level where I think one can start nibbling. And below that, you have supports coming in at 1980 and 1850. So what 2050 is where one can just about start entering, don't do the whole hog at one go. Yeah. So after 4 years, yes, and like you said, I'm still bullish about 2250 Kotak should do much better.
Very interesting. 35% in the last 12 months is what Kotak has done. But what we're going to do is slip into a very short break. On the other side, we'll get you what to expect from maybe Godrej Consumer. We'll also get you BTST picks. We'll get you something that Musk's father is going to be investing in or sitting on the board of. Which is that company? Stay tuned for all of that and more.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as
Welcome back. You're watching India Market Close. Now, a very interesting update is coming in on Servotech Renewable Power Systems. Let's pull up the stock and see what it's doing in trade today. It's up almost 6% in trade. And this is because the company has appointed global business strategist and father of Elon Musk. So they've boarded him on the board, and to give us more details as to how this will pan out and what it exactly stands for, let's welcome in Varsha to give us more details on that. Varsha, what are you picking up?
Yes, so they've appointed a global business strategist Elon Musk to its global advisory board. Musk will play a role in aiding strategic global vision and AI-driven innovation. And this appointment will aligns with Servotech's ambitious vision 2027. What will Errol Musk do? He'll have tour Servotech's manufacturing facilities in India and will engage with key government and investor groups through roundtable sessions, and will also attend quarterly global advisory board meetings, and will contribute to media activations and press interactions. Well, who is Errol Musk? He's an Elon Musk father, and renowned for contributions to field of tech, infra and sustainable development.
Very, very interesting. Okay. So that's on Servotech. It's interesting because Servotech also in the LED lights and solar power products space, and therefore this could be a great synergy. How much of the rub-off happens will actually be a wait and watch. But Mr. Chokalingam, would you find a development like this interesting enough to actually dig in and understand exactly to what extent will Mr. Musk be involved?
I believe it is the Musk father, right? Yeah, so I am not exempted because I am also very old man, above 60. So our children are far superior than us. So therefore I am not excited. I would stick to the fundamentals. I am not excited about this development.
Point taken, Emin. How would you view this one on charts?
It's not made much of a difference, Harsh. It's there where it has been for the last 13 trading sessions. So it's just a flash in the pan sort of a thing.
And Himin, on that note, your BTST?
Okay. My BTST is HFCL, Himachal Futuristics. One can buy HFCL at a small stock at 80.50, stop loss of 78, target of 85.50. It's just finished a 7 trading session decline, oversold, positive divergence, crossover buys on the early into early charts.
Okay, so that's with regards to where BTST stands in Heyman's basket today. Let's also talk about some earnings that are expected to come out tomorrow. Godrej Consumer is one of them. In terms of what you can expect from the earnings, revenue might be a slight hit in terms of where estimates stand. There has been a bounce back which is seen in the home care business as per their business updates. Pressure on margin and profitability will continue on the back of inflationary pressure. Revenue may rise around 7% as per Bloomberg estimates. EBITDA may fall around 3%. Margins could likely see contraction of around 200 basis points. Net profit may fall almost 45%, and this is on the back of an adjusted profit. Despite that, the profits are expected to fall significantly higher. Now, what you can expect, standalone volume growth to be in mid-single digits, revenue growth in high single digits. EBITDA margins, might be in the same range as Q3 itself. Consolidated numbers, high single-digit INR sales is something that the street is expecting, mid-single-digit volume growth. In terms of segments, mid-teens underlying volume growth to be seen in home care business, mid-single decline in terms of personal care volumes, and personal care will continue to go through the kind of price and volume rebalancing that it is seen in the past few quarters as well. International business, Indonesia to see mid-single digit volume growth, Africa, Middle East and America to see strong double-digit growth. Now, key monitorables for this would be first pricing growth plus the volume growth, and of course vice versa, and the pressure on margins as to what extent will they continue in FY26 as well. And lastly, the commentary on overall international business as well. Mr. Chokalingam, I'll come to you on this one. A lot of FMCG majors have already come out with their earnings. Your view with respect to that, and of course how Godrej Consumer will perform, versus their peers.
See, unfortunately, FMCG, fast-moving consumer goods have become, slow-moving consumer goods. It's a fact we have to accept. And market, if you see carefully in the last 1 year, it started contracting the valuation of such sectoral stocks. And gold consumer cannot be an exception. If you look at the first 9 months of the last fiscal FY25, the revenue almost stagnated. There was no growth at all. At the PBT level, the profit grew only at 4%. The industry also expects no double-digit growth for Q4 as well. So when that is the situation, I am not comfortable in giving a valuation multiple of over 60 times for FY25 earning. So I would rather go after growth stocks which are available from banking sector, or I would go for aviation stocks, leader in the industry, where oil price crash of 32% would help them. Or I would go for within automobile sector, like Eminem, which is doing phenomenally well. So this would be my approach, that stick to growth stock or the business which will see a massive margin expansion within the large cap space. That could be a better strategy than continuously chasing the slow moving consumer goods now.
Taken slow moving consumer goods. I think we'll have to change that acronym, Nifty SMCG, Mr. Chokalingam. But jokes apart, there are a few banks which have come out with numbers, and you mentioned that financials interest you at this point. Both on the PSU banking side, you had something like an Indian bank coming out with an interesting set of numbers. You had even within the private banking side, some of the smaller banks, and Utkarsh Small Finance came out with numbers. Very uninspiring set. But do you believe that it's the end of the pain with regard to the smaller banks, and how would you play PSU banks?
Interesting question. Smaller banks, it is mixed one. As you mentioned, some of them have come out with good results, some of them have come out with the bad results. Particularly the small finance banks. I would stick to PSU banks as well as even HDFC Bank. In fact, it is misunderstood, the results of SBI. Last year they had a write back under other provision category. This year they had to make a provision. So it is because of this provision adjustment, it has shown degrowth, but it has shown a very decent profit growth at operating profit level, profit before provisions. So for such a large bank, growing the advances at 12-13% also something really marvelous. So I would stick to bank like SBI, Bank of Maharashtra, and HDFC Bank. Yes, I have to complete the analysis of other small private banks. My logic is that if any bank has net NPL less than 0.5%, and if it is able to grow the advances in double digit and available at a price to book value of less than 1.5 times, I think it's a good to go. That is my approach as far as the banking stocks are concerned.
Okay, so that's the view with regards to where banks stand. Hemen, let's take a quick view on certain stocks that are buzzing in trade right now, and quick technical view. The first one is V-Mart. The stock is down 6% as we speak, and this has been throughout the day. What's the view like? Is it profit booking?
Yeah, it seems like profit booking. 2750, 3500 for about resistance. Yeah, doesn't look as if it's going to go down too much beyond 3050.
Jindal SAW, which is also down by about 4%. What's the view like?
Sorry, could you repeat the stock, please?
Jindal SAW.
Okay, yeah. Jindal SAW. Okay, this doesn't look very pretty. We've been range bound from 220 to 285 for the last 4 months. It looks like a rounding top. Close below 225 could be in trouble. So this doesn't look too good. I'd stay away.
View on KFintech, that is also down by about 3% odd.
Okay, KFintech, having said that, okay. KFintech is also, I'd say, a little bit of a profit booking. 800 to 1300 in the past couple of months is quite a lot. A sell signal on the daily chart with a lower top, lower bottom. So doesn't look like going down too much, but time being, this recovery or rally, whatever you term it, has come to an end.
Okay, thank you so much, both of you gentlemen, for coming in, joining us and giving us all of those views. We'll let you go on that note. Let's quickly look at where the Nifty is settling in at. In that sense, we've had a decentish kind of day today. It's been a very, very range-bound day of trade, around 0.5% higher on the Nifty. 24,500 is just about there is what we're seeing, and that's the positive. And this is despite no support being lent from the bank Nifty. So that's where it stands out. So let's quickly look at what all has done well, and let's look at contributors first on the Nifty. And what you'll see therefore is, of course, you have HDFC Bank doing well, but you have an Eminem which is contributing decently, an ITC and an Adani Ports. A couple of those Adani names really flying in trade, mind you. Just wanted to mark that out. Kotak, SBI, ICICI, Axis, the top 4 losers in terms of points contributors on the Nifty. So that's where a major part of the drag has come from. If I were to just add all of those up, that's about 50 of the 64 negative points that we're seeing on the Nifty. So that's where a predominant chunk of the drag has come from, the bank Nifty. And now let's look at the heat map, and that will give us better context on what were the meaningful gainers. Outside of that, a Trent and a Shriram Finance have done very well for themselves. We've closed for the day, and Eternal also closed around 2.5% higher. Tata Motors and some of the auto stocks, including an Eminem, was up around 3.5%. The Adani twins were up 6.5 to 7.5%. And we had some losers within IT, maybe a Tech Mahindra slight negative bias, and HCL Tech also around 0.5% lower. But outside of that, it's predominantly the banking financial pack which has led the losers, at least in trade today. Let's look at the advanced decline on the NSE. And within that as well, the breadth was good. The market breadth sustained pretty much through the day, and it was fairly healthy in that sense. And that's where a large chunk of the gains came from for the mid cap and small cap indices. Let's pull up the mid cap and small cap indices, and 1.6% higher on the Nifty mid cap. Small cap index also ending around 1% or 1.2% higher. That last bit of spike also seen on the Nifty small cap. So positive on both of those. The broader market's doing much better than the Nifty, and visibly so. Now let's quickly also zoom into sectors and pull up the heat map with regard to that. Auto doing phenomenally well, 1.9% higher. Nifty Defense 1.8 as well. So Nifty Defense resuming its upsurge. The Nifty FMCG was the other one after the Marico numbers, where stocks are, or rather the index is up 1.2%. The Nifty Metal has silently gone up 1% or thereabouts. What stood broadly in line with how the market has performed is the Nifty Pharma and the Nifty IT. Those were relatively okay. The Nifty Bank and Private Bank, no surprise there. The Nifty Private Bank closing 0.8% lower. And that one's had a bit of a dull day on the back of Kotak largely and SBI. Both of those numbers weighing down on the Nifty Private Bank, or rather the Nifty Bank and the Nifty Private Bank respectively. That's how it played out broadly. Let's last off look at the top gainers, top losers on the BSE 500. And some names, of course, Motilal standing out within those. Adani, along with the group entities, doing fairly well, and you'll see some of those names on the green side of the screen. And Adani Green, and Adani Enterprises, Adani Total Gas. Those were some names. HPCL and some OMCs did fairly well with oil prices or crude coming off. Those were some names which did well. Polycab, KEI, as well as RR Kabil, that entire group of wires and cable stock were buzzing as well. VMart down 5%, some bit of profit booking seen there. Kotak on the back of numbers. And then you had a few names, Gujarat Ambuja Exports, and maybe an Aether and Jindal, which were down just about 2 to 4%. So that's broadly how the texture played out. Let's look at what to look out for tomorrow. You have those two key metrics coming from the US, but this week will be dominated more by what's going to happen with regard to commentary on the FOMC. This one's a big one. Shares to exit lock-in, Rainbow Children's Medicare, 20% of that capital to exit lock-in. Now, in terms of all the names that are there in trade, JBM Auto stands out, had a very good day today in trade, and Godrej Consumer as well standing out. So those two names were standing out. You also have 197 Communications, a Paytm, that we'll be looking out for. Within the wires and cables, you'll have Polycab to look out for as well. So those are some names, and KEI in fact. So those were some names which you will want to keep your eye out on. Now, on to an NDTV Profit exclusive. Here, sources tell us that TCS has cut variable pay for senior employees for a third consecutive quarter. My colleague Haripriya joins us with the exclusive details on that one.
Right, the variable pay for the January to March quarter, which is the fourth quarter, has been directed by 69% for the senior employees. Now, this is the third consecutive quarter that these variable pay has been cut. In the previous quarter, it was 78%, and before that, it was a 55% reduction. Variable pay is essentially the performance-linked incentive which is given out on a quarterly basis. These cuts are made mostly at the higher level for the senior employees. Now, TCS is also, this comes on the back of TCS not giving a yearly wage hike as well, which it recently reiterated in the Q4 management commentary, given that the demand environment is weak and they do not have much visibility on the business that's coming in. Some of the employees that we spoke to also told that this is happening despite them being top performers in their verticals, and this is also after following the work from office rules which TCS has linked to variable pay and also being on active projects. So this is so far what we hear from them, and this is also a broader industry problem where even in the previous year we saw some other companies, some other IT giants cutting variable pay as well, given that the weak demand environment is looming on the sector.
Okay, thank you so much, Haripriya, for that. Those exclusive details coming through with regard to TCS. Not looking pretty, right, from where we see it. But thanks so much for that. Completely out of time on this edition of India Market Close. We'll leave it at that. Thanks so much for joining us from all of us here. Stay tuned. More action on the other side.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in?
Hello and
welcome to NDTV Profits. A very special conversation we have with us DIPAM Secretary Arunish Chawla, who is leading the government, disinvestment and asset monetization initiative. Welcome to NDTV Profits, sir, and thank you for speaking with us. I would like to begin with asking you that how's the disinvestment pipeline look like in the current financial year, and given the uncertainty and market volatility, how you are planning in terms of big IPOs in the current financial year?
I should first tell you that we manage assets, not obsessions. We have done away with fixed disinvestment targets. And that is because we have adopted a composite value creation strategy. And this strategy rests on 4 pillars. 1, good corporate performance. 2, fair dividends to minority stakeholders. 3, CapEx as per the budgetary targets. And 4, a calibrated disinvestment. The calibrated disinvestment could either be in the form of IPOs, it could be in the form of OFS, it could be in the form of qualified institutional placements, or it could be in the form of strategic sales.
Mm-hmm.
What strategy we adopt for which particular public stock depends on market conditions, our own in-house research, which we call the DIPAM model,
mm-hmm.
and of course, our requirements to place valuable public assets to share them with ordinary investors.
Mm-hmm.
It is Honorable Prime Minister's and Honorable Finance Minister's vision that we should share the value of our public enterprises and public stocks
Mm-hmm.
With the ordinary households,
Mm-hmm.
and we are implementing it in letter and spirit.
Understood, sir. And I totally understand that, you may not able to give the big IPO plans at least, but could you please share the number of, disinvestment candidates which we could see government is, going for strategic sale? At least if you could share some number.
We did an OFS right in the first week of April. And that was from our defense portfolio, the Mazagon Docks Limited. We have an aim, a target, in fact, a moral strategy to share 25%, at least 25% of every major public stock
Mm-hmm.
with the people of India.
Mm-hmm.
In addition to that, as you know, we also decided to list one of the biggest financial institutions in the country, which is the LIC.
Mm-hmm.
And we have already disinvested 3.5%.
Mm-hmm.
And the SEBI, the regulator, has given us time till March 27 to bring it down to 90%. As you know, it's a very large portfolio. The market cap of LIC is now almost 4 to 5 lakh crores.
Mm-hmm.
And depending on how the markets evolve and depending on what the market research, the DIPAM market research throws up,
Mm-hmm.
We would be bringing up with calibrated offers for sale.
Mm-hmm.
And through you, I must tell the viewers and the market participants, those who observe and take part in the markets,
Mm-hmm.
that public stocks are not in unlimited supply. As and when conditions are right, we will bring them through OFS and other mechanisms in the market.
Mm-hmm.
And we will give good discounts so that ordinary investors can partake in them.
Mm-hmm.
And as you know, the market investment is now fairly diversified. Ordinary households, ordinary investors senior citizens, and now even housewives are investing in the stock market. We are grateful for the faith they have reposed in us, and we hope to live up to their expectations.
You mentioned two important, OSS. One is the latest one, which is Mazagon. The second one is LIC. On the LIC, I'll come a bit later. But on the Mazagon OFS, sir, when are you planning to sell the remaining 5% stake? Is there any timeline to it?
Keep watching the market news and keep watching the Deepam official. There is a Twitter handle that we have, which is Secretary Deepam. It's an official Deepam handle. And we give all the market news, the relevant market news and our offerings there well in time before they come on the market. So be on the lookout and don't miss the opportunity.
Of course, we track that, sir, regularly, in fact. But I wanted to understand whether the current market situation is conducive enough to come up with, more, OFS. And on the LIC point, I would like to ask that in 2022, the LIC listing happened. A lot of road shows, government has done. Do you think that this is the time to, offload some more stake in LIC?
Count on us to surprise you. Those who are in this business know there is a difference between macro and micro shocks. We manage a public stock portfolio of 40 lakh crores. That's a huge responsibility. The common mistake we make is that when the mood is down, nothing can happen. As you know, in first week April, we surprised everyone because the moods, it was Trumpian. That was the macro mood. But our own in-house research, which we now call the Deepam model, showed us that there are certain stocks which are holding on and they are good hedge stocks. And in general, public stocks, because they give very good dividends and they follow a sustainable capex strategy, they are very good hedge stocks for anyone's portfolio. And if you follow it's up to you. The dividend is in the hands of the investor. If you want to consume it, you consume it. If you put it in a growth portfolio, it will mitigate any macro shock in the market and will hold it up. And that is exactly what we will do. As you know, we track things very carefully. We have a very efficient, a large team of market researchers. And through them, we will be regularly coming up with OFSs of public sector stocks. They will be small in number because we are aware of the liquidity conditions in the market, what the markets can absorb. And we would always keep the interest of small investor in mind and always keep an opportunity for that.
My question remains, is there any timeline for LIC? Do we see some movement this year?
No asset manager gives out timeline strategy in the market. But as I mentioned and I reiterate, we will give every announcement well in advance to the market participants through the official Deepam handle. So please be on lookout for that.
Sure, sir. One, the public sector bank, which everybody is talking about, the IDBI bank, and the entire disinvestment has been, in works from for last 2.5 years. Now, I know that it making its progress there. I wanted to understand, is there any change of stance, given the current external headwind situation, given the situation we are in where things are not, predictable and waiting for more announcement from the US side in terms of trade negotiation, etc. Is there a wait and watch mode approach at this point of time when it comes to IDBI disinvestment?
IDBI disinvestment is on track. Government has taken a decision. It is publicly announced that we will strategically disinvest 30% of government stake and 30% of LIC stake to a strategic investor through a fair and open process. It's a complex, multi-stage, multi-layered process. We are working day and night and taking it forward. The data room has been established. The due diligence is being done. The share purchase agreement is being negotiated. And as it moves on, you will get the fair, correct news at an appropriate time. And I must emphasize that such decisions are not affected by macro shocks in the market.
Okay.
This is determined by a fairly well-calibrated, well-sequenced disinvestment strategy. And we are committed to implementing the government decision transparently and expeditiously.
But sometime, just for understanding, macro shocks like, external headwinds, the tariff uncertainty, do have an impact on the valuation.
Yes.
Are you concerned about that?
Both yes and no. You see, what happens is if you approach the markets with a trader's mindset, then you are obsessed with long and short positions. But if you believe in the markets with an investor's mindset, and you are there for the medium and long term, then you know how to ride over these shocks and ride through them. And a fair dividend strategy achieves precisely that. It is to give comfort to small investors that your returns will come no matter what the market conditions are, what the shocks are. And I would urge all fund managers, I would urge all those who have demat accounts, all those who are small investors, to always put some public stocks in your portfolio. It will help you. It will give you a consistent, sustainable, fair flow of dividend incomes. It will it will make you a participant in the value creation strategy of public enterprises, in their capex plans, which we monitor very, very carefully and rather aggressively. So, you have reposed your faith in us, and we are appreciative and careful about that.
Well, you have been quite vocal in terms of fair dividend policy, particularly from the private corporation. You had some meeting also. Did you raise this issue with private sector? And what is the response so far? And also, do you think that they are not doing enough?
I'll clarify. This is moral suasion. We are not imposing any regulation on the private sector. When we do market research, and we did a comprehensive round of that research over the last 1 month, when, the closing of the March, and we found that we compared the public sector stocks that we manage with the Nifty 50 corporates. The public sector stocks now form 10% of the market cap in India. And as you know, the Indian stock market is now third largest in the world after US and China. And this 10% of the stock or the paid 25% of dividends on the market. Right? And when we compared it to Nifty 50, we found that in terms of dividend strategy, if you if I may use a technical term, they both first and second order stochastically dominated the Nifty 50. And that is why we just give a fair message that we should all follow a fair dividend strategy on the market. This will make our markets a better place for the Aam Aadmi.
I'm sure, sir, with your approach and, you've been talking to private companies, I'm sure that will get reflected in the dividend as well. Moving to the MTNL issue, sir, here, the debt which is there, a huge debt in fact. And recently government approved the asset monetization, but considering the big land parcel of MTNL, is it a struggle to, monetize those assets? How are you going about it?
Good question. We have set up a National Land Monetization Corporation. It has now been staffed. It has a new CEO. We recently approved a land monetization matrix, which is a strategy to move forward with monetization of these assets in an organized way, so that MTNL can quickly dispose of its assets. Sometimes it may not be an outright sale, it may be another asset monetization strategy. But things are moving, and you will see results during the course of the year.
Okay. You think that you will see some progress in this fiscal year itself?
Absolutely.
Sure, sir. So recently government has invited bids on, on minority stake sale in the public sector banks. What is the status of that? Did you receive, any bids, and how are you going about it? When we could see that this is coming? Have you appointed anybody? What is the status there?
I'm happy to tell you that we received a very enthusiastic response. And the leading merchant bankers in India have applied for it. They include both Indian and multinational merchant bankers. The big names that you know of and can think of, I would not name them.
Okay.
And also the big, all prominent legal firms have applied for it. We have evaluated their submissions. We have taken their presentations. We have empaneled them. And you will see that we will move ahead in accordance with our announcement.
Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Nifty and Sensex jump higher for the day with Adani Enterprises and Adani Ports as the top gainers. Nifty Auto emerges as the top sector for the day, led by Mahindra and Mahindra. Nifty FMCG Metal snaps a 3-day losing streak. Shares of Mahindra and Mahindra climb over 3% following its Q4 profit jump of 22%, which aligned with estimates. Meanwhile, revenue exceeds expectations, boosting investor sentiment and driving gains in stock. Group CEO and MD of Mahindra Group, Anish Shah, in an exclusive conversation with NDTV Profit, says that the recent acquisition of SML Isuzu will help them focus on intermediate segments. The Indian government is moving ahead with key asset sale plans, including the IDBI bank stake sale and further dilution in Life Insurance Corporation as part of its broader disinvestment strategy for the fiscal year, says Secretary of the Department of Investment and Public Asset Management, Arunish Chawla, in an exclusive interview to NDTV Profit. Tata Consultancy Services further reduces variable pay for senior employees for the third straight quarter. A persistent increase in tensions between India and Pakistan is expected to impair Pakistan's access to external financing and pressure its foreign exchange reserves, according to Moody's. Following its decision to suspend the Indus Water Treaty in retaliation for the Pahalgam terror attack, India briefly stops water flow through the Baglihar Dam on the Chenab River. According to reports, the centre is planning similar steps on the Kishanganga Dam near Bandipur. In a dramatic escalation of America First policy, US President Donald Trump announces a proposed 100% tariff on films made outside the United States, a move that threatens to cripple the thriving market for Indian cinema in North America. Good evening, you're tuned into Profit 360 on NDTV Profit and I'm Sanjana. Over the next half an hour, we're going to bring you the latest updates on markets along with key national and international news. So a quick look at how the markets fared today. The Sensex and the Nifty surge for the second straight session with Adani Enterprises and Adani Ports leading the gains. Nifty Auto emerged as the top performing sector, driven by Samvardhana Motherson and Mahindra. Meanwhile, Nifty Oil and Gas, Media, IT, Financial Services and PSU banks continued their upward momentum for a second day. Nifty FMCG and Metals snapped their 3-day losing streak, signaling renewed strength across sectors.
Well, we inched towards 24,500 in trade today, and which was the key positive. Losers in that sense was largely banks and a couple of IT names, maybe an HCL, a Tech Mahindra, to just throw in those. But the big ones were Kotak and SBI, which really contributed to the losses today on the back of their numbers, which came out on Saturday. In terms of what did well, Adani Ports and Adani Enterprises were the two big gainers, 6.5% to 7.5% higher. Outside of that, there was Trent, which did fairly well, good strength within that one as well. Then there was Eminem, Tata Motors, some auto counters which were doing well as well. Overall, the Nifty Auto was the top gainer in trade today. In terms of the breadth, both on the Nifty as well as on the NSE as a whole, very strong breadth on the Nifty. Nearly 40 out of the 50 Nifty 50 companies traded in the green, so that was the key positive. But within the Nifty, within the larger NSE basket, the advanced decline largely was strong and well in favor in that sense of the bulls. The mid cap and small cap index also did fairly well. They both closed at their day's high, with the Nifty mid cap up over 1.5% in trade. On the Nifty it was fairly range bound, but on the mid cap and small cap they built on the gains as the day progressed. So that was the other key positive. In terms of sectors which didn't do well, it was just the banks and the private sector banking index and the Nifty banking index. Nifty bank largely dragged by the same names, SBI, Kotak, as we spoke about. Even within the private sector, Kotak was probably the largest laggard. So those were the flavors that really stood out. Within the BSE 500, cable and wire stocks were one set which really stood out. Adani Group stocks, all of them were trading very, very well in the green today. So there was plenty of traction there. Those were 2-3 pockets which also did well.
If you look at the last few weeks, the Nifty is up 2,700 points from the recent low. I don't think many people in the market at the starting of April would have expected this market to rally the way it has. But I think our stance has been very clear all along that this 6-month-long bear market that we saw was a digestion of the 2-year bull market, that the market witnessed, I think, which was phenomenal in every sense. I do believe that we are out of the woods. I think these are the pointers that we put out in our recent reports. And I think the momentum has looked good. The breadth has been excellent. The participation is amazing. And you have the Bank Nifty leading this entire market up. And as we speak, you actually have more and more sectors bottoming out and starting to join the party. So it could be real estate, it could be auto, it could be PSU, and even capital goods. But let's be mindful of the fact that we've rallied a lot and there are issues at the borders, which obviously people are talking about. It's not in your control, but I've always believed that the markets are the best judge of geopolitical situations. We've seen that with the Middle East last year. As of now, the price action looks quite relaxed. I know India VIX is above 18, which is a bit of a concern, but the price action itself is not too negative. And I would say that till the Nifty is above 23,800, which is now the most important support for the rest of May, I would say this is a buy on dip kind of market.
Meanwhile, auto giant Mahindra & Mahindra reported a better than expected March quarter, citing robust growth, execution excellence and disciplined capital allocation as key drivers. In an exclusive conversation with NDTV Profit's Hiral Dadia, Group CEO and MD Anish Shah shared insights on the company's tractor business, growth outlook and the strategic implications of its recent acquisition of SML Isuzu.
So our approach has been that we pick certain areas and look for very strong execution in those areas. Our business in this space has spent the last 3 or 4 years reinventing itself, coming up with a much better set of products, a much better customer service, a wider footprint and so on. So that gives us a lot of confidence. In the LCV segment, we have a 51.9% market share, and that's up from the low 40s just a few years ago. And SML is going to really help us focus on the intermediate segment right now in commercial vehicles. And we feel we can do well in that segment. And then we should look at heavy trucks and buses after that. So that is going to be tougher to penetrate with some strong players there. But that's one where at this point in time, at least, we will focus on intermediate. And we will look at that at some point.
So would it be right to say that this is going to be a space where Mahindra is entering, which is absolutely growing, but complicated and competitive? So the gestation period to get where you want to get is probably 5 years down the line?
In the intermediate segment, we're actually much better positioned. Because with buses, for example, in this space, we will have a combined share of 20% or so. And yes, it is a competitive space, but that's what we are used to in all the spaces.
But the capex also becomes very high in this segment, right? And that's what you've seen in terms of trends with other players. And building the electric bus at scale is a capital intensive business. So how do you counter that?
So we don't expect any more capex than we have outlined in the plans for both businesses. And we should be able to have a strong position with that, as we have in other segments today.
Meanwhile, DPAM Secretary Arunish Chawla, in an exclusive conversation with NDTV Profit, said that the IDBI bank stake sale is on disinvestment is on track and things will be strategically disinvested. Let's listen in.
IDBI disinvestment is on track. Government has taken a decision. It is publicly announced that we will strategically disinvest 30% of government stake and 30% of LIC stake to a strategic investor through a fair and open process. It's a complex, multi-stage, multi-layered process. We are working day and night and taking it forward. The data room has been established. The due diligence is being done. The share purchase agreement is being negotiated. And as it moves on, you will get the fair, correct news at an appropriate time. And I must emphasize that such decisions are not affected by macro shocks in the market.
Okay.
This is determined by a fairly well-calibrated, well-sequenced disinvestment strategy. And we are committed to implementing the government decision transparently and expeditiously.
And despite earlier optimism, sources say negotiations for the India-UK free trade agreement have hit roadblocks, postponing the expected conclusion during high-level meetings in London on April 29th or May 2nd. While significant progress has been made, unresolved critical issues are preventing a final agreement. To break down the key deterrents holding up the deal, let's turn to my colleague Rishabh Bhatnagar for more insights.
Right, what we're hearing on the India-UK FTA talks, the free trade agreement talks, is the fact that the final closure will still take time. Now, why this is important is because when Union Commerce Minister Piyush Goyal visited Europe, he went to 3 cities. He started off at London. He went there on April 29th. He then moved to Oslo and Brussels, and he then returned to London. So the first time he was in London, there was the expectation that the India-UK FTA closure would be announced. There was a press conference also announced, but that was cancelled last moment. Then Piyush Goyal, at the end of his Europe tour, again visited London in hopes of being able to announce the India-UK FTA conclusion of negotiations. However, again, on May 2nd, that wasn't made possible. Since then, Commerce Minister Goyal has returned to India, and there is no sort of particular timeline on when the India-UK FTA could see its closure. What we're also seeing is the fact that there are 4 to 5 key issues that are currently still not resolved and might need resolution. The first one could be the sunset clause that is part of the bilateral investment treaty. That is something that is being discussed currently. The second could be UK's new carbon tax, and the third also data localization remains a big one. So there are 4 to 5 key issues that are still left hanging, and there might be further rounds of negotiations that may be lined up.
Thanks, Rishabh, for that. And moving on, let's take a look at what happened in the Apex Court with regard to JSW Steel on Friday. A Supreme Court ruling involving JSW Steel, Bhushan Power, and a 19,000 crore acquisition is making headlines. The court cancelled JSW Steel's takeover plan for Bhushan Power and Steel, citing violations of key rules. But beyond this decision lies a broader story of failed resolutions, misrepresented facts and lender concerns. To understand what went wrong for the company once positioned to rescue BPSL, let's turn to my colleague Charu for more insights on this. Charu, take us through what exactly the Supreme Court said on Friday, and more importantly, how that process actually works.
Hi, so the Supreme Court has, in a very groundbreaking ruling, has come out and basically cancelled JSW Steel, steel takeover of Bhushan Power and Steel Limited. Now, why is it important? See, these resolutions and takeovers usually take place under the Insolvency and Bankruptcy Code. Now, IBC has a very simple founding principle, that is, time has to be reduced in doing these processes, and bad loans have to be taken care of very quickly. So the court has said that JSW's resolution plan was illegal and did not follow the IBC rules, which means that despite being, the successful resolution applicant for several years, the resolution plan was not really taking any action, was not really following the steps which it was supposed to follow. The court also came down heavily on NCLT and NCLAD for passing a resolution plan and not taking care of the voices and concerns of the lenders. What happened here is that the court has also called upon the wisdom of the Committee of Creditors and the resolution professional, because it is, saying that it is not really hearing the voice of the lenders, which include State Bank of India, Punjab National Bank, Bank of Baroda and several more. So what happened here is that the resolution plan that was approved, was worth over 19,000 crore rupees. However, the claims of the lenders were over 47,000 crore rupees. What does this mean? This means that the voices of the lenders were not really being heard, and any action towards doing this very swiftly was not taking place, and the court felt that the principle, founding natural principles of the law are not being followed, and that is why ordered for liquidation of Bhushan Power and Steel Limited.
Right, Charu, thank you so much for bringing us those updates. We'll continue tracking the story and bring you all of the developments. Moving on, Brent crude oil has dropped 21% in 2025, falling below $60 per barrel, benefiting Indian companies. Indian Oil and BPCL save on crude costs, boosting profits without raising fuel prices. Airlines, paint and cement industries see lower expenses due to cheaper oil-based materials. However, ONGC and other oil producers suffer as they sell crude at lower prices. Meanwhile, OPEC Plus is increasing output by 4.11 lakh barrels per day in June to regain market control amid US pressure and internal production surges, keeping prices low but straining finances. And moving on, sources are telling NDTV Profit that Tata Consultancy Services have reduced the variable pay for senior employees for the third consecutive quarter, signaling continued cost control measures. For more insights on this, let me quickly turn to my colleague Haripriya, who joins me on the phone line with more. Haripriya, a worrying trend actually emerging as this now happening for the third time in a row.
Just like this is the third quarter in a row that the variable pay has been slashed. For the first quarter, it has been cut by 69%. Previously, it was cut by 78% and before that by 55%. This is essentially when the sector itself is going through seeing a weak demand environment. Now, this is also added blow because TCS is also delaying the annual wage hike. As it had flagged in the recent management committee that happened during the first quarter. Some of the employees that we spoke to did tell us that this is despite them being good performers and following all the work from office rules and being on active projects that are in the roles right now. This variable pay essentially constitutes about 20 to 20% of an employee's salary and is a quarterly payout depending on their employee levels. This is majorly done for the senior employees that are on the higher wage role. This is also a continued phenomenon now because even in the last year we saw a couple of other IT companies, including Infosys also, which had slashed the variable pay. This comes as the sector is going through a downturn and business is harder to come by with tariff wars being in on the demand environment.
Haripriya, thank you so much for those updates. Another bleak quarter for TCS employees as variable pay has been slashed for senior employees third time in a row. Moving on, let's shift gears to what's happening between India and Pakistan now. Tensions remaining high following the deadly April 22nd Pahalgam terror attack, with Pakistan continuing unprovoked firing across the LOC for the 11th consecutive night. In response to the escalating situation, Prime Minister Narendra Modi met with Defence Secretary Rajesh Kumar Singh today, a day after receiving a briefing from Air Chief Marshal AP Singh on the Indian Air Force's preparedness and potential retaliatory options. Meanwhile, the United Nations Security Council will discuss the rising conflict today. As part of its retaliatory steps, India has suspended the Indus Water Treaty and temporarily halted water flow through the Baglihar Dam on the Chenab River, intensifying the geopolitical standoff. Now, in Jammu and Kashmir, security forces have escalated efforts to locate those responsible for the deadly Pahalgam attack, focusing on 54 key routes originating from Baisaran. This operation involves ground forces, aerial surveillance and intelligence units working in close coordination to track the perpetrators. For a comprehensive breakdown of the latest developments, NDTV Shivarur provides this in-depth ground report on the search operation.
2 weeks later is telling as to how difficult the terrain is and how much support these terrorists have actually had on the inside. Remember, the enemy within is another aspect that simply cannot be whitewashed. It simply cannot be ignored, because those were the overground workers for sure who very likely helped the terrorists operate in these highlands, cross the passes and enter Pahalgam at least a few days before that attack took place. According to security agencies, 2 locals from Pahalgam are very likely to have visited Pakistan at some point, perhaps come back as well through different routes, and then laid out the entire logistical route for those terrorists. So as we sit here in Pahalgam, just shy of 2 weeks since that terror attack, the truth is writ large. The men responsible for the butchery of sinking Kashmir back into darkness could still be out there in one of these forests. They still could be contemplating which hideout to exit from and which route to take into different parts of Jammu and Kashmir. Where they are is not clear. The details of the investigation are still to be fully out, and over 100 overground workers have been questioned. There is no clarity as to whether a direct link of even a single one of them has yet been established. But the difficulty and complexity of the operation, as you can see in the terrain here in Pahalgam, is going to continue. Hopefully, there will be some news to share soon as far as the terrorists are concerned.
And as India-Pakistan tensions rise, India has briefly halted water flow through the Baglihar Dam on the Chenab River following the suspension of the Indus Water Treaty. Given irrigation's critical role in Pakistan's economy, this move could have far-reaching consequences. So to understand the impact of this decision, Kushvinder Vora, former chairman of the Central Water Commission, spoke with us earlier.
If we talk about very short-term impact of that, say that now we are not, obligated to share our flow data and also the flood data, which is very vital for management of water resources for any country. So if that flow data and flood information, which was coming to them somewhat in time frame, is not available, so their water management will definitely be affected. 80% of irrigation is from Indus system in Pakistan, and their 20% of GDP is basically based on irrigation. Now, to affect the irrigation, it is not necessary that we should entirely, cut off the entire water for that matter. But once we are doing irrigation, we are growing the crops, we do watering for number of days, right? So number of waterings in many 10 dailies kind of situation. And even if it is the water supply is affected in any 110 daily of particular crop water, when the crop was vitally requiring the water, that completely destroys the quality as well as quantity of the irrigation.
Meanwhile, global ratings agency Moody's has cautioned that rising tensions with India could severely restrict Pakistan's access to international financing, further straining its already fragile economy. In its latest report, Moody's highlights geopolitical friction as a major risk factor, warning that Pakistan faces growing financial pressure while India continues to strengthen its economic dominance. My colleague Malika now joining us live from the newsroom with more details on this. Malika, take us through what exactly the report has said.
Right, Sanjana. So basically, there are 3 simple points one needs to understand from this Moody's report. The first one that Moody's highlights is that sustained escalations between these 2 countries, while it may not have economic repercussions for the country itself, but it could be a setback for Islamabad, as its forex reserves could come under pressure and weigh in on the growth of the country. Then the second point that Moody's is making is that persistent increase of tensions between the 2 countries, what it could do is hit the axis or affect the axis of Pakistan to foreign exchange reserves or international funding. And remember, Pakistan is already under severe debt. So this could, in fact, act as a deterrent for Pakistan to clear its years-long debt that the country is already facing and is drowned in. Third point that Moody's has made is, while Pakistan and India are in the midst of high tensions, higher defense spending from India's side could potentially weigh on India's fiscal strength and slow down its fiscal consolidation.
Thank you, Malika, so much for that. We'll continue tracking the story and bring you all of the developments. Moving on now to more tariff drama. President Donald Trump has announced a 100% tariff on all foreign-produced films, aiming to boost Hollywood, but sparking concerns globally. For Indian cinema, this move could increase costs, making theatrical releases in the US market less viable. The US and Canada are key international markets for Bollywood and regional films, contributing significantly to box office revenue.
Other nations have been stealing the movie-making capabilities from the United States. And I said to a couple of people, what do you think? I've done some very strong research over the last week, and we're making very few movies now. Hollywood is being destroyed. Now, you have an incompetent, grossly incompetent governor that allowed that to happen. So I'm not just blaming other nations, but other nations, a lot of them, have stolen our movie industry. And I'm saying, if we're not willing to make a movie inside the United States, and we should have a tariff on movies that come in. And not only that, governments are actually giving big money. I mean, they're supporting them financially. So that's sort of a threat to our country in a sense. And it's been a very popular thing.
And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Apollo ties. Now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind? Hello and welcome. We are in the thick of earnings, and in between all of those, we're going to try to squeeze in SBFC Finance. Now, it's interesting because it's an NBFC firstly. It trades at around 3 times price to book. And when it comes to the ROA and the credit cost, it's held up very, very well. Even in terms of growth guidance, there's been no concern as of now. And that's why in this cycle, this one becomes very interesting to understand. Let's first understand as to what I want to really look for when I'm trying to analyze this one. Can the credit cost and asset quality sustain? Currently, NBFCs are seeing pressure, a lot of them, with regard to asset quality. This one is not seeing too much pressure. Even in terms of credit cost, you're not seeing too much of that impact coming on the P&L, and therefore, can that sustain? Because that will lead to likely better growth outcomes. And that's probably my second point here, to try and understand whether there's a downside risk to that 5 to 7% QOQ growth guidance. So very, very strong growth guidance. Can that really sustain is my second question. My third question is with regard to increase in leverage, and why I say this is because the capital adequacy of SBFC is at 35%, which means that it has a sizable amount of equity within that capital base that it has and that it disburses from, and therefore it has good bandwidth to take on borrowings onto its balance sheet and reduce its capital adequacy to grow. So they will now likely start using more and more of borrowing, which they've already been doing. But as they do that, their capital adequacy will come down, but their interest cost will go up, and therefore their margins will come down. And therefore in such businesses, better to look at spread than margins. But as the margins squeeze, does the ROA, which is the return on assets, which is a measure of profitability, does that also come down? So that is the other piece that I want to look at. And last off, cost efficiencies. Its cost to income has come down from 50% to 40%. And therefore, what you're seeing is a better profitability which is coming through. Can that continue, and to what extent? So we'll try and bring out all of these points when we have a chat with the management. But that's the first piece of it, what I want to know. Now I'll come to the fact as to what the company does, because that's what we do on KYC. We try and break this company down. We'll first start off with what the company does. It was incorporated in January of 2008. It was incorporated as MAPE Finserv Private Limited, renamed to Small Business Fincred India Private Limited on the 3rd of July 2017, and then called SBFC Finance Private Limited from the 24th of October 2019. It converted into a public limited company on 30th of September 2022, and thereafter listed on exchanges on the 16th of August 2023. It raised around 1,000 crore worth of capital, and it is co-promoted by Clermont Group and Upwood Group. Now, in terms of product, it includes MSME loans, secured MSME loans, and gold loans. So loan against gold and secured MSME. Understanding is 100% of the book is secured. We'll obviously get better perspective as to what the risk could be in case of default. How long does it take for them to liquidate some of these assets if at all there is a default? It also offers, and this is where it becomes interesting, loan management services to third-party financial institutions, particularly in Tier 2 and Tier 3 cities. It's known to have a good process in terms of loan disbursement and loan collections, and it leverages on those. It operates through 205 branches. Branch count has increased by just about 10 or 15, so around a 7%, 8% kind of branch count growth over the last year or so. And it has around 4,294 employees in 16 states and union territories. So good, large presence as well that it has. In terms of its key milestones and what it really likes to boast about, one is it first off acquired Kavi's lending book at 845 crore. That was what happened. Now on top of that, it also had between 2017 and 19 adopted the phygital model, which is combining technology with in-person customer service. They in no way continue to push digital only. They are very much physical plus digital. They converted to a public limited company for their IPO, of course, and they listed in August of 2023. The IPO price was 54 rupees a share. They listed at a 44% premium. And currently, the stock price sits at around a 25% or has given 25% returns from the listing price as well. So decent amount of returns as well that the stock has given. But let's quickly look at the key metrics and what we'll try to break down in terms of giving the KYC rating that we do on this one. We'll start off with the income statement. We'll thereafter look at the balance sheet, the operating metrics. We'll look at asset quality. We'll also look at the shareholding pattern thereafter. We'll look at valuations, street cred and street coverage, which we generally always do. So broadly, that's how we'll try and cover all the bases. I'm going to first start off with income statement as we do. And, it's a fairly healthy setup here. You look at the way in which your net interest income has gone up. It's gone up from 250 crore in FY22 to 777 crore in FY25. Very, very strong growth on that net interest income number. Also, the NII has grown faster than the AUM, which is again a very healthy sign. Provisions are up around 27% at a compounded rate, and profit after tax is up a very solid 74%. OPEX, as I did mention, is one of those reasons why your profit after tax has seen a bit of a surge, along with scale and economies of scale playing out with regard to the business. But that's how the numbers stack up. A clear thumbs up with regard to how the income statement has shaped up. The balance sheet last 3 years, very similar, strong balance sheet that we've seen. AUM has gone up from 3,100 odd crore to 8,700 odd crore, which is a 40% growth YOY, and compounded for 3 years. That's very, very strong. Look at the capital adequacy. It's gone up because of that fundraise that they had in the middle of 2023. So that has led to an increase in capital adequacy. Currently sits at 36%. Again, very healthy capital adequacy. Now let's look at operational metrics, and this is where some of the details start to come through. So you had ROAs which were sub 4% prior to listing, which is FY23. Thereafter, it crept up to above 4% and continues to go up. Can it sustain is the question again. Margins, which were at around 9.5%, have gone up to 10.2%. I did mention that you could see a margin shrink because interest costs could go up. We'll quiz management on that, but that's a risk, and therefore we've given this a neutral, whether the ROA number can sustain or not. Spreads have also gone up from 7.5% to around 8.5%. OPEX to assets has come off sharply, and we spoke about this as well. OPEX to assets has come down from 5.5% to 4.65%. Whether this can continue to shrink and how much scope is there for that will be one of those questions which will likely determine how ROA shapes up in that second row. So that will hold the key. But that's how the operational metrics, setup is. We've given this on neutral, and of course we'll quiz management on how this plays out. But let's look at asset quality, and this holds the key from a perspective that you look at the stability on that 2.6, 2.4, 2.7. So you're seeing very little variation in that sense, at least over the last 3 years. You're not seeing some major concern there. And you look at net NPAs as well, and that is also fairly robust, 1.6, 1.4, 1.5. That's how it's played out. You look at the last 3 quarters journey as well, 2.7, 2.7, 2.74 on the GNPA count, and on the net NPA count 1.6, 1.6, 1.5. So fairly steady in that sense, but not necessarily a space where asset quality will continue to remain steady. You want to continue to watch out for this metric. Don't have a very large history with regard to this one, so you want to wait and watch. A neutral on this count because you want to be conservative where asset quality is concerned. Shareholding pattern. Now, in terms of how that has evolved, look at promoter holding, 53 to 54 odd percent, fairly steady in that sense. FIs hold around 5 to 6 odd percent, 6.5 odd percent. Apologies. So yes, DIs hold around 17.5 to 17.5ish percent, and the public shareholding is roughly 22 to 23 odd percent. That is how some of the shareholding has evolved. We've seen a bit of inch up in terms of FII holding over the last quarter or two maybe. And within the DIIs, you have SBI Small Cap Fund, which is featuring, and you have AB Sun Life Fund, which is also featuring. With regard to this one, you also have Franklin India Smaller Companies Fund, which also features. Among public holding, again very interesting, you have an Amansa, which holds around 3.8%, but has been very mildly reducing its shareholding by around 0.01%. And you have Aseem Dhruv, who is the MD and CEO. Again, interesting, because Aseem Dhruv is ex-HDFC Bank, the current MD CEO of SBFC, who holds around 3% in the company. And then you have Malabar India as well, among others, which holds around 2 odd percent. So you have some interesting shareholders as well within this basket, and a thumbs up with regard to this one. Mind you, the market cap on an SBFC is 11,000 crore. So something to keep in mind in terms of the shareholding and how much of the market cap gets derived from some of these promoters and how much do they own. But let's look at valuations now, and we've kind of compared this to a Manappuram from a perspective that it gives you some flavor with regard to gold lending, but gold lending is a very small composition of the overall loans of SBFC. It currently trades at 3 times 1 year forward price to book, which is certainly not cheap by any standard. Credit Access is a pure play MFI, which trades at around 2.2 times, but it has its set of asset quality issues. So again, may not be the best comparable in that sense, but we'll give it a neutral with regard to where valuations is concerned, not the cheapest on the street. Let's look at street cred, and in that sense, it's done okay when you're looking at the street credentials. Again, since listing, it's not given a significant return from the listing price. So if a shareholder had bought at IPO, they've made decent amount of money, but post listing, we're not seeing a very substantial rally in the stock price, just about a 25% fair return, and for a small cap, that's still quite decent given the way in which some of the small cap indices, or rather the benchmark, has done. Let's look at street coverage now. Last off, you have 4 buy calls, 1 hold call, 1 sell call with a potential 15% return. Surely a thumbs up with regard to that. You have a decentish kind of coverage and a decentish kind of return expectation on this one. Before we look at both the KYC ratings as well as we speak with management, let's slip into a very short break. Of course, we're going to speak and ask the management about all those questions that we spoke of.
Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? Let's quickly move on. You know, it's time when we go across and speak with the management. We have Mahesh Dayani, who is the Executive Director at SBFC, joining us right away. Mahesh, you know, good speaking with you. Thanks for coming in. I want to first talk about the fact that what are you seeing on asset quality trends and what are you seeing with regard to how your asset quality is evolving at this juncture, because several NBFCs are facing asset quality headwinds at this point. Your book looks relatively okay. Talk to us about that.
So I think you'll have to differentiate between various asset classes. So you've got largely secured and unsecured, and the conversation is largely related to retail. Unsecured obviously has been going through some bit of turmoil, and a lot of noise and a lot of warnings were placed sometime last year. What you're seeing currently is basically the outcome of what excessive lending had happened over these years. And if I were to talk in terms of priority or in terms of quality, I think MFI was the worst hit, followed by unsecured business loans, personal loans, credit cards. So you have a commentary which isn't too positive, but incrementally what you see is that largely the unsecured or some bit of credit card, the stress seems to be easing off, still not out of the woods, but incremental stress seems to be easing off. MFI, I guess the stress is still there. And that's what, when you look the Q4 results, that's what really comes out. If you look at secured, I would say most of the players in the affordable side have reported a reasonable, stable quarter. We've been no different. Last year, we had paused our disbursals, so we didn't really have a significant jump in disbursals, but that was being cautious right at the beginning of the year. The numbers, the bureau numbers that were coming out weren't too great. So we took the foot off the accelerator way back then. And what you're seeing the numbers now is just largely on account of prudence in terms of the disbursals that we did last year. The way we look at it, I don't think significant changes happened at the leverage level. But we're a small company, so to commit our momentum, whether it's on disbursal or the asset quality moving forward, isn't too difficult. So we've always maintained that our delinquencies are going to be range bound. Credit costs is going to be somewhere around 1%, 10 basis points here or there. And the NPAs are also going to be pretty much range bound. So that's some degree of solace if you're completely a secured lender, either by property or gold.
Sure, point taken. But what gives you that confidence, Mahesh? Because while you are secured, I take that point, but you still lend to the MSME space.
So I think one of the key things is that we're well diversified across the country. So we've got almost an equal contribution from all zones. So you don't really are clouded under an event risk. So an event risk in a Karnataka or a Tamil Nadu or any other state that may happen really doesn't impact us. It doesn't take the wind away from the momentum that we've been building. And because the concentration risk is limited to at best 8-10% in a single state, we wouldn't really see us getting stuck in an air pocket for a fairly long time. If there is a particular event, at best you're probably impacted by a month or two, but it really doesn't disturb your apple cart significantly. So that gives us the confidence saying that unless and until obviously you have a large event which impacts the entire country, then it's a different thing. But some spurts here or there is obviously not going to rock the boat too much.
Okay. And is there a specific cohort? Is there a specialization of the type of borrowers that you lend to, Mahesh? Because again, that credit cost number of 1% which you are targeting, and maybe 10 basis points here or there, I'm trying to assess, judge what's the downside risk to that.
So, if you go back even during COVID times and you look at most of the bureau numbers, the highest delinquency that's gone is anything between 4 to 5%. And I'm talking about roughly ticket sizes ranging anything between 1 lakh to 30 or 40 odd lakhs. And even if you have an LGD of say 30 odd percent, slightly higher, your credit cost is not going to completely go out of the park beyond 1.5 odd percent, or probably nearing 175. So that's the worst possible outcome when your entire country is shut. You don't have the ability to lend, you don't have the ability to collect. That's the worst possible outcome. So even if we were to look at that kind of a scenario, we're saying that your standard deviation is almost 2 times from where you are, which is very unlikely to happen. So even if you look at any cohorts and you probably cut down data to events which are state specific or pan-India specific, you're pretty much range bound on a secured lending side. So whether it's home or non-home, so you will have a particular range to play. Obviously, your efficiencies and your ability to execute comes into play, and that's what probably shows up in our numbers and the guidance that we've been given.
And Mahesh, the security that you take, one is loan against gold. What are the other assets which you give loan against? That's the first part. The second part is, in case of default, how complex, how complicated, what's the kind of time lag for you to make that recovery?
So in terms of properties, you rightly mentioned, gold obviously has the gold as the collateral as the security. With respect to properties, almost 85% is residential property, largely self-occupied. You have close to around 7 to 8%, which is commercial. And the balance is a bit of a mixed use kind of a properties. Answering your second question with the time that it takes, if loans do qualify under SARFAESI, then you have a fast track of resolution that could range anything between 18 to 24 months. If those are outside of SARFAESI, then it could go to 36 and 48 months.
Understood. And what's the risk like on growth, Mahesh? Likely the only risk is the fact that you could have an asset quality slip up, but that you seem to be confident of that. And therefore, this 5 to 7% growth, how long do you expect this to be sustainable for QOQ?
I think the only risk is going to be our own stupidity of not executing it well. I don't think we're going to go down because of the market not being large. So the market's almost at 3.5 lakh crores, growing at almost close to 21 odd percent. And that practically means that you double every 3 to 4 years. So I don't think growth is a challenge. How well do we execute it? How well do we execute it efficiently? How well do we execute it without burning too much of human capital, financial capital, and remaining profitable at a branch, at a unit level? I think that's what probably keeps us awake. I don't think there's an overhang of growth. And that's the reason what we've always maintained, that growing at 5 to 7, which means that you're annually growing anything between 25 to 30, doesn't seem to be a challenge on a segment which is a priority for the economy, for the regulator to grow, even not for the next 1 year, but obviously for the foreseeable future as well.
Sure, and what does, of course, you'll be looking to increase leverage, right? You're at a 35% capital adequacy. What do you expect and when do you expect your next fundraise at? Is there a thought process there? 20% capital adequacy, 25%? What's the kind of bandwidth you leave? And therefore, as your debt goes up, explain to us where your margins will normalize at.
So currently we are on an ROA basis closer to 4.5%. So practically at a leverage of close to around 3, our exit ROEs are closer to 13%, slightly more. So we have some degree of leverage which is available. I think our first milestone is to hit 15% in terms of ROEs. Which should probably happen by the end of this particular financial year or the first quarter of next year. But that's something that's been consciously designed to go in. Because our ROAs are high and we keep on accruing profits on a year-to-year basis, we don't see ourselves going back to the market at least for the next 8 quarters. Clearly, I think the first of these milestones have to be achieved. Adequate return has to be delivered on the business that we're delivering before we go ahead to the market. On a debt to equity, we're barely less than 2. I think we have enough room to take it to 3.5 on an operating basis. Considering that the rating upgrades that we've had consistently, obviously subject to our operating performance, we don't see a challenge going up to the leverage of 3.5 times from where we are.
Point taken. And therefore, where should your NIMs and ROAs normalize at, Mahesh? How should one look at those numbers?
So I think instead of NIMs, one has to look at spreads in a business. So largely what it means is that at what you lend and at what you borrow, and that brings in the efficiencies. If you're really doing well, your rating is on your side, so your borrowing cost technically should keep coming down. Ability to lend at the right price is important, whether transmission of interest rates happen on time. That seems to be very critical. So what we've maintained is we will continue to maintain our spread, and that's been our narrative all through. Some minor basis points here or there, but largely our spreads are going to remain constant all through the year. So we don't see that changing.
And ROA, Mahesh, therefore, and cost efficiencies and their impact on ROA, how much more can you optimize OPEX?
So what tends to happen is, we swallowed the frog upfront and took a higher cost at the start.
Sure.
And so what you would see is a downward sloping curve with respect to our OPEX. So we've been always maintaining that our OPEX should start seeing a downward towards almost 50 basis points a year. Last year, we, I think, did well on that count where the OPEX came down by almost 70 basis points. This year, we continue to maintain the same trajectory that our OPEX is going to continue dropping by 50 basis points. So if you do the maths, if we continue our efficiency run and we are leveraged to 3.5, so your ROE impact is 50 basis points multiplied by 3.5. So that gives you almost 165 benefit on your ROEs. And that's what, gives us the confidence of hitting a 15% ROE by the end of the year or the next first quarter of next financial year.
Point taken. Thank you so much, Mahesh, for coming in, speaking with us. And of course, it'll be good to track this through FY26 as well. So looking forward to our next conversation as well.
Thank you.
But that's the management of SBFC. We've spoken about pretty much all that we had to. We're going to quickly look at the ratings on our KYC rating with regard to the parameters. That's how it stacks up. Good growth on income, balance sheet, operational metrics fairly healthy, but we've cautionary given it a neutral. Asset quality neutral as well. No major changes on any of those counts. Shareholding thumbs up. Valuation neutral given that it's quite steep in that sense. Street cred neutral and street coverage thumbs up gives it a 6 out of 8 on our KYC ratings. But we're out of time on this edition of KYC. We hope you found this helpful. Stay tuned, more action on the other side.
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. I do want to say at the start that we listen to you in the comments that you put up on our videos that get posted online. And just a couple of weeks back, we had a conversation about savings bank accounts when a lot of the frontline banks reduced their interest rates on these accounts quite substantially. And we said it's not the best idea to keep a large amount of money lying idle in your savings account. Now, the counter to that, of course, is that investing instead as an emergency fund in a mutual fund is maybe not the best idea in terms of liquidity. Of course, yes, you get the money the next day, but in certain cases, and one of our viewers pointed out that he had a heart attack and his children or his wife did not have access to the mutual fund account. And so they needed money in their savings bank account so that he could be rushed to hospital and the immediate expenses could be taken care of. So we'll talk about this, but I also want to talk about a new category that is catching the eye because of the change in the taxation of liquid funds and fixed income mutual funds, which is the income plus arbitrage fund. What is this all about, and how should you go ahead and plan your emergency corpus? Joining me now is Mohit Gang, the co-founder and chief executive officer of Moneyfront. Mohit, it's great that we're having this conversation because incidentally we'd had that conversation about savings bank accounts. So let me start by asking about arbitrage funds. Just to set the context, I think that would more than anything else, because this is a category that is in the equity category, equity taxation, and it has gotten a lot of attention because of the change in taxation. So how does it work first?
Okay. Hi, Alex. Always a pleasure to be on your show. Look, arbitrage category has become immensely popular. More so after the 2023 changes in debt taxation. Since the time debt has become completely taxable. Previously, if you recall, Alex, debt funds were taxed with indexation. After 3 years, you could have claimed a long-term capital gains taxation and could have adjusted indexation against it, right? But that's no longer valid. And since the time debt has become completely taxable, I think arbitrage as a category has become immensely popular because it gives you equity taxation advantage. However, the return profile of the fund is more debt-like. When I say that, it means that arbitrage funds are completely hedged positions. They don't take any long calls on naked equity, which means there is zero long equity exposure. Whatever equity exposure they have in the portfolio, it's completely hedged. Right, so clients don't have any relationship with the market movement or the index movement. Yes, market volatility can impact arbitrage returns and the interest rate movements can impact arbitrage returns, but it's a pretty safe bet to go for. If you have a holding period of 3 to 6 months and beyond that, then yes, it's a great category to be in. The tax advantage, as I said, if you hold it for over a year, you get 12.5% long-term capital gains taxation, and less than a year, it's categorized as short-term, which is 20%. So equity taxation on a post-tax basis gives you a much higher return than any other debt, short-term debt fund like your liquid, overnight, ultra-short, and money market. So if you compare with these categories, then it's a great choice.
Okay, so a couple of follow-ups then in that. When we look at the way that these arbitrage funds are constructed, is there at all any debt or fixed income component in these arbitrage funds? And when you redeem the units, how quickly do you get your money?
Okay, fair questions, Alex. I think in any arbitrage fund, there is a significant debt composition. So typically an arbitrage fund will have, let's say, 65 to 75 odd percentage of arbitrage positions, which are the positions which a fund manager has been able to identify where he thinks he will make a slightly higher return than the debt returns or the short-term debt returns prevalent in the economy. However, no fund manager in any kind of market format can typically figure out 85-95% of the portfolio completely into arbitrage positions. So they go ahead with 30 to 35% debt position in the portfolio. That portion of debt could be short term, medium term, or even long term in some cases. But most of the fund houses prefer keeping that debt in ultra short debt instruments or call money market so that they can immediately deploy it either in arbitrage positions or they can use it for any redemptions proceeds which they have to pay out for. Okay. And the redemption cycle for arbitrage funds is T plus 2 days, T plus 2 business days, unlike a debt fund which is T plus 1 business day.
Okay, so that's an important point to bear in mind. You might treat it like a liquid fund, but it's not, obviously not a liquid fund, where a liquid fund or an overnight fund also, correct me if I'm wrong, Mohit, is available to you for redemption the next day. Is that right?
Yes, it's available to you. If you redeem today before the cutoff time, then the money is available to you in your bank account the next business day for liquid and overnight and any kind of debt funds, but not for arbitrage.
Okay, so that's an important point to bear in mind. I also want to talk about that 65% threshold that you mentioned. That is what takes you above the equity category for equity taxation, right?
Oh yes, absolutely. Typically, because all these positions are hedged, there is no, as I said, there is no naked equity exposure out here, but that is required to give them an equity tax advantage.
Okay, so we've now established what arbitrage funds are, and we talked about why they are being preferred by a lot of people, because liquid funds now get taxed at the slab rate. So a lot of people have shifted to arbitrage. Of course, there are disadvantages. As our viewer has so rightly pointed out, accessibility or liquidity of funds is a very important factor to bear in mind. But let's talk about this income plus arbitrage category, where the mutual fund industry has floated more products to take advantage of the change in the tax rules. Why is this a category that is seeing more interest, Mohit?
Okay, this is a very fascinating category which has evolved, I would say, in last 3-4 months, Alex. There were funds in this category previously, but they weren't being managed very actively, or even the fund houses weren't focusing on this category. But post the tax changes, in the last finance bill, the ETFs, the fund of funds and everything, previously the taxation was at slab rate. They've now become, you now get long-term capital gains taxation on that after completing 2 years of holding period. So post 2 years, the gains are LTCG and taxed at 12.5%, which is a significant change. Previously, the FOFs or the fund of funds were categorized as long-term, basically they were categorized as debt funds for tax purposes and were completely taxed at marginal rate, right? So that advantage wasn't there in holding any kind of FOF or an international fund or so on and so forth. So now after the change in taxation, this category becomes extremely useful. So out here you will have equity composition, not equity composition, you will have arbitrage composition, which is greater than 35% in the portfolio. So that, and the debt composition is the remaining part of the portfolio. So then finally, if you hold the fund for 2 years plus, you get added advantage of 12.5% taxation.
Okay, so important to understand the limits here, whereas in the arbitrage fund, they had to have the 65% limit for arbitrage. In this income plus arbitrage fund, they need to maintain a 35% at least of arbitrage to get that 12.5% long-term capital gains tax advantage after 2 years, right? If they're not maintaining that, then they would be treated as a debt fund, correct?
Yes, absolutely. They have to maintain above 35% arbitrage allocation to get that tax advantage.
Okay, so let's talk about this fund of fund structure, because, and rightly so, a lot of people also point out that the disadvantage of a fund of fund structure is that you get charged twice when it comes to your expense ratio, right? Because you're investing in a fund that invests in another fund, and obviously that underlying fund is going to have its own cost. So you're bearing the cost twice. How does this work, Mohit? And is it a significant disadvantage?
Alex, yes, prima facie, it is a slight bit of disadvantage. However, the advantages by virtue of taxation and what you are getting into finally outweigh the tax disadvantage, or not the tax disadvantage, sorry, the TER disadvantage, if you may call it so. Look, SEBI has stipulated rules for FOF, and SEBI specifically says that for any fund of fund structure, the complete cost of the fund cannot be more than double the weighted average cost of the underlying funds which are there in the fund of fund, right? To break it down, let's say if you have a fund which is income plus arbitrage fund, the typical composition out there is you will have a corporate bond fund and you will have an arbitrage fund as the underlying. So the portion of the fund is divided between these two categories. Now, let's say the corporate bond fund runs an underlying exposure, underlying TER of around 60 bips. And the arbitrage fund runs an underlying TER of, let's say, around 40 bips. So your weighted average cost of these two is the underlying cost of the fund. And the FOF is then allowed to charge something over and above to maintain the expenses of the FOF. So FOF, let's say the weighted average cost is 50 bips. So the FOF can typically go and charge anywhere up to 1% on this fund, but you will find most of the FOFs in this category charging 10 to 20 bips over and above the underlying cost. So the expense ratio which a viewer sees when he goes online is only the expense ratio of the FOF. The expense ratios of the underlying are not given in any of the websites which you go and check out when you check these funds.
So let's give an example just so that people understand this, right, Mohit? If you were to invest 100 rupees into one of these schemes, based on what you have described, you would have in a direct scheme 50 basis points of a cost. How would you work that out? 50 basis points, which would mean 50 paise on that 100 rupees. So, but how would you work this out?
Okay, let's take a very simple example. Let's say you have a fund and let's take an example. Perhaps you can take an example of a DSP income arbitrage fund. So they will have a DSP banking and PSU fund as an underlying and the DSP arbitrage fund as an underlying. Okay. Now the DSP banking and PSU fund would have an expense ratio of maybe around 28 to 35 odd bips. I'm not exactly aware of the numbers, but yeah, around that band. And the arbitrage fund will have an expense ratio in the similar range. So let's say the fund is investing 60% into the banking and PSU fund and 40% into the arbitrage fund. So the weighted average cost of the fund after giving the ratios in the proportion in which the fund is held into these two funds, you will find the weighted average cost to be around 50 bips or 40 bips, let's say. That is the cost of the underlying. Now the FOF will charge another 11 to 15 bips, or my sense is around 20 bips as the expense ratio for running the fund. So that's the running expense of the FOF. So the total cost for the investor is 20 bips of the FOF and the underlying cost of around 38-40 bips. So that's your total cost, and this is how you have to see it.
Yeah, so 60 paise on 100 rupees is the cumulative that you would pay. And remember though, that this is direct. On regular, you would have a higher amount. It could maybe go to 80, 90. Is that fair? 80 to 90 paise? Mohit?
Absolutely. I think that's the band. On regular plans of these funds, you will typically end up paying around 80 paisa to 1%. And on direct plans, I think the typical expense ratio would be somewhere between 40 to 65 bips.
Okay. Now, how does that compare? That obviously, and you've already pointed out that liquid funds and debt funds to that extent that are on the shorter end of the spectrum would be anywhere between 35 or thereabouts paise, right? And I'm talking about direct here. Arbitrage is also a similar kind of a treatment on. So you're paying more for investing into these schemes, but is the trade-off acceptable? And how does that work? You mentioned the scheme that you mentioned invests in a corporate bond fund, which by my understanding has a duration that is longer than your liquid fund, which is effectively a very short-term paper that it invests in, or an overnight fund, which invests in CDs and CPs, which is certificates of deposit and commercial paper and very short-term paper at that. So how does that have a bearing on the return expectations that you might have?
Alex, look, I think one has to be very clear. If you're investing in this category, then the holding has to be over 2 years. If you're investing for less than 2 years, then this category does not make sense at all. If you're investing for a tenor which is less than 3 to 6 months, then you are better off in a liquid or a money market kind of a category. If it is over 6 months to, let's say, around 2 years time frame, then arbitrage is the category for you. And if it is over 2 years and you really want to park safely, then income plus arbitrage is the category for you. Because what happens is, after 2 years, when you pay only 12.5%, let's say the combined yield in this portfolio, the YTM of the corporate bond fund here would be somewhere in the range of, let's say, 8.5, and the YTM of the arbitrage fund would be somewhere in the range of around 7.5. So the aggregate, the weighted average YTM of the fund would be somewhere in the range of, let's say, 8% or 8.15% or whatever it is. But post-tax, after 2 years, when you see, your returns are significantly enhanced because you're paying only 12.5% as compared to a normal standalone arbitrage where your YTM would have only been 7.5 and you paid 12.5. So you're better off in this case. Or a normal debt fund where your YTM was 8.5, but you paid full 30% tax on that. So on a post-tax basis, this category completely stands out. If you hold it for over 2 years, then the expense is also worthwhile. But otherwise, definitely not.
So then that's an important point to raise, and that comes up to the argument that I pointed out at the start of the program. Then Mohit, is it appropriate to use this as part of your emergency corpus? I'm sensing the answer to that is no. Because despite the tax advantages that you have, if you're not holding for a period of 2 years, and chances are in an emergency corpus, you would want to have more liquid assets. Does this qualify?
Absolutely, Alex, bang on. You can't be further away from truth on this one, that this is not the category for emergency parking. Look, we've repeated this time in and time out again, and I'll again put the hierarchy out there. If you really want to play emergency corpus, then 3 to 6 months of your salary has to be in a sweepable FD as a first thumb rule, so that it can be withdrawn overnight. Or if you believe in the concept of Insta Cash, which is a mutual fund instrument, but again, the limits are pretty low out there. So you can do that. And then post that, once you have parked your money in sweepable FD, then comes liquid, overnight or money market instruments. After that, you have an arbitrage category where you park funds which are meant for beyond 6 month parking or beyond 3 month parking at least, if not 6. And when you are sure you want to do a fixed income allocation, you don't want to take chances in equity market, but you have a pretty decent horizon with fixed income, which is say 2 years and above, that is when you get into an income plus arbitrage category. It is not an emergency replacement. It is not a fund for parking. It is a fund for fixed income investment as part of your portfolio allocation.
Okay. Now, just to drive home one last point, since we've established that, And you've pointed out how much you need to keep in your emergency corpus as well. So that question is answered. When it comes to the return expectations on this, you pointed out 2 years as well. The last 1 year would look really good for this income to arbitrage or plus arbitrage category, because you've had a declining yield situation where interest rates in the system have fallen, and so fixed income as a category looks better. Is it always the case that you can expect that? The answer to that would be no, right? Because once you have another rate cut maybe, or another 2 rate cuts, there's probably going to be a pause and then an increase in the rate cycle the next time. And when that happens, should you adjust your return expectations as well?
Alex, this is a very fascinating category. Every mango in the basket of this category is a different variety altogether, right? As many varieties of mangoes that's the kind of varieties you find in this category. So there is, let's say, an Axis fund which will have underlyings of at least 10, 12 funds, and not just Axis fund house, but other fund houses as well, right? There are funds which will have underlying as arbitrage plus banking and PSU fund, funds with underlying as corporate bond and arbitrage, funds with underlying as gilt and 10-year constant maturity and arbitrage. And then there is an ICICI fund which has even equity, 10 to 12% as underlying, some REITs, some cash and gilt and everything, right? So while an investor picks this category, he has to be completely aware what is the underlying. If he wants a long bond or if he wants a long duration bond as an underlying to play the interest rate scenario, then he has to pick the fund accordingly, which has underlying exposure of gilts. If he wants a slightly aggressive band, then he can pick something which has a little bit of an equity. If he wants a pretty moderate band, then he picks something which is a corporate bond and banking and PSU as an underlying fund along with arbitrage. If you want a very conservative band, then you pick something which has high quantum of traps and cash as underlying with low duration debt funds as underlying. So one has to be extremely cognizant of what he's picking up. The varieties are far and very, very different.
Okay, last question, a quick answer to this one, Mohit. So this would fit into your overarching fixed income allocation, I would think. And the second question would be, based on what you have described, what do you like in the category, and are you recommending that people go and invest in this?
It's a pretty complex category for someone to understand and fathom. Honestly, I'm not so much of a juggler when it comes around mixing and matching various kinds of debt instruments for that extra 30-50 bips kind of this thing with a 2-year kind of horizon. Again, it becomes a little sticky around, so that you have to hold it for that kind of an horizon. I would go with a simple, plain, vanilla, long duration debt fund right now. And for parking, I would go with arbitrage. I'll keep the two categories pretty separate because arbitrage any which ways gives me an equity taxation advantage. But someone who wants fixed income as a core part of their allocation for a pretty long term, then maybe yes, this could be a category. But again, one has to understand the nuances of the FOF very clearly before getting into this.
Okay, fantastic. Mohit, thanks so much as always for taking the time. Pleasure speaking with you.
Thank you so much. Thank you. My pleasure.
We have to slip into a very quick break. On the other side, we've got information on how you should invest in the gift city here in India, to invest in assets abroad, and more with regard to your EPFO nominations. Do stay tuned.
Apollo ties. Now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Welcome back. You're watching Your Money Matters. There are a lot of restrictions in place when it comes to investments into mutual funds that invest in assets abroad. Another alternative is investing through the gift city. My colleague Mahima has this report about what you should consider.
Right, so the question really here stands that what is the steps, first of all, the procedure to invest in global markets via Gift City. In terms of the steps, first you have to open a demat and trading account with IFSC registered broker. Transfer funds from your Indian bank account to that particular trading account. Using these funds, you can now start investing in international financial instruments. This could be stocks, mutual funds, etc. The limit, of course, for transacting is capped at $250,000 per financial year. Now, instruments that you can invest in include US stocks, offshore bonds, mutual funds, offshore global markets, other global markets as well. In terms of key points to consider, where the utmost important key point to consider here is the LRS limit. Indian residents can only invest up to US dollars $250,000 per financial year and not beyond that. Now, why should you invest in global markets using gift cities? One, you get global exposure to global markets overall, and it can also help you diversify your portfolio. Most of the mutual funds that are provided by Indian brokers that provide exposure to the global markets are right now not available for trading, buying or selling right now. So this is a good way to invest in global markets via the gift city. Now, in terms of how taxation works for these purposes, well, for individuals and non-individuals, taxation is at 20% post indexation if it's held for 36 months or more. In terms of taxation, again at 20% post indexation after 24 months for listed securities on IFSC. In terms of the other tax benefits like exemption from STT, CTT and stamp duty for transactions carried out on IFSC exchanges is also there. So this is the overall view as to how one can actually open a demat account in the gift city via an IFSC broker and start investing in global markets.
Is that something that you're going to consider? Let us know in the comment section. Now, there's another update when it comes to the EPFO, the Employee Provident Fund, and how you should have a nomination in place well in advance. How should you do that nomination? My colleague Yukta has this report.
The Employee Provident Fund forms a sizable nest egg for a lot of people, particularly if they contribute till their retirement. And while the EPFO is working to address concerns about withdrawal of funds, there are several complications for survivors of members that passed away without having a nominee assigned. This involves endless paperwork and delayed payouts. But here's how you can fix that today, by updating your EPF nomination online. And it just takes a few minutes. Start by logging into the EPFO portal using your universal account number, password and the CAPTCHA code. Now once you're in, head to the Manage tab and click on e-nomination. You'll be prompted to enter new information. A page will open showing your basic account details like your name, UAN, member ID and date of birth. You can click proceed on that. Now under the family declaration section, choose yes to either add a new nominee or update an existing one. This is where you fill in their details like name, gender, date of birth, your relationship with them, address, bank account info, and even a photo. If your nominee is a minor, you'll also need to add a guardian. But once you've filled everything in, click Save Family Details. If you want to add more nominees, hit Add Now and repeat the process. But you can also decide how much of the fund each nominee should receive by entering their share percentage. Save the nomination when you're done. Next, scroll down to the pending nomination section and here click on e-sign. Enter your Aadhaar virtual ID and click verify, and you'll be asked to give consent for KYC services. Once you do that, enter your virtual ID again and click get OTP. Then you enter the OTP sent to your Aadhaar linked mobile number, and once it's verified, your nomination is complete. To check your nominees, you can go to the Manage tab, click on e-nomination and then click on nomination history. It's also important to know that you can only nominate your parents, spouse or children, not siblings or friends.
And that brings us to the end of this edition of Your Money Matters. It's been an absolute pleasure bringing it to you. Do stay tuned for a lot more in the space. This is NDTV Profit.
Apollo ties. Now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system.
Rakesh Sharma joining in this morning, Executive Director at Bajaj Auto. Mr. Sharma, very good morning. Tamanna here. Glad to speak with you. As always, let's talk about how April has fared. The numbers on the face of it show some signs of weakness. Is this because of a tightness in finance, or how are you looking at the whole month?
Good morning. Actually, the numbers show a weakness both for the industry and for us, largely because of the base effect. You know, we have now entered an important mini season period, which is, marriages in the north. And this constitutes about 45% of the market, which gets affected. So it's a substantial chunk. Now, last year, all the marriages were bunched in April. So we had a very good April, both for the industry and for the individual companies. And this year, the marriages are evenly spread right across April, May, and June. And therefore, an April comparison with last year's April doesn't tell us much. We, to understand the market and our own relative performance, we are looking at how April has performed sequentially, going from March into April. And there is some good news over there. I think there is an uptick in the industry, and the uptick is almost 16 to 17% over March. If you recall, the quarter four performance of industry has been choppy numbers were like -3, -4%. That is the performance of the industry. And therefore, it was important to see how April starts to shape up Q1. And April has gone off pretty well. Things have improved over March, and we would rather look at that comparison.
Fair enough. The marriage season may have skewed factors for the month of April. But what about the financing capabilities or the finance which is available to customers? That has squeezed over the system. Are you seeing the impact of that even going forward?
No, we are not seeing that impact at all. I think that impact is felt in parts of the industry which had sort of overreached on finance and taken bigger risks. And now what we're seeing is pulling back. So a lot of our financing, almost 70%, is from our captive finance company, which has followed very even policies 6 months back, 3 months back, and currently. And we are not seeing any issues around that. We are aware that the risk has to be assessed very carefully, and the captive finance company, which is Bajaj Auto Credit Limited, is doing that. But I wouldn't say that our sales have got hampered because of BACL tightening any credit norms.
Right. Rakesh, that's an interesting point to make, because the read on the street was that probably Bajaj also would be one of the companies that would be impacted by the same, but that's a good clarification coming in there. We've discussed about the domestic part of the business. When you talk about exports, yes, you've seen 4% growth. However, it's lower than the peers and Bajaj Auto's historic average as well. So what is the aspect on that front? What is causing concerns? And is this a one-off?
Yeah, again, it's a base effect. I would say that going forward, we should be delivering the double-digit growth, which we have been doing in the last few months. And I would say that, about 10 to 15% growth year-on-year basis is certainly visible.
Okay. And which are the markets where you think recovery could be faster? Because always when you talk about a Bajaj Auto, the moment there is weakness in the domestic market, you always have the exports which come to the rescue, and vice versa. The strategy just plays well for you. So this time around, when there is weakness across exports and domestic, which segments will be the green shoots in the coming quarters?
No, but first of all, let me clarify. I just said that I'm not seeing any weakness in the export market. We have been growing at about 14 to 15%. This is a one-off because of a base effect. And hopefully in the next few months, we should be in that zone of growth. Yes, we would like the overseas markets, particularly Africa, to pick up. They have been at a certain plateau. And there is a bit of an overhang of all that is going around in the world on tariffs and making currencies a bit jittery, holding back purchases, etc. So Latin America is also seeing a little bit of plateau, but Asia is coming back rather smartly. So all in all, I would say 10 to 15% growth is visible for us, which is in keeping with our trends in the last few months.
Enough. Mr. Sharma, let's get into a little bit of detail on what's happening industry-wise and where Bajaj Auto is standing in comparison. Because if I look at growth over the last, if I take November 2024 and look since then, industry-wise, growth has been petering down for the two-wheeler segment as a whole. If I were to compare or ask you to look at how Bajaj Auto is doing relatively, are you feeling the same pain points? And within that context, are you seeing an uptick going forward in demand? Because you're looking at this broader rural recovery story. I'm wondering what your take on that is.
Well, last year was about 5 to 6% growth for the industry. And this was led by the top half. However, the growth is not secular across the months and quarters. What we have found is that there are wide variations in growth. Q1 last year was double digits. Then Q2 sank a little bit. Quarter 3, because of October, was 16-17%. And Quarter 4, like I just said, was -3, -4%. So it's been choppy. We think that going forward, the industry should clock about 6% growth, because the recent past indicates that that is what is going to probably unfold. However, again, I don't think that the growth is going to be very evenly distributed. We will have to navigate some sharp peaks and troughs. That's the nature of consumer behavior also. In parts, it is fueled by consumer behavior, which is waiting for festives and occasions to buy and things like that. The structure of the demand will also continue as it has been, which is the top half, which is the 125cc plus segment, should be growing at almost twice the rate of the 100cc segment. That has happened for quite a few quarters, 2 years almost, and we think that that is going to continue. So yes, about 6% growth led by the top half, but choppy. Each quarter will have to be dealt with on its own merit.
Oh, that's fine. But are you seeing two-wheelers pick up further? Are you seeing more focus on commercial vehicles? If you can just give us some color, what are you seeing happening with the EV space of it?
What I told you just now is all about motorcycles. So my comments were motorcycles, not about two-wheelers and three-wheelers.
Okay. So let's get into some more detailing on two-wheelers and three-wheelers, and what is the direction that you're seeing there?
Well, like I just said, we think that motorcycles should grow at 6%, but it might be choppy in the sense that every quarter will have to be dealt with its own merit. Within the motorcycles, the 125cc plus segment should grow at twice the rate of the 100cc segment. That is what our presumption is, and we are basing our forward plans on this hypothesis.
Thank you, Rakesh, so much for joining us on the show and sharing the views. So that's the management of Bajaj Auto.
We're now in conversation with Mr. C.S. Vigneshwar, who's the president of Federation of Automotive Dealers Association, or commonly known as Fada, and they've come out with the data for the April month in terms of sales performance. It's indicating a very interesting trend amongst the categories of vehicles. To talk more about this as well as what's the feedback on the ground from the dealers, we're now joined by Mr. C.S. Vigneshwar. Mr. Vigneshwar, good afternoon, sir, and thanks so much for joining us today. I just wanted to break up how this month has gone essentially in terms of vehicle categories. I wanted to start off first with the two-wheeler growth. It's been roughly about 2.5% compared to last year, 2.25%. And this number has actually grown 11% sequentially from the previous month. Now, we had months like Gudi Padwa also go into March this year compared to April last year, but still this number is quite positive. If you could just start off first with, in terms of two-wheelers, in terms of the growth momentum, has this largely been led by rural demand according to you?
Thank you so much for having us over. Yes, it's been modest growth, but it has been a growth which we are certainly enjoying seeing these figures because it's quite encouraging. We have grown at about 2.25% year on year in April, the two-wheeler segment, which is quite decent from the fact that we've also had the OBD price increases. So that also has been a little bit of a headwind. But despite it growing at about 11.84% month on month and 2.25% year on year, I think it's extremely good. And we are really hoping for the other sectors also to do well.
Mr. Vigneshwar, there has been a lot of brokerage notes as well as on the ground the financing requirements have slightly gotten tighter for two-wheelers. Are you also seeing that on the ground currently? Because we have a lot of two-wheeler listed companies who have their own financing arm as well. But largely amongst the NBFCs, there has been some notion of tightening in terms of credit quality. How are you seeing that on the ground?
We are seeing some things very, very similar. Our tag times between getting a customer connected with the financer and then the financer giving the loan to the customer is taking longer. We call it the tag time. We are also seeing that a lot of rejections are there compared to what it was 6 months before. And we also seen that financiers, the bankers asking for more documents. So these things have actually been a little bit of an impediment for growth.
And in terms of, let's move into the passenger car side, because while there has been growth shown in this year, according to the data from yours, 1.55% on a YOY basis, Do you see that this has largely been fueled, of course, by SUVs, but also by discounts?
Yes, discounts are certainly pushing these vehicles inventories to customers. And it is again a question of having stock, because right now, throughout the industry, we are having about 50 days of stock, which is clearly 2 times the stock levels what FADA recommends. And discounts would be, of course, a factor of stock, because higher the stock, therefore, we are giving out more discounts. So we are working with OEMs, but the OEMs need to take a little bit more attention, give more attention, and spend more time in seeing how they can optimize these inventories, bring it down to 21 days, which is what is the industry and the FADA recommendation. Moment this happens, perhaps things would be better, because as a dealer, not only we are paying higher stock interest, but we are also paying higher discounts. So our books are not looking great. This needs to improve, and we really need to work with OEMs to make that happen. From that's one point of view. This month, we have also given out data regarding different fuel types. So that is also something which is quite interesting. We are seeing that alternative fuels, which are CNG, LPG, you also talk about hybrids and EVs, they are right now constituting nearly 30% of sales. So which is a good thing. Slowly we are replacing fossil fuels in different ways. The traditional fossil fuels were of course pure diesel and pure petrol. So these are being given a run for the money, so to speak. And this wasn't even 1 or 2%, let's say 5 years ago. So I think the whole industry has come together to give the customer a choice and also to give relief to our exchequer, because we are trying to help the drain in our forex reserves by selling only diesel and petrol vehicles.
Mr. Vigneshwar, would you say that the tractor demand has actually been